Check 1, 2.
Good morning, everyone. We're about to get started. If folks could take seats. So good morning. I am Wendy Edelberg. I am director of the Hamilton Project at Brookings, and it is my great honor and pleasure to have the task of welcoming you here on behalf of Brookings, and I think gaveling in this conference. I have long been a fan and consumer of the work coming out of the Tax Policy Center, so this is really a privilege. And looking over today's agenda just fills me with optimism. The work being discussed today reflects the efforts of scores of excellent researchers dedicating their experience to making government function better. The day will be filled with actionable ideas and findings. And recent legislative events notwithstanding, there is clearly momentum and additional resources for the IRS to invest in better implementation, even under current law. So now, with that, I'm going to hand things over to Eric Toder, Institute Fellow and Co-Director at the Tax Policy Center. Before joining TPC, Eric had stints at the Office of Tax Analysis at Treasury, the IRS, and CBO. And Eric is going to also take a few minutes to welcome you.
Well, thank you, Wendy, and welcome everyone to the 13th annual IRS TPC Research Conference. That's one thing that changes every year, the number in front of that. It's really great to be back after 4 years of being online and to see so many old friends again. I'd like to thank the conference committee headed by Brett Collins and Alan Plumley at IRS and Rob McClellan at TPC for putting together this year a really great program. And this is a very interesting time we're living through in tax policy and administration. In addition to all the usual concerns we always have about the tax system and the need for reform, we also have to face how to deal with the expiration of the individual income tax cuts at the end of, in TCJA at the end of 2025, and the ongoing expiration of some of the, and increases in taxes on some of the business base items. So there's a lot going on. And of course, on the enforcement side, you've had this increase in the budget that makes up for years of cuts. Hopefully that will be sustained. There are some concerns about that. So it is a very challenging time, and I think it makes the research at this conference on compliance and how that can be done effectively even more relevant than it usually is. Today's program will address major questions in tax administration, and this is just some of them. How can we reduce compliance costs and more effectively deliver tax benefits? What are the sources of racial differences in audit rates? How changes in the quantity and do changes in the quantity and the composition of audits affect voluntary compliance? How is the composition of taxpayers and their activities changed? And how does that affect compliance? And how much assets are hidden in foreign accounts, and how do we identify them? Our keynote speaker today is Catherine Ron-Powell, an opinion columnist of the Post, who has written a lot about tax issues and tax compliance funding recently, so I think you'll find her comments interesting. Let me now turn the microphone over to Barry Johnson, who is a deputy head of RAS and thankfully also the director of SOI, and we appreciate all the help you've given to the tax community over the years.
Thanks, Eric. So Melanie Krause, the IRS's Chief Data and Analytics Officer and the Director of Research Applied Analytics and Statistics, or RAS, couldn't be here with us today, so you got me instead, but she will be joining us online later today. I know if she were here, she would like to thank all of you for attending this 13th annual conference. So I'll start by thanking our co-sponsor at the Tax Policy Center. Thank you, Eric, for your continued generosity in supporting tax administration-related research. This is such an important forum for IRS researchers, for our peers in other agencies, and from other tax administrators to come together to get feedback on our work and to learn from each other. Thanks also to Bill Gale and the Brookings Institution for sharing their beautiful facilities with us so that we can resume meeting in person after such a long hiatus. Before going any further, I just want to note how proud I am to be associated with the really outstanding folks who make up RAS and those in the IRS research functions that are embedded in the operating divisions. These talented staff daily undertake innovative, highly technical work that is already impacting tax administration activities across the IRS and globally through our work with the OECD Tax Forum. Impacts include applying behavioral insights to improve notices, developing helpful nudges, and even helping to improve the voice prompts taxpayers receive when they call us. Staff are exploring uses of modern machine learning and automations to reduce the time staff spend on routine tasks and to better leverage all the information available to the IRS. They've developed innovative ways of linking tax data to provide fuller pictures of taxpayers' experiences through a wide range of interactions. This approach will help us to identify pain points and measure impact of steps taken to mitigate them. Staff are also making progress combating identity theft, improving audit planning and selection methods, improving estimates of the tax gap, and developing helpful statistics to help taxpayers and researchers better understand the full scope and impact of our tax system. I can think of no better time to be coming together to discuss ways that data and analytics can impact tax administration than now. As already been noted, the recently released the IRA investment and the IRS strategic and operating plan details that have been released in the most recent plan show how we're going to leverage the historic investment, which will transform tax administration on behalf of American taxpayers. Even a cursory review of that plan makes clear that data and analytics are going to be at the heart of a modernized, effective, taxpayer-focused IRS. Every initiative envisions a role for the type of research analytics you'll see today. These include improving services to taxpayers who reach out to us for assistance, new services to help taxpayers identify credits they may have overlooked, designing new treatment streams to reduce time it takes to resolve an issue, and developing new audit selection mechanisms to target the most egregious cases of noncompliance and reduce the number of no-change audits. It's exciting to see that so many of the operating plan priorities are featured on today's program. I have the honor of leading one of the transformational initiatives in the Strategic Operating Plan, a set of projects that recognizes the value to the IRS from partnering with academics to tackle difficult research questions. One of those projects is revitalizing our Joint Statistical Research Program, which is a program that that invites external research proposals to benefit tax administration. We're currently accepting applications through the OMB Standard Application Portal. That window will close on June 30th, but we are committed to annual calls for proposals moving forward. In addition, the operating plan notes the value to the American public from safely using aggregated data to assist with external evidence-building projects, and we're working on several ways to increase our ability to meet those demands within the restrictions of the Internal Revenue Code. Some of this work is done in partnership with the Tax Policy Center, and I'm particularly grateful to Len Berman, Claire Bowen, and the whole team who are keeping that work moving forward. And then finally, I'll note that the additional IRA investment will have a significant impact on all the IRS research functions, including my organization, the Statistics of Income Division. We're actively hiring new data scientists, social scientists, statisticians, computer specialists, and others to support the many transformational activities going on across the service. So we would greatly appreciate any referrals anybody attending here today would like to send our way. We do have some direct hiring authority. We are actively recruiting on college campuses, and we have numerous job postings out on USA Jobs, which is the federal government's hiring website. So if you know anybody that's looking for a job, please send them to us. So it is a great time to be discussing tax administration research, and we at the IRS are very grateful for the support and interest from you who are gathered here today, and for the academic and research institutions who have been helping us move forward, both during the lean times and in the future. Without the work that you have done with us over the last few years, we would not be where we are now, especially given the tight resources over the last decade or so. So thank you. So without further ado, I'm going to invite our speakers and our chair up to kick off the first session. Thank you for being here. I'm looking forward to learning from everybody.
There's limited space up there. Yeah. Hello. Hi, I'm Dina Ackerman at the Office of Tax Analysis in the U.S. Treasury, and I'm here to introduce and moderate the first session, which is Service is Our Surname. And we have 4 great papers about tax administration. We've got some great data to share with you and lots to think about there. And one paper that's basically more about the background about who's getting the tax credits and what their experiences would be, and which would be very necessary in order to make the right policy calls for things about that. So I want to introduce the 4 papers. First, we'll hear from Jan Millard with a cast of thousands on using behavioral insights to improve taxpayer experience. The authors there are all at IRS. The next paper is how do we reduce tax costs and taxpayer burden for resolving balance due accounts, which will be presented by Howard Rossi, who's also at IRS and has many colleagues on that paper as well. Third would be understanding yearly changes in family structure and income and the impact on tax credits, which will be presented by Nikita Irie, and that is a Brookings paper, Brookings Urban paper. And finally, racial disparity in audit rates, presented by Tom Hertz with his IRS colleagues. And so the session will go that there'll be 20 minutes for the authors to present one at a time, standing here. Then we'll have each of the discussants gets their 10 minutes, and then we will all come back. I will be here, and you will be at your assigned seat, and we will take questions, and we invite you at that time to bring us questions. So without further words, Jan Millard.
Well, good morning. It's such a fun way to start the day, right? I got to set the scene for everybody. So I get to do the fun, and I call this fun because this isn't work to me. This is actually something I'm very passionate about. So what I am going to talk about today is we're going to talk about looking at behavioral insights, right? How we can begin to improve on the taxpayer's experience. So make sure I'm doing this right. Yes, I am. Okay. So I have done numerous papers over the years. I've presented a couple here at some of these conferences in the past, using behavioral insights to try and, the big word is nudge, right? But really what we're trying to do is improve our correspondence to taxpayers to say, hey, this is what we really want you to do in an easy way of doing it. So we thought, hey, here's a great experience. It's not Her Majesty's revenue customers. I think it's now his, right? His Majesty's. But they presented a paper and they talked to us a little bit about what they did is they took the voice prompts when people call in and they said, we kind of did a little bit of that nudge idea in there and we saw some great results. So we said, hey, here's an opportunity to expand our research. So we decided to look at our voice portals. So when taxpayers call in, we call it a voice portal because what they do is they call in and depending on the choices they make, right? So they pick one to go here, pick two to go here, they put them in what we call applications. So those applications allow them to sit. Now, let's be honest. How many of us have ever had to call into the IRS? Anybody? Even me, and I work for the IRS. So if you're anything like me, I'm a prepared individual. I get out my coffee. I make sure my phone is plugged in, and I make sure I'm multitasking as I'm sitting on hold. It's not on purpose, it's just because we have a very large customer base that we have to deal with, and we have a very small staffing to deal with them. But we decided let's take a look at one particular application, and we call this Application 75. Application 75 is basically like the balance due, where taxpayers really need to get into us to talk. So we said, okay, what can we start to look at? When the taxpayer calls in, they get into a holding position, and in that holding position, they get to hear 5 repeatable messages, but they actually don't repeat. They're just 5 messages that are heard in 30, right? There's like a 30-second increment between each. Once that 5th message is gone, they're going to be on hold for the next, 80, 90, 120 minutes. I'm kidding, it's not that bad. So we said, okay, let's think about what is a way, since we know that they're only going to hear 5 messages, how can we position these messages in a way that's going to make sense to the taxpayer? So we took the 5 messages, and currently one message, if you look at it, the first message is, hey, make sure you're prepared. So when your call is answered, okay, well, what does prepared mean? Make sure I'm prepared? It's like, I don't want to be prepared, I just want to talk to somebody, right? That's the mentality. The second original one was like, oh, here are a few online options, but they were not very clear. The third original message is, hey, go to irs.gov and use the searchers, right? Search. Well, okay, what am I searching for? Because I don't even know what I'm trying to do. And then last but not least, it's just that one more prompt to say, hey, again, go to irs.gov. So we went to the call sites and we said, what are some of the calls that you get that are more frustrating for you and the taxpayer? One of the major calls was, okay, people call in and they just want to make a payment over the phone. Guess what? We do not accept payments over the phone. It's not in our purview. So they waited for a good hour and a half just to be told, you have to go into irs.gov and look at and then you had to pay that way. So we said, let's start to look at these messages in a unique order that's going to bring the taxpayers what they need right up front instead of making them wait. So we redesigned the first message to say, did you know that we do not accept payments over the phone? However, you can go to irs.gov, and then we put that /payments. We directed them to the exact location on irs.gov they would have to go in order to present that. The second message, we said, hey, let's take a look at what is it the taxpayers want to do. Most of the time, they want to set up an installment agreement. So we said, let's let them know. If you go onto irs.gov, online payment agreements, did you know you could save money? Because basically, if they go in and input the installment agreement themselves or set it up themselves using our online tools, they'll save money, versus if the person on the phone does it for them, it costs them a little bit more. So not only we encourage them to where they should go to resolve it with our channels, then so on and so forth. Then we kind of get into the, hey, use your online account. You don't know what's going on? Take a look at your account on online accounts on irs.gov, right? So we fashioned our messages to kind of adhere to that flow. What is it the taxpayers want to do? How do we want to start to filter out those people that really can handle using our online resources versus anything else? So that's how we decided to do that wonderful process. Now, we went in with the goal of, okay, what is it that we really want to do here? Well, we want to increase channel shifting. Channel shifting means it's like those taxpayers that are tech savvy and especially don't want to really talk to anybody, they just want to take an online activity. So we wanted to increase that channel shifting to say there are other options other than the phone. We wanted to increase the use of online services. Over the years, we have developed a lot of unique tools now that are available on irs.gov that allow taxpayers and the customers to, self-service. So we wanted to improve on that process as well. And then also, we wanted to save on the resources of allocation. What that meant is there are taxpayers that truly do need to talk to us. They have a reason. There's some complexity behind it. So we want to kind of open up the lines so that they get to us faster. So those were the goals that we had in mind when we decided to do this project. So here's the fun part. How do you actually do a pilot and then take all of that information and analyze it, right? So we had to kind of structure it in a way where we looked at the data, because as we started to look at the data, there's 3 specific groups that we saw a pattern in. The first group is those callers that called in and they heard the message, at least one message, when they, got through, they heard one message and that was one unique, and they only heard one message. The other group was the taxpayers who called in and maybe they didn't get to the messages, they just kind of, hung up, and then they said, oh, I'll call back because I was in the right location. And then they finally did hear at least one message. And then, of course, we have our last group of callers, which they call multiple times, and within those multiple times, they've heard at least one or more of the announcements in the realm. Something to keep in mind is we have those outliers. One of the outliers we had is those taxpayers who called in on multiple days. So they could have heard both the control and then also they could have heard the redesign. So we kind of pulled those out of the database just to make sure that as we were looking at the data, it was a little bit cleaner so that we saw some statistical, significance in the data. So as you can see, just looking at the population as a whole, we saw at least a 12% increase in channel shifting on the redesigned prompts versus the control prompts. And when we say channel shift, they hung up and they took an activity somewhere else, online or they resolve their issue without even having to talk to a caller. We broke down the analysis, in those specific groups so that you could kind of get an idea how they perform. But with the whole population, a 12% increase in providing customer service, I think, is exciting. It's exciting to me. Another thing that we noticed in the data is that you're looking at the access among callers, right? Message increased online access. And when we say online access, it's not just, oh, they're going to set up an installment agreement. They actually went online and did various things. You have online, you have direct pay, you have the credit card payments, you also have what we call online payment agreements. So there's multiple areas online, and we noticed that in that whole sample, based on just using that, hey, going to irs.gov and giving them the various options, we saw that with the whole sampling population, we saw at least an 8% increase in channel shifting with the redesigned messages than we did with the control messages that were currently there. Another fun fact is that OPA. We really wanted to track how many taxpayers are really jumping off or channel shifting to go on and set up their own installment agreement. The reason why we thought this one was really important is you can see there was like almost a 27% increase in the redesign versus the control. And the reason why that is significant is because we stress the importance of it's going to save them money. And it will save them money in the long run, because if they go on and set up their own installment agreements and they can do that, it can save the taxpayer an average of $76 to $95 just by handling or doing it on their own. So we were kind of excited about these numbers where taxpayers are going online and setting up installment agreements and actually using the products that we've started to develop for their use. Okay. Let's talk about, among the callers abandoning a queue. So a large portion of these redesigned messages, we saw that there was an abandon after the second message. So remember I said the first message is kind of, we want to filter out those taxpayers who just want to make a payment over the phone. We know they can't make a payment. So of course we saw, a significant, as far as the redesign over the control of people actually channel shifting. Where it really gets interesting is you see the larger people starting in the second one. The second message was the one that said, hey, you can save money by going online and setting up an installment agreement. So we see that we really start to see a significant channel shifting within that second population. As we get further down the line, we asked ourselves, it's like, are they channel shifting because of the messages as we go further down the line, or is it because there's only that 30-second gap between each one, and they were still busy writing down what it said, and then they're jumping off? So again, the data right now, it gets exciting for me, because it's like, ooh, here's another avenue that I can start to explore where we can even improve more on our customer service and how we start to introduce these messages within that queue process. Okay. So as the callers on the redesign were more likely to abandon their call, spent time waiting to connect, right? So the interesting thing about this, as you see the taxpayers who are starting to abandon the calls and do the channel shifting, that really began to open up a little bit more space in time for those taxpayers who really wanted to talk to a customer service representative. And I think that's probably the most exciting part, is like even 5 minutes may not seem a lot to you, but for the person that's on hold, it's a lot. It's like, oh, hallelujah, I got him faster than I thought I would. Do see that it is saving, we are saving some time, the more, and that leads us to believe the more we start to even look at these redesigns and start to fashion them even better, using those behavioral insights, right? How does the taxpayer go? Then we can start to see even more decreases in wait time for taxpayers who actually want to talk to the customers. So what does all this mean, right? We spend all this time, we do all this studies, we do all this research. So what does that really mean? It allows us to start to take a look at truly what is happening to the taxpayer, right? What is that taxpayer's journey? Why did they call us? What was the purpose of calling it? Is it because they just decided one day, it's like just for giggles, I want to get on the phone and see what the IRS has to say? No, most of the time it's because they've been introduced to us in like, oh, I know I owe, maybe I should call and find out what I should do. Or they receive multiple notices, right? Or they receive notices that they don't even understand. So that's usually the taxpayer's journey. So we wanted to take, really start to understand why it is so that we can refine our data and our analysis. One thing that we learned as we started to really delve into that data, right? Why did they call us? What caused that call to prompt that we were looking at our analysis? It was interesting to see that over 60% of the pilot taxpayers were sent at least one notice within 30 days of the time that they called us. So 60% got at least one notice. So then that makes you ask, why did the other 40% call, right? Are they like me where they go on a trip for a month and they never go to their mailbox and then they come home and they see the big stack of letters? That's another question that we wanted to ask ourselves. One of the largest contributors to the phone calls in our inventory that we were looking at, they received at least that final notice, right? So there's this final balance due notice. It's a little bit of harsher language. And then the interesting thing is the second most notice that was sent out would be the very first notice of balance due, right? So it's like, okay, the last one was the largest inventory, but the first one was a large inventory too. So that kind of is like, you hit them the first time, of course they're going to call. You hit them the last time, of course they're going to call. What's happening in between, right? Those are the questions that I like to ask myself. So when we were looking at these multiple notices, right? So we asked ourselves, more than 50% of these taxpayers that were issued multiple notices prior to calling remained in the queue. Wouldn't you? I mean, if you had like 5 notices from the IRS, wouldn't you wonder, why did I get 5 notices? So you might be more likely to stay on and talk to the customer service rep. So we also thought that's another interesting avenue of information that we can start to pursue. It's like, why are multiple notices going out? So it not only leads us to improve on the process of the phones, but it also leads us to start thinking about how can we improve on our correspondence and how we communicate with our customer base. So then that leads us to the next question. Everyone always says that the level of service that the IRS has is really low. Okay, well, here's the formula that we use. And as you can see in the formula, what is kind of bad toward us as far as the level of service are those abandoned calls. Well, those abandoned calls are what we consider those channel shifters. So really, should we be, asking ourselves, should we really be dinging us? If we're providing them with an opportunity to self-correct, are we not providing a service to that taxpayer? So we kind of looked at this analysis and said, there are some limitations to how we currently look at level of service that we provide to the taxpayers. And what's another approach maybe that we can start to think about when we look now as we're designing these new voice prompts and we're encouraging taxpayers to self-correct and we're developing all these new tools that allow taxpayers to do online application processes. So we started looking at different types of ways that we can really improve on our level of service, right? So you have the level of access, right? This kind of measures the proportion of calls received. The average speed to answer, that's another way. Again, we can look, how long did it take us? Because that's a common one that it should always be considered. The other one is the first contact of resolution, right? So did we help them when they first contacted us? And then, of course, effort to serve. Effort to serve is kind of where you start to get that taxpayer effort and that effort to serve. It's like the taxpayer, they're taking their own action, but we have provided them the ways to do it and the tools that they need to do it, as well as if we're looking at our level of service. Are we providing the tools and are we providing the appropriate avenues for them to use those tools? So that just leads us to this great opportunity. If we were to take our database and all the information and apply to some of these, unique ways of looking at level of service, you can see that if we took the estimated taxpayer efforts, we do see that there is a decrease, and so our level of service, there's a lift, right? We're servicing them better than if we just use the plain old level of service, as well as the same with the estimated effort to serve. And I know that's a lot, but there's a lot of information here, but it's really interesting and fascinating to me. But all of this that we do, we can start to build upon that. So again, we hope to apply more principles of behavior and enhancing how our customers and how we can serve our customers better. We want to continue to develop. We want to do even more testing in this field to see what we learn. So the more we learn about that taxpayer's journey, the better we can start to refine our information toward it. And then, of course, we also want to play around a little bit more with the metrics, so that we can get a better picture of how we truly are servicing the taxpayer and the various avenues that we begin to service them in the future. Well, thank you, guys.
Hello, my name is Howard Racy, and I work for W&I Strategies and Solutions. I think this is the forward. Yes, and today I'm going to be talking about the balance due taxpayer, really with the goal of reducing IRS costs and taxpayer burden. And when we talk about balance due taxpayers, we're talking about people that owe at the time of filing. And really, if we think about filing overall, there's really kind of three outcomes. We have people that have an even balance, so they don't owe us, and we don't owe them. And we have people with a balance due that owe something, or people that get a refund. So the vast majority, and today I'm talking about individual 1040 filers, the vast majority of taxpayers, 80% of this group, they don't have a balance due. But within that population, that 20%, that do have a balance due, again, you have 13% of those folks that pay it. They either pay all of it or they do an installment agreement, but they resolve that issue. But then we have these 7% of people that receive a notice. And of those people, about 87% of those people receive the CP14, which is that first balance due notice. You owe us money, you didn't pay, you did file, but you didn't pay. So it costs the IRS a significant amount of money to handle balance due notices, and specifically the CP14. Now, every year we send out about 7.5 million, so this is 7.5 million taxpayers that are not paying at the time of filing, or not paying in full. And so at a cost, about 51 cents per notice, these numbers start to add up. And so then outcomes, when we think of downstream costs here is really what we're talking about. We have people that pay once they receive that notice, and kind of as Jan was alluding to, the first time they see something, they do pay or set up an installment agreement. Now, installment agreements still cost money because you have monthly reminders. There is a cost also of setting that up in terms of a customer service representative. Then we have those people that ignore us, and then we send them, depending on the balance due, we most likely send them 501, a CP 501. We may send them a 3 based on the amount that they owe. But then here's our call folks. And what Jan was just talking about, all those people that call, well, it costs us about $65 million a year just for the people for the CP14, not including all of the other people that call for other notices that they get. Now, some of the other outcomes here, even when we think about costs per people that visit a taxpayer assistance center, people that have a written response, we didn't have good numbers on these. It's hard to delineate out people that specifically went to Taxpayer Assistance Center specifically for 14. But overall, we're spending a lot of effort, we're spending a lot of time, and the taxpayer is spending a lot of time on the phone, as we were pointing out. So a lot of our intervention, and again, I keep looking at Jan because her group actually did a lot of the work here that I'm referencing here, with a lot of our work goes towards fixing the notice, fixing that CP14. What can we do to get people to contact us, to get people to pay? And we do a lot of things, and we've done a lot of great work around changing the format, changing the fonts, changing the language, all with the idea of getting more people to pay. But with all of this effort and kind of working on this idea, it's the balance due has already occurred. And so we're kind of remediating or reacting to the balance due that's happened. So what if we shift that? And we put it before of what if we could prevent the balance due from occurring in the first place? What if we could identify causes of the balance due and then develop strategies to mitigate that? Well, we kind of have a lot of good outcomes there. We decrease the balance due notice, we decrease downstream costs that I was just talking about. And in many ways, when I've talked about this before, it's kind of like a hypertension analogy here. It's like we can treat hypertension in one of two ways. We can wait, get hypertension, and then take drugs, and then change diets, start to exercise, stop smoking, and all those things. Or we can start earlier, and we can don't start smoking, maintain a healthy weight, exercise, eat right, so you avoid the issue in the first place. And so that's really what our research is going to talk about today. So in order to do that, we really need to identify populations. So who are the folks that really are at risk for having a balance due? And so what we're doing here is we're looking at balance due change, and now we looked at tax year 16 to 17. So why do we look at 16 and 17? Well, this is the last year before the Tax Cut and Jobs Act changed withholding so that you doubled withholding so that the number of Schedule A's significantly dropped. You also had, following that, we had this little thing called global pandemic that resulted in filing changes. We had fewer Schedule C's. Also, you had differences in marriage and divorce rates during that time. So either you couldn't get married because nobody was around and you couldn't travel, or you couldn't get divorced. Not sure. I think that would be the worst of the two. But really what we're looking here is there's three main categories here. You have no change. Somebody in 16 and 17 had the same occurrence. They had a refund. One year they had a refund the next. You have a favorable shift. So this would be a shift away from a balance due, or specifically a balance due with a CP14. And then, unfortunately, you have the unfortunate shift. People that are going from a balance due to a balance due with a CP14 are going from a refund to a balance due with a CP14. And this unfavorable shift is the folks that we wanted to really target. And so, using chi-squared and kind of in Kramer's V to really kind of look at effect sizes, we start to identify certain populations that are having these balance due, these unfavorable balance due changes. And the first one occurs with our friends that couldn't get divorced. And so when you get divorced, now specifically we're defining divorce as moving from married filing jointly to single filing status. And here, with that divorce, we're seeing an unfavorable balance due change. So people from 16 to 17 that got divorced moved from either refund or just a balance due without a 14 to a balance due with a CP14. With Schedule A, if folks removed Schedule A, again, moving towards an unfavorable balance due change. And Schedule C. Now, Schedule C was interesting here because either specifically here, adding Schedule C, and then our next analysis, having Schedule C in general, led to this unfavorable balance due change. And then we also looked at some other schedules, looked at age and looked at total positive income. I'm going to point out income here because I'm going to talk about income later. But with income, you had both unfavorable and favorable. So it kind of was all over the place. So then what we did, we have these populations, the three that we targeted here. We targeted divorce, we targeted removing Schedule A, and we targeted Schedule C. And using a logistic regression, we're really trying to look at risk. How more likely is it that one of these populations is going to end up in a balance due situation or an unfavorable balance due situation? So with divorce, we found that there is triple the risk compared to the standard taxpayer population of a divorced taxpayer moving into an unfavorable balance due situation. Now, for this group between 16 and 17, when we're talking about impact here, there's really only 500, I say only, I guess I shouldn't say only, 578,000 individuals moved from this marriage filing jointly to single, and really that only accounts for about 7.8% of this unfavorable change. But when we move to Schedule A and Schedule C, we have a much bigger impact here. So removing Schedule A, twice the risk. So having it 1 year, removing it the next year, you have twice the risk, almost twice the risk of moving into unfavorable balance due, and the same with Schedule C. Now, Schedule C, if you either had it in 16 and 17 or you added it, you had double the risk. So we looked at income. We tried to look at income. And so what we did, we created a debt ratio where we took the balance due or the refund and then divided that by total positive income to get a percentage. So it basically was what was your refund and what was your balance due? What was the percentage of your total positive income? And not surprisingly, it kind of turned out as you would expect, that the more difference that you had there in terms of positive numbers, the more likely or you were going to have a risk of an unfavorable shift. And so here, like if we look on this kind of this bottom line for 2017, you have the refund folks, the refund even balance going to a balance due with a CP14, and so you had a difference here of 5.67%. So the greater difference between the amount that you owed and your total positive income, the more likely you were to have a balance due that you received a CP14 with. But the issue here, and when we talk about kind of how do we address the issue, income and debt is kind of hard to do. It's like we can't have a different, you can't tell people to have a different debt ratio or make less money or make more money or anything like that. So when we think about how to prevent the balance due from occurring, well, first we start looking at what are those activities. So debt ratio doesn't really give us a good indication of how to do that, but as we can with divorce. Well, what happens with divorce? You may lose dependents that you can claim. You may have to withdraw 401k because lawyers are very expensive. You may lose Schedule A because you no longer have mortgage interest or mortgage deduction, and you may have to add Schedule C. And so, again, when we think about divorce, it's kind of that trifecta of horribleness where we already saw that taking Schedule A away is an issue, adding Schedule C can be an issue. And so, again, but these are the things that can happen there. Removing Schedule A, it's usually around mortgage deductions and medical expenses that you're no longer able to take. And then adding Schedule C, we're seeing so many more people with the gig economy and kind of the side hustles that they do. And one of the things that we believe that happens with the Schedule C is that if you are a wage and investment taxpayer, where you're used to getting a W-2, specifically, they're taking withholding out at the source. However, when you start driving for Uber or Lyft or deliveries or things like that, as a taxpayer that may not know those things, you don't know to kind of withhold or hold money back to account for that income. And so when tax time comes around, it's like, oh, I made all that income, but nothing was withheld, so then you end up in this situation here. So one of the things, like if we know these things are happening, can we inform taxpayers about these risks, these behavior changes that happen, and does messaging really work? Well, according to RAS and their 21 Comprehensive Taxpayer Attitude Survey, it does. 86% in that survey said the more information and guidance the IRS provides, the more likely people are to correctly file. So we conducted a gap analysis. We looked at what information is out there around divorce, around Schedule A, and around the gig economy. And so, or specifically here, divorce, starting a small business in the gig economy. And we looked at 3 sources. We looked at irs.gov, we looked at Google, and we looked at kind of in-person support. Now, irs.gov has a great amount of information. Unfortunately, it's finding that information as, in a sense, a novice taxpayer. It's like you are not aware sometimes of the information that you're trying to find. And so here, a lot of the publications are very technical in nature. We know that. We write in legalese. We write in IRS speak, as we all have, our pages and pages of acronyms. And so, in a sense, we have the information, but being able to locate that information. Google, really, as great as it is, we use it all the time, but unless you know the specific terms that you want to add, like divorce and taxes, or divorce and something, or starting a business where they're not taking out withholding, it's like, well, you're probably going to get an article then, but otherwise not. Now, surprisingly, not so much with Google, but when we talk about gig economy, we also looked into like Lyft and Uber and their pages to see if there's anything in there about informing taxpayers of the impact of making that money without withholding. Not surprising, there's no information there. And we looked at in-person support, and again, it's links, but we don't have that good quality information. So what we did, we partnered with the Taxpayer Experience Office to address we have these populations, and for our purpose now, it's like, in a sense, we've just done this, and so we focused in on divorce, the one that was 3 times the risk. Obviously, we're not dealing with as many people that have issues with Schedule C, but we're making interventions here for those folks. And so the first thing we did, with their help and working with communication and liaison, we developed irs.gov/divorce. And this is a live page that currently exists out there as of about a month ago. And so, again, this is a landing page for divorce taxpayers. It has the one-stop, they can get all of the information that they would need that, in many cases, they don't know they need. And that's kind of really this idea, is like what you don't know often is what gets you in trouble. And then, again, developing new material for that page, like how not to owe taxes after divorce, 5 things to know, and then also developing this kind of external communication campaign. And this is where we are right now in terms of the focus here on divorce. This external campaign is like, how else can we get this information out there, working with communication liaison, Taxpayer Experience Office. So what are those populations? Is it divorce attorneys? Is it a way to get the information to them to say, hey, I know you're getting divorced, I know it's horrible, but don't forget that you don't want to come around tax time and end up in having even a worse situation, or maybe a better situation than you are right now. So I want to give just, when we talked before just about this divorce and taxes checklist, this is, again, kind of what it looks like in terms of this is information that's on that site. It's like, will your taxes get up? I can't see from over here. Yeah, we'll be able to claim dependents, those things. Remember the things that were in the box before about those things that happen. Can you claim this? What's going to happen there? Did you withdraw from 401k? Which, again, a lot of people don't realize there's a penalty for 401k withdrawal, as everybody knows, but that counts as income in the end, which is devastating because then you end up owing lots of money on that. And so really kind of overarchingly what we're talking about today and what I've tried to show here is this idea of an evidence-based intervention where you're identifying an area of concern. So people shifting into this unfavorable balance due. And then using a series of research techniques or analytical techniques like logistic regression, where you're trying to determine the amount of risk, like how likely is it for your population of interest to end up in this a situation that we don't want them in, because we don't want them to have a balance due, and we specifically don't want them to have a balance due with a CP14. And then partnering with stakeholders who have that experience, who have that knowledge and expertise to develop media campaigns, develop websites, and so forth. Thank you.
Hi, everyone. My name is Nikita Airy. I'm from the Tax Policy Center. Today, I'll be presenting a paper I wrote with Elaine Mogg and Lillian Hunter of the Tax Policy Center. We're also grateful to Kevin Werner, Joyce Morton, and Laura Wheaton, who provided assistance and advice in creating our data sets and performing microsimulation runs. And thanks also to the Intuit Financial Freedom Foundation for funding this work. So our goal was to understand how families' economic and household arrangements change from year to year, and what difficulties they or the IRS might face in predicting refundable tax credits based on prior year's tax information. Our analysis, given the renewed interest in advanced tax credits following the 2021 CTC expansion, can help inform the design of advanced tax credit programs and provisions to protect low-income families in the event that their eligibility changes from one year to the next, and they end up having received an overpayment of their advanced tax credits. So for background, the Earned Income Tax Credit and the Child Tax Credit together make up around 17% of low-income families' income, versus only 3% for families overall. And so how families receive such a large chunk of their income, how and when they receive it, matters a lot. Among low-income families with kids, the EITC and CTC are a relatively larger share of incomes for families with multiple children, which makes sense because the credit increases with the number of children you have. And then another interesting thing to note is for women heads of household, this has less to do with the EITC and CTC, but earnings are a relatively smaller share of their total income relative to other income, which is largely dominated for this group by transfers. So let's look at what determines someone's EITC amount and could therefore influence year-to-year swings in credits. So families are first eligible for different maximum credits based on how many eligible dependents they have. So starting from no eligible dependents up to 3 or more. For simplicity, we'll refer to these dependents as children, though there are older dependents who are eligible. Whether you receive the maximum credit, a partial credit, or none depends on your income, and then those income thresholds vary for married versus unmarried filers. And then some of you will have noticed that this graph shows EITC amounts from 2018. EITC amounts are indexed to inflation and it increase slightly every year. So these are a little bit below what current amounts are. And I'll go into the reason for 2018 in a little bit. And then next for the CTC, this graph shows child tax credits amount for a head of household. In other words, an unmarried parent with dependents. The dark blue line shows the child tax credit amounts by income for a filer with 1 child, up to a maximum of $2,000. Unlike the EITC, CTC recipients need to earn at least $2,500 in order to be eligible for the credit. In 2018, with additional earnings above that starting point of $2,500, you could then qualify for up to $1,400 per child as a tax refund. And then those with enough income to owe taxes could qualify for up to $2,000 total per child, including that $1,400 refundable portion. And then for reference, I'm also showing the increased CTC amounts from 2021 in gray above, so $3,600 and $3,000 per child. So in qualitative research with EITC and CTC recipients, you'll see responses from some of them who are pretty savvy about understanding what their total tax refund is likely to be and why, and they plan around receiving it. They plan their finances around it. Some understand how their income affects their credit and how to strategize, like who claims which child in the case where there are overlapping households and caregivers. But more respondents, particularly like low-income respondents on TANF who were interviewed in recent work by Urban Institute colleagues, had very little understanding of what goes into determining their total tax refund and thought of them more as surprise bonuses rather than a reliable recurring source of income. And that has to do with, tax credits aren't the only thing that determine your total tax refund. Withholding can also go into it. And so low-income families also have more volatile incomes than families overall. Around 60% of them will have 1 month of the year that's significantly above their average income for the year. And they also tend to have more ambiguous household arrangements that can complicate their tax filing decisions, such as children living with multiple unmarried parents in the household. So then you throw into the mix the question of whether to deliver tax credits all at once as a lump sum at tax time or in advance of tax time split up into periodic payments like monthly payments like we did in 2021 with the child tax credit. Research by Zachary Parolin and colleagues demonstrated that each type of receipt of each type of payment was associated with alleviating different financial stressors. So large one-time amounts helped families catch up with housing payments, while the monthly recurring smaller amounts helped families afford food. So there's benefits to both. And receiving EITC refunds, on the other hand, has been shown to be associated with positive outcomes like deciding to enroll in college and go to the doctor. While advance payments can smooth incomes month to month and helping families, low-income families with the income volatility we discussed, and cover day-to-day expenses. We also saw families surveyed in the Wellbeing and Basic Needs Survey at the Urban Institute reported preferring monthly payments to lump sums, 45 to 27%. So the question we wanted to answer was how accurately can advance payments be delivered, and how can, considering how families' income and household changes might lead to overpayments. So in order to do that, we analyzed data from the CPS outgoing rotation group. I know it says ASEC, in which around a quarter of households in the CPS are interviewed twice a year apart. They're interviewed for 4 months, they cycle out for 8 months, and then they're interviewed for 4 months again. And so then we have income data from those families from 1 year apart. We use that to create a data set of households with kids in at least one of the 2 years in which they were interviewed. And so we paired 2015 and 16, 2016 and 17, and 2017 and 18. Using that data set, we estimated EITC and CTC amounts using the Urban Institute's TRIM microsimulation model, applying 2018 tax law to all years with some caveats, but the decision to use 2018 was motivated by that was the last year before or in order to minimize the effect of the tax cuts and Jobs Act's changes to the CTC. But we did allow, for example, the EITC to inflate from 1 year to the next. So those changes are reflected in here. We counted changes in tax credits of at least $500. And then in the next few slides, I'll focus on results for households with income under 200% of the federal poverty level in the first year observed. All right, so this graph breaks down the frequency of EITC changes for all families and all families with income below twice poverty. The blue section of the bar represents increases, the black section represents no change, and the yellow section represents decreases with gradients within each color breaking down the magnitude or type of each change. So we saw overall 69% of families saw no change in their EITC compared to only 39% of families under twice poverty. But for many of the 69% with no change in the overall group, that's because they just didn't qualify for an EITC in either year. And so you'll see that's represented by the gray section of the bar labeled 0 both years. For families under twice poverty, 39% saw their EITC decrease and 22% saw their EITC increase. Around half of all increases and decreases in this low-income group were changes of $2,000 or more. We paid particular attention to decreases because this is the situation that would trigger needing to repay an overpaid advanced payment. And in a similar analysis of anonymized TurboTax returns showed very similar results in years not affected by COVID. What drives these changes? For those low-income families whose EITCs decreased, an increase in earnings explains the EITC drop for nearly 3/4 of them, so 28% out of the 39%. So that happens when a family's income moves into or past the phase-down range of the EITC. If you'll recall the trapezoid graph from earlier, that's like that rightmost portion sloping downwards. So then accounting for income changes, decreases in the number of eligible children and increases in earnings explain around half of the remaining EITC decreases. Income changes in either direction caused EITC increases with about equal frequency, but relatively few households saw their EITCs increase as a result of having additional qualifying children in the tax unit. And again, this is just focusing on low-income households. And then lastly, for the EITC, among all low-income households with kids, we saw some variation in EITC changes by household head characteristics. A few interesting differences that we observed were Black non-Hispanic and white non-Hispanic households saw similar rates of EITCs decreasing, staying the same, and increasing. But Hispanic households saw similar rates of EITs, 43% of Hispanic-headed low-income families would see their EITC drop compared to lower portions of Black and white non-Hispanic families. Unmarried household heads had more stable EITC amounts than their married counterparts. We can speculate as to why. Maybe this has to do with the way a tax unit with 2 earners can experience income volatility differently or more acutely than a household with 1 earner. And then for married household heads, EITCs decreased more often than they increased, so like 48% to 20%. And lastly, changes were distributed pretty similarly among household heads under age 35 and between 35 and 50. But a much greater share of households with heads age 50 and above were not eligible for the EITC. Again, this shows households with kids. Some of this has to do with the underlying distribution of ages among EITC recipients. Moving on to the CTC. First of all, changes among all families with kids and families with kids under twice poverty were more similarly distributed than we saw with the EITC, and this has to do with the CTC going to a much wider group of families. Over 90% of all families with kids received a credit in either year compared to 82% of families under twice poverty. So like a greater share of families, low-income families were ineligible for the CTC. We'd expect to see this with the phase-in and the $2,500 earnings threshold for CTC eligibility. Families under this cutoff make up a greater share of the twice poverty subset. 21% of all family CTCs increased compared to 31% of low-income families. For low-income families, smaller and larger changes happened with similar frequency, whereas for all families, changes were dominated by increases of at least $2,000, for example. So CTC decreases were about evenly split between income decreases or decreases in the number of children at home. So these are changes going in the same direction. But CTC increases for low-income families were mostly explained by increases in income, moving up the phase-in range at the beginning of the credit, if we remember that graph. Relatively few increases for low-income families were explained by the household gaining children. But that was actually the much more common explanation for families overall. About half of CTC increases in the overall group were caused by additional children, and half of those specifically by a child being born or the household adopting a child. I haven't shown on this slide a few other options, a few other possible reasons for changes, including changes in the number of other dependents, other older dependents, I should say, income changes in the opposite direction of the credit changes, or changes in marital status. Those make up the remainders, not shown here. And then compared to the EITC, we see relatively few differences in CTC changes by race, ethnicity, marital status, and the age of household heads among low-income families with kids. In general, low-income families are more likely to see their credit increase than decrease. And that, again, we can look at where along the phase-in range for the for the CTC those families' incomes are distributed. We see minor differences by age. For example, households with heads under age 35 are almost twice as likely to see their CTC increase as households with heads age 50 or over. And you can see that in the bottom 3 blue bars. So to wrap up, our results show that pretty big shares of low-income families would be at risk of needing to repay advanced tax credits because so many families' credits decrease from one year to the next. Specifically, we saw 39% of low-income families with a decrease in their EITC and 20% with a decrease in their CTC. Overall, most families overall, credits remain stable within $500 from year to year, which suggests a safe harbor of that amount would protect most families from needing to reconcile or repay excess payments. But for low-income families, further safeguards might be needed. This might point to only advancing part of the advance payments, maybe higher safe harbor thresholds for those with lower incomes, or perhaps only advancing the CTC and not the EITC, because we see that those higher rates of decreases in the EITC. At the same time, outreach efforts can help families plan for some foreseeable changes in their tax filing situation. For example, you can anticipate a kid coming into the tax unit in advance to some extent, and you can also anticipate a child aging out of eligibility for the EITC and CTC. though what our analysis shows is that this accounts for a relatively small portion of changes overall, which are dominated by those income changes. So yeah, thank you so much.
Okay. Thanks, everyone. I'm pleased to be able to present some new research today on differences in audit rates by race. It's with my colleagues Brian Sarton, Carol Eibel, and Mark Payne, all of IRS. And this work is really an extension of the work originally published by the Stanford team cited as Alzane et al. We sometimes call that the Stanford paper. And we're trying to extend that work and really draw the lessons from it that we can for operational impact on IRS. So some important disclaimers here, more important than usual perhaps. This document reflects the views of the authors, one of whom, me, is also an author of the Alzane et al. Paper. So this work is preliminary, and we're sharing it in hopes of eliciting some constructive feedback to improve our understanding of what's going on here. And the perspectives and findings expressed here should not be taken to represent IRS or Treasury Department policy. So in this presentation, I'll use we and our. When I say we and our, I'm referring to the 4 people listed there. I'm not referring to the other Stanford paper co-authors, and I'm not speaking for IRS or Treasury policymakers. Second important disclaimer, as many of you know, the IRS does not collect data on taxpayer race. So all of these estimates are based on race ethnicity probabilities, which are based on first, last name, and address matching against published distributions of the race and ethnicity frequencies for those attributes. And importantly, these estimated race data are then used for research purposes only. They are not used in audit selection, and they will not be. So the first thing I'll do is look at some of the key findings in the Stanford paper and then try to figure out what we can really take away from them. And then I want to step back a little bit and look at some of the other sources of audit rate differences by race, which will touch on some of the work of the last paper, actually. And then to really stress the point that Stanford stressed, which is that audit enforcement objectives matter. Okay, then we'll look at some evidence for algorithmic bias in EITC audit selection. And some evidence that unscrupulous paid preparers contribute to the audit rate gap. Okay? So here are some of the key findings from the Alzane et al. Paper, which I trust many people in this room are somewhat familiar with. The headline finding was that using the imputed race data, they found that black taxpayers were audited at between 3 and 5 times the rate of non-black taxpayers looking at tax year 2014. They find that the bulk of this gap reflects differences in audit rates by race among EITC claimants, not simply that EITC is audited at higher rates than non-EITC and that EITC has a disproportionately black clientele, as it were, but that within EITC there is a race gap in audit rates. So that's an interesting finding. So looking within the EITC claimants again, they built alternative audit selection models using the representative audit data from the NRP to try to infer what might be creating a race gap in the operational outcomes. And they looked at the following questions. What is the objective of the audit selection model? All right. And what they find is that models that try to find claimants with the highest total tax understatements will pick non-black taxpayers at higher rates, whereas models that try to find claimants with the highest overclaimed refundable credits picked black taxpayers at higher rates. So to be clear, overclaimed refundable credits are one form of tax understatement, but they are not the only form of tax understatement. So that latter objective is a subset of the former. And it turns out that the demographics of who you pick depends on whether you focus on the total or whether you focus on the overclaimed refundable credits subset. They also found that looking for the highest expected value of tax understatements picks non-black taxpayers at higher rates, whereas selecting those with the highest probability of any understatement picks black taxpayers at higher rates. So expected values versus probabilities, another factor that matters. Last, they figured out that large Schedule Cs make a difference. In particular, if you constrain your model to audit a limited number of EITC returns that also have a large Schedule C, above $25,000 in gross Schedule C income, that will audit black taxpayers at higher rates than if you do not constrain the model in that way. So it was hypothesized that maybe there is some Schedule C constraint, perhaps related to resource constraints on the IRS side, that might be driving down the Schedule C share and driving up the share of black who are audited. So these are three hypotheses based on simulations in research data. They're not actually sort of forensic analyses of the operational models. So what do we make of all this? First of all, our subsequent research has basically replicated the headline finding and confirmed it, and confirmed that it's relatively stable over time, with some interesting changes, but fundamentally relatively stable over time. We've also extended the work to look at Hispanic, Asian Pacific Islander, white, and all other / multiple race taxpayers who were aggregated as non-black in the Stanford paper. Then we turn to the question of the sort of decomposition results that the paper presented. In particular, a decomposition tried to break the total disparity in black, non-black audit rates into the difference in audit rates among EITC claimants, among non-EITC claimants, and in this between effect, which is the one I referred to earlier, that if EITC is audited at a higher rate and is disproportionately black, then that will mechanically have an impact on black taxpayers. So what is the relative weight of those three factors? And the results in the paper come up with the lion's share being the within EITC piece, and relatively small amount, 14%, being the between effect, the component C there. And this would seem to imply that to reduce the overall race gap, we really need to focus on part A. Okay, but in fact, there are other ways to do that decomposition, and many of them assign a somewhat larger share to component C, the between piece. In particular, there's a thought experiment you can imagine, which is, what if we equated black and non-black audit rates within EITC? Just equate them mechanically, recalculate the overall disparity, what do you get? And then what if we did the opposite experiment, equate the EITC and non-EITC audit rates, leaving disparities in each of those sectors as they are? What would that do to overall disparity? And you might think that from these numbers that one would have a much bigger effect than the other, but in fact they have about the same effect. Both of those thought experiments reduced overall disparity by about 60%. So that kind of tells you that there's two ways into this problem that are both quantitatively important. Okay, so then how about these three modeling exercises? What can we take away from that? The first conclusion is really very important, that among EITC returns, the choice of audit objective really does matter, okay? Fundamentally, the demographics of the distribution of noncompliance, of total tax understatements, are different from the demographics of the distribution of overclaimed refundable credits. Those underlying distributions of noncompliance measured in two different ways are just different. And that means that models that pursue those different objectives will select different populations. That's a fundamental insight of the paper. Now, is it relevant? Well, yes, because historically the refundable credit audit program has focused on refundable credits. So we do, in fact, fall into the overclaimed refundable credits side of that dichotomy, okay? So we are in that, we're on that side of the equation. However, the Stanford paper sort of seems to suggest that a change in objective would reduce the race gap and raise total revenue. But it's important to be clear that the Stanford revenue estimates only hold if all audits are NRP-style audits, which are full-scope audits, and they take about 18 hours apiece. Okay? Whereas the vast majority of EITC audits operationally are correspondence audits with a limited scope. They take about an hour and a half. Okay? So that gap is big enough to be able to conclude that the trajectory in the Stanford paper and this sort of approach to reducing disparity is not a feasible trajectory, just simply cut and pasted to operational reality, okay? What we don't yet know is whether a feasible version of it is possible and what its disparity in revenue properties would be. The expected values versus probabilities question does not appear to be the problem, okay? It is the case that EITC audit selection models generally have the primary objective of minimizing the probability of selecting compliant taxpayers with secondary consideration given to revenue. So we are more on the probability side than the expected value side. And there's a reason for that, right? I mean, avoiding selecting compliant taxpayers is really important for pre-refund audits of low-income taxpayers. Holding their refund check for 6, 9 months, whatever it takes for them to resolve their correct claim and incorrect audit status is a big deal. So there's a reason for focusing on minimizing the no change rate or the false positive rate. Furthermore, subsequent analysis by the Stanford team actually has confirmed that when the objective is refundable credits, the models of probability actually select fewer black taxpayers than do models of expected value. So it flips that conclusion. The previous conclusion was about total tax understatements, saying, you get more black taxpayers if you go with a probability model. That actually flips when you switch the objective function to overclaimed refundable credits, which is more like what our objective function actually is. So this does not appear to be the problem with our current audit modality. Next, the issue of large Schedule Cs. Stanford folks found that the EITC returns with the larger Schedule C businesses are audited at lower rates than would be optimal, that an unconstrained model would choose, and that selecting more such returns would reduce the black, non-black audit rate gap. So that sort of points to a way forward. But again, this conclusion applies to models that are based on total tax understatements and audit the full return. So it's the same issue we have before. We don't really know what a feasible version of that would do and whether it would reach the same conclusion about the importance of large or small Schedule Cs. Okay, so stepping back a little bit to look at some other potential sources of audit rate differences by race. And this really ties into the previous paper about EITC eligibility and volatility in eligibility. Think about the way that the eligibility rules themselves might have a disparate impact by race. There's a lot of examples. One example is this. Married couples can claim stepchildren, but unmarried taxpayers cannot claim their partner's children, even if they support them, even if they're co-resident. And they run the risk of being audited if they do. So this could potentially have a disparate impact on black taxpayers who have lower marriage rates. So there are many other ways that you can think about the EITC eligibility criteria having disparate impact by race, and that might filter into the question of noncompliance and audit. Secondly, the unscrupulous paid preparers, those who submit lots of false claims for EITC and are spotted by our preparer strategy program. What we have shown is that they do, in fact, draw clients disproportionately from minority communities. So if your preparer is submitting a bad return on your behalf and that's getting you audited, that might be part of the problem. Next is the question that the Stanford paper really prioritized, the whole question of exam objectives. Are we trying to minimize no change rates, find largest overclaims, largest total tax dollars? And more generally, are we focused on single issue audits and doing a lot of them, or are we focused on fewer, longer, multi-issue audits? These are policy choices, and they have demographic implications. And then comes what I would consider algorithmic bias. These first 1, 2, 3 are not algorithmic bias in any data science sense of the term, at least in my book. Let's talk about actual algorithmic bias. What that is, in my book, is that when a particular model for a particular audit selection work stream generates demographic differences in audit rates that cannot be explained by underlying differences in noncompliance, where those underlying differences in noncompliance are defined in relation to the existing tax code and in pursuit of a chosen enforcement objective, right? So how you define your audit objective dictates how you measure and classify compliant versus noncompliant. And only after you condition on all that stuff can you start talking about whether the model is doing what you want it to do. And if it's not, and if it's generating demographic differences that are not justified by what it should be doing, that's algorithmic bias, or that's what I consider algorithmic bias. So having stressed the importance of enforcement objectives, and having stressed that there are many different ways to measure noncompliance that correspond to different enforcement objectives, let's look at what some of those objectives might be. And people in this room know more than I about the multiplicity of ways that you might conceive the IRS's overall objective. One that comes readily to mind is to maximize revenue for a given budget, right? And to do this, you would want to audit according to marginal revenue for dollar of cost, subject to current staffing levels and skills constraints. That approach will get you a particular mix of audit clients demographically. A different approach is a little bit closer to what the Stanford paper documents or illustrates, is what I call proportionality, which is the principle that audit risk should rise sharply with the value of the total tax understatement, even if that does not maximize enforcement revenue. So it may not be the most cost-effective way to audit, but it's a sort of vertically equitable way to audit in the sense that you're auditing the largest non-compliers most heavily. And that is not the same as vertical equity as normally conceived, which is to say that you audit the richest taxpayers most heavily. This is saying you audit the most compliant most heavily. That has a different demographic implication. Or we could try to minimize audits of compliant taxpayers for reasons that we mentioned, but that sacrifices some revenue. Or we could focus on minimizing improper payments of refundable credits, but that will tend to lead towards higher audit rates for black taxpayers. Or we could focus on the question of minimum coverage, or focus on the question of minimum coverage. And here we have to recognize the variety of audit work streams. There is no single audit model. There is no master list that we go down. There are many, many, many different work streams, each driven by different models. And the proportions of work drawn from those different work streams are an important policy choice that can affect disparity as well. Maximizing total federal revenue is another worthy objective, and there we would want to emphasize the deterrent properties of enforcement, which is difficult to do because they're not as well understood as some of the other properties of enforcement. So bottom line is that once you have a set of objectives, it's possible to estimate the expected demographics of taxpayers who meet the corresponding audit criteria. And then if your models are not reproducing those demographics and are deviating from them in significant ways, that is a sign of algorithmic bias. So here is some evidence that that is part of what's going on here. First of all, this comparison that I just said, it's like compare the demographics of who you expect to audit and who you're actually auditing. We've done that comparison for many, many different definitions of noncompliance, different thresholds, different sort of objectives. And we do find that the current black to non-black EITC audit rate ratio is higher than the corresponding noncompliance ratio. So that suggests that something like algorithmic bias is at play. And to date, 3 mechanisms that contribute to this bias have been found. We have not found a magic bullet. There is no magic bullet that we know of. But we found 3 little pieces of the puzzle. First, as many of you know, residency and relationship status of dependents are crucial EITC eligibility criteria, and those we must impute from incomplete information. We don't know the relationship status, and we don't know the residency status in particular of all taxpayers. We impute that, and that process is not error-free. Moreover, it looks like imputation errors raise the audit risk for black EITC claimants relative to others. So hopefully, better models and better data supplementing existing data sources might be able to mitigate that problem. The DDB model, dependent database model that many of you are aware of, is not brand new. It is an aging model. And updating the existing EITC scoring model could potentially increase exam revenue and reduce racial bias, right? Algorithmic bias, in my definition, is the kind of thing that if you get rid of it, you have a win-win. You make more revenue and you have less disparity. And that's what we're hoping might be possible with better machine learning applications to the problem. And then in the past, weekly audit selection targets led to the over-selection in some weeks, led to over-selection in some weeks, going too far down the scoring ranking in some weeks. And that drives down the quality of the audits and appears to also have generated some racial bias. This problem has largely been resolved with better scheduling through the year. Next to last slide, the unscrupulous paid preparers that I referred to previously, we've been tracking them since 2005. There are penalties that can be applied. Treasury is proposing more such penalties. And the numbers are interesting. In 2019, 17 million returns out of 160 million came in from these preparers who were on our list as past or present unscrupulous providers. and 6 million EITC claims out of about 26 million. So it's a big chunk of returns coming from preparers who we don't think are exercising due diligence on behalf of their clients. And what we have shown is that those clients are drawn disproportionately from minority communities. So it matters. And what the one way of quantifying how much it matters is just to exclude all the returns from all of those preparers, to exclude those 17 million or those 6 million. And if we do that, the overall black to non-black gap in audit rates falls by about 21%. So that's a non-trivial chunk of the issue right there. To wrap up, the emphasis on preventing overclaims of EITC credits is reflected in both the number of EITC audits conducted and in the way EITC claimants are selected for audit. That was an important lesson of the Stanford analysis, is that in both cases, this emphasis serves to raise the audit rate for black taxpayers relative to others. Our ongoing research is evaluating the hypothesis that a change in audit objectives to focus on top dollar tax understatements is feasible in a pre-refund correspondence audit environment where we can't spend 18 hours, but we can spend an hour or two per audit, or maybe 3. This includes estimating outcomes in terms of differences in audit rates by race, by burden on the compliant taxpayer, and enforcement revenue. And secondly, we have found evidence of algorithmic bias. It's not the full story, but it seems to be there. And preliminary research has identified potential updates to algorithms that may be able to lower the gap in audit rates while improving audit outcomes. Improvements to audit selection algorithms take time to test and implement and are critically dependent on the funding made available through the IRA. That's it. Thanks.
Okay. Could you stick on for a second to make sure I can do my slides?
Yeah, the right arrow.
Right arrow?
Right arrow.
I always want to go up here.
I did the same thing.
Thank you.
I don't know what up is.
What? It just seems intuitively it should be up, not to the right. Oh, I did it. Excellent.
I'm sorry, on the handheld gizmo.
I don't want to do handheld because I screw up. Okay. I want to thank the organizers for giving me the opportunity to comment on these two really interesting papers. I'm going to start with my comments on Jan's paper, Common Name. It's also a very common experience that we can all relate to. What makes all of you hang up and switch to the online website? Is it how long the wait, the messaging, the number of messages, the music, your tolerance for pain? For me, it's the music that always drives me out, but that's not what's been tested here. I'll be curious to find out what you do play there. How you get into their sample, you've got to be the type of taxpayer who receives a collection notice from the IRS and then follows up with a telephone call and listens to the first pre-recorded message. The first pre-recorded message is followed by 4 more, in between music, and then after the messages are over, it's just straightforward music. The metrics to measure this are, first, does a caller hang up, the abandon rate? Does a caller go to the website, the channel shift? And does a caller actually use the website application, the access rate? I'm going to throw in a quibble here, which is there's a lot of emphasis in this report on percent differences between the two groups. I think percent differences overstate all of the impacts because, for example, on channel shifting, you will see a 13% increase in channel shifting, but that's associated with going from 12.5 percentage points of those people who use it to 14.1%. Quibble. Now, in terms of the emphasis, not the music again, it's the message. And a lot happens in terms of how each message changes. There's a lot of variables that are changing. The 5 that were most salient to me was they began each of the 5 messages with a question, and then they provided an answer, an action. In each of the messages, and particularly in the first message, which they don't do under the current situation, they refer the caller to an IRS website, and thankfully for people like me, they do it at least twice in the same message, if not more than twice, and they give a link to the website that corresponds to the suggested action in the message. They order the messages by the most frequently asked, and recognizing the intelligence of the taxpayer, they don't keep telling the caller that the call volume is high. Another irritant. So what is the impact of messaging, and what is it that we're interested in? For me, what my interest would have been, speaking personally, is what is it in the wording of the messaging that causes a change in behavior? And that's really hard to quantify because, as I say, there's a lot going on in changes in each message. And if I look at the results, I'm a little doubtful as where we draw the line here. If you look at among those who hang up, it's the second message. We see a higher percentage point change in listening to that second message and then hanging up. But if you look at the percent change for those who take action after hanging up, it's the first message, which leads you to a more general website. And also in terms of seeing action taken, it's the people who are, the biggest action is in terms of going and setting up an online payment system. So although it's the second message that tells you that it's a lot cheaper to set up it's a lot cheaper to set up an online payment plan online rather than doing it through the customer service. Those people who do tend to be motivated by the first message, which just gets you to a generic IRS website. And then in terms of the numbers, and I may be misunderstanding the numbers here, because I pulled, but it seemed to me from my reading that a lot of people were eligible to use the online payment system and so forth, to set up a plan online. But when you actually look at the numbers, there's not a lot of people, relatively speaking, who do it under the current message, and then while you get an increase when you go to the new messages, maybe it's only 400 people. So that raises the question that my niece, the user experience expert, pointed me to, which is the issue the messaging or is the issue the website? And we're not there yet. I like this paper because it was fun to read and think about our all experience. It made two important observations which are really relevant to stuff I'm thinking about, which is the issue of how do you measure performance? They point out that the IRS current metric for looking at the effectiveness of telephone calls probably understates or ignores the effect of people hanging up and actually then transferring or channel shifting to the website. And it also indicates that not one metric is ever enough to really get to what the user experience is. From a researcher perspective, I'm very interested, as is a lot of people, in terms of the return on investment on customer service. In this specific example, they were able to trace through from the beginning of getting a letter to taking an action by having the Social Security number, the TIN. And I'm curious as to whether we can, in other forms of customer service, be able to track taxpayers through the use of their TIN. That would be great. Turning to Tom's paper, Tom's paper follows the Stanford study that was released a few months ago, which, even though it's called a Stanford study, Tom is a co-author. And that study confirmed our worst fears that there are racial disparities in the audit rates, in part because most of the co-authors were not affiliated with the IRS. They couldn't really delve into why there are these racial disparities, and that falls on Tom and his colleagues to undertake. But it's going to be a long and difficult task. I don't envy you, but it is interesting. But one of the things that you could get out of the Stanford study was that the objective of the audits mattered. Why were you doing that? And I had flashbacks then to my life as a child in the 90s and getting involved, don't laugh, Barry, and getting involved with EITC compliance at the very beginning. And when I think of what we were looking at that time, in terms of the objective of compliance, it was purely political. Well, maybe not purely political. The goal was to avoid the huge cuts in the EITC that were being proposed by Congress at the time. It was also to open the door on refundability for the child tax credit. And an agreement that was worked out between the White House and Treasury and then Speaker of the House Gingrich, there were no cuts to the EITC, and they did open the door for refundability. So if you look at the political objective, what followed next really gained the objective, at least the commitment to improving compliance in the EITC. And what was worked out in this particular letter was that the IRS would get an additional $700 million in appropriations over the course of 5 years and use that strictly for EITC compliance, and then yield out of that some billions of dollars of revenues. That may sound familiar to those of you involved in the current debate. We were leery of using the error rate. Even though we wanted actually to improve EITC compliance, we were leery of using the error rate because the problem with error rates and tax gaps measures is that on the one hand, they may show a reduction in overpayments, but they may also show an increase in overpayments, because the same thing that may lead to a reduction also may increase the amount of overpayments that are detected. That kind of desire not to go too fixed on the error rate was sort of changed in 2002 with the enactment of the Improper Payment Act and OMB putting the EITC on that list. And now annual measures of the error rate are published. In terms of where Treasury and the IRS were in terms of how you're going to achieve those objectives, the goals were to minimize the burden on both the IRS and taxpayers. And the result was this emphasis on correspondence audits, which would be dealt with through the mail, not in-person interviews, and would also be focused on several issues. And those were informed by the compliance studies, and in addition, they were accompanied by other statutory changes. And those statutory changes, one of which led to trying to get greater access to third-party data. In the 1977 Act, there was this increased access that was given to the IRS to data on child support arrangements through the National Registry of Child Support Registry. Also, there was a requirement that SSA would obtain the SSN of the parent and link it to the SSN of the child that they were currently applying for. Those were going to be a long-term strategy. Okay, I got it down to a minute and a half over time. Any event, we knew there were cracks. We knew that neither was going to get us all the way in terms of being able to detect. The hope was that data analytics would fill in the remaining hole. And some of what Tom has identified suggests that either we haven't kept up with that or that there were holes there. I think in terms of the largest crack in terms of the data was our inability to find any data on marriage. This was a particular concern because one of the issues that we found was that there were married couples who were filing as head of households in order to avoid head of household status. But we were told that marriage data might be available in the shoe boxes of many city halls. We couldn't get that. That could have an effect on the racial disparities because we know that the marriage rate for black adults is about half that of white. And so if you're targeting a head of households, you may be missing the people that we were most concerned with. Going forward, there's a lot of things that need to go forward. What I'm interested in personally is how data after the audit plays into the audit selection. We know from the work that John Guyton, Dave Manoli, and others did, there's a high correlation between EITC denials and people not responding to an audit. If people don't respond to an audit letter because they don't speak English well or because they have good reason to be fearful of government, that may be, and that then factors back into the audit selection, that historical data, that may be compounding bias in the system. And frankly, that's going to be a problem to the extent to which the IRS moves forward in machine learning, which often is based on historical data. Thank you for your patience. And moving on to the next one. Can I do that? Emily, I got you up there.
It's my pleasure to discuss these two very interesting papers. The two papers have a common theme on life events and their tax consequences. I will discuss the balance due paper first and then the credit paper. So I think balance due taxpayer paper is very interesting and very important for tax administration. I especially like the focus placed by this paper on how to prevent taxpayers from being in the vulnerable situation. I have a few comments, some about data analysis and some about the administrative strategies. First, the paper identifies life events by looking at changes in 1040 characteristics from one year to the next, such as changes in filing status or adding or removal tax schedule. I wonder if the authors also look into other situations more generally. For example, you talk about adding Schedule C, so you may be able to calculate the share of taxpayers' income subject to withholding in general, so that the result will not limit it to the Schedule C, but you may be able to see maybe capital gains or dividends also play a role in explaining the result. And the paper said that the regressions were performed on taxpayers who have an unfavorable shift in the balance due status. It may make sense to narrow it down to those taxpayers who also have a CP14 issued, so that we can rule out taxpayers who are able to pay anyway, regardless of status shift. Because I think from Table 2, you can see that among taxpayers who have this unfavorable shift in balance due status, majority of them did not have a CP14 involved. And so I agree with the paper's strategy of identifying the life events, but I think the focus of the paper is on taxpayers who need a nudge in order to pay the balance due. Maybe you have already imposed that data restriction, but it's not clear to me from reading the paper. You talk about the income effect, and I'm interested in seeing some of the income effect on the CP14 issuance and some of the resulting outcome. And next, the paper points out a communication gap between the IRS and taxpayer. And one of the strategic goals covered in the paper, which I found particularly intriguing, is about the external communication campaign. And I would encourage the authors to look into behavioral insights to see or to consider how the IRS could make the message or communication with taxpayers in a more proactive way, or to shape or to influence the taxpayer behavior. Also, given the new infrastructure underway as laid out in the recent strategic operating plan, are there opportunities that IRS could think of to more fundamentally change how it interacts with taxpayers? And as many of you may remember, for TCJA changes in tax year 2018, IRS automatically waived the estimated tax penalty for eligible taxpayers because many taxpayers failed to pay such payments in correspondence to the new law. So I understand the papers want to avoid an outlier like 2018 and focus on 2016 to 2017 changes. But I also think that for outlier situations like that, it is even more important for the IRS to have an effective communication mechanism in place to help taxpayers to avoid that vulnerable situation. Last comment. The paper's emphasis is on upstream prevention, but it looks like the IRS may also want to identify the downstream activity to see why some taxpayers need additional contacts with the IRS. As the paper mentioned, the phone calls, visits at the Taxpayer Assistance Center are all very expensive options and burdensome to taxpayers. So maybe you could see or learn from this additional contact to see if there are any improvements to be done in terms of the clarity or the timing of the initial notice so that we could increase the successful rate of CP14 on the full pay or even installment agreements. Let's turn to the next paper. Yearly change to credits. This paper estimates that a large decline in the year-to-year EITC and CTC occurs for a significant fraction of low-income taxpayers with children, and the impact is greater among certain minority households. This paper also has important implication for the design of advanced credit. I only have a few comments. First, I would like to see more analysis and discussion about the scenario in which a child may be claimed by more than one taxpayer. The paper mentioned multi-generational households, cohabiting couples. So as far as a child's well-being is concerned, it may be interesting to evaluate the credit changes from a child's perspective, in addition to from the taxpayer's perspective, when more than one taxpayer could claim the same kid. Second, on page 7 and page 8 of the paper for the discussion about changes in marital status, I'm a little bit surprised that the paper talks mostly about the income differences between the single and married states, but not so much about the potential change in the child's residency. Maybe it affects a small fraction of taxpayers, but I suspect the impact could be large when the kids move away from the household. Relatedly, in a few places, the paper talks about long-term trend in the U.S. household living situation. For example, the decline in the number of or the share of married couples living only with biological children, or the increases in head of household filers or joint custody. The authors may want to connect these discussions more closely to the paper's focus on the yearly shift in credits. I would love to see what implication we could learn from that kind of analysis. The paper shows that under current law and under current tax administration, if the advanced EITC and CTC were to base this solely on the taxpayer's prior year income and family structure, a significant fraction of taxpayers would need to be repay the credit back at the end of the year, or for some they may not be able to receive the full eligible amount during the tax year. And we also learned that there are a few conditions under which this risk could be minimized. For example, if the life event is anticipated or can be reported timely to the IRS to be reflected in advance payments. And also the credit design also matters. For example, phasing the credits or phase out the credits at a relatively low income level certainly will make the advance payment less predictable for a larger fraction of taxpayers. And I think these are all very great points we should keep in mind in related discussion. However, regardless of whether there is an advance option or not, I think it is desirable from policy and tax administrative point of views to reduce the risk of unexpected and unfavorable change in the credit amount from one year to another. And one implication alluded to but not elaborated in the paper is the importance of IRS taxpayer service. I guess, the discussion in the previous paper about how to improve IRS communication in a more proactive way can also apply and certainly will help with the current case. Thank you.
Okay. Before taking questions, I just want to thank everyone for presenting and your interesting work. And I also want to give special credit because never before in the history of presentations have I seen people behave so well regarding time. So thank you very much. Yeah. Yeah, so except for Janet, thank you, everyone. Okay. So questions? Yes.
I had a question for Howard. You noticed, or you indicated that one of the drivers, perhaps, of reducing BAL-due situations was the filing of Schedule A, itemizing. And I wonder, well, that sort of makes sense, right? So if someone has, at the end of the year, a certain amount of tax withheld, and then they figure out their tax and it's not met by the amount that they've had withheld, they could reduce their BAL-due by making up some itemized deductions. Maybe things like charitable contributions that aren't really tracked all that well by the IRS. And so I'm wondering that the outcome of let's say not having a BAL-due or having a smaller BAL-due sounds like a good thing, but it may actually be caused by a bad thing if it's noncompliance, reporting noncompliance. And I'm particularly concerned about that because our random audits historically have said that the compliance of people who claim that they have a refund due is less compliant than those who admit that they have a BAL-due. They're more honest. So I'm just wondering if you've been able to check into that maybe the reduction of BAL-dues may actually be caused by a bad thing.
I see like a foot in front of my face. That's not something that we've looked at. So you're really talking about kind of mitigating or using that BAL-due so it's not something that we've considered or used, but it's really with the Schedule A, it's the removal of that. So it's like you had those in one year, and then when you remove Schedule A, that's when someone's more likely or twice as likely in terms of the risk to move into a BAL-due situation. Does that answer?
Yeah, but removing, if the prior year is not the right baseline, if the right year they had fake itemized deductions, they take that away, that could be a good thing, but it may result in a BAL-due this year.
Okay, I see what you mean. Yeah, so it's really would be looking at more of a trend overall. So you'd have to look at the previous year. So did they use that? Did they use like things that weren't true on one year and then removed it? So yeah, we only looked at the 2 years. So we didn't consider if it was legal what they did in 16 compared to what they did in 17. But yeah, it's something that we can look at, kind of more of a trend over time.
Okay, and question over here.
Yes, a couple of quick things for Jan for the first paper. So one thing that I assume, so please confirm this, you guys ask for the identification number at the beginning of the call, because you are following these people over time, or you are supposed to be following these people over time. So I assume that that's the first thing you do. The second thing is that I didn't understand very well, because you said that you dropped some people that call multiple times, but you will assume that these people originally were assigned to a treatment or a control, no, the first time they call. So if they call multiple times, then your treatment is not working, so you should be considering these people in the analysis, no?
Yeah, so the reason why we chose the application that we did is because in order to be in the application, the taxpayer did have to provide a TIN, so we were able to follow them that. That was the nice thing. One of the reasons why we did the multiple is because we were trying to test the validity of the messages, right? So is the nudge possibly doing it? Is the control? So those that called multiple times, they heard both the control and the nudge, and so it's like, okay, we can't apply the logic to, did we see a channel shift because of the message change, right? It's because that's one of the things, but, right, yeah. So, but the interesting thing about that data is now we have another little subset over here that we can say, okay, why are they doing this? It's like, we've tried multiple ways. Why are they doing it? So what type of path are they taking? Which again, now we've got all these cool ways like, ooh, how can we even do a better pilot next time? Or how can we do other designs? How can we start to address those taxpayers that we kind of put on our outlier for the moment? So we didn't quite ignore them. We did for the analysis, but we still have them in the back of our mind based on the analysis we took on them, on how we can start to approach in different avenues.
And also, we couldn't assign taxpayers to a control or a treatment group. We had to do it by day. So taxpayers who called in on certain days heard the control message, and taxpayers who called in on other days heard the revised message.
Yeah.
Question? Okay, well, did I miss anybody? I see a hand over there.
And this question is for Tom. I was really struck by the unscrupulous preparer impact and whether you're examining the presence of a tax time bank product with those non-compliant returns. And the question is more about ability to improve and whether other Treasury agencies, like the financial bank regulators, would want to be involved if the underlying return flowing into a bank is in fact an improper payment. Then, positive impact would be broader than IRS.
Can you, tax time bank product?
Like
you
a
wanna...
RAC, RAL, refund transfer product, all the ones where they'll enter into a contract with the preparer at the time of preparation to have fees deducted from the forthcoming refund by having a limited purpose depository account opened in a third-party banking institution. That tends to be something that I've seen in DOJ press releases tied to civil injunctions and criminal cases.
Wow. Well, I don't know anything about that. The first thing I would want to know is whether we can track that information. And I can certainly relay that question to the people who do know something about that.
Yeah, I think a RAC and a RAL indicator, there's a GAO paper from 2019 that goes into the ability and accuracy for IRS to track RACs and RALs. And then I think they also use there's only probably like 6 or 7 banks where there's a unique routing number, and you can identify consecutive prepaid debit card trackers.
Okay,
for the
thanks.
account number.
Yes.
Yeah, so this is for, I guess, Howard and Nikita kind of jointly. And I'm wondering, you kind of talked a lot about this ex post or like a website, but given that the IRS does have at least some information, like for wages, how much you're changing kind of during the year, or Nikita, for your paper, like we know when the child turns 18, right, they're likely to drop off. And I'm wondering if you've kind of thought about how we can use these kind of ex ante predictive measures to maybe send out a letter, in the year before this happens and say, hey, your child is going to drop off. That's going to change your EITC, or that might change your filing status. Here are some things you might want to consider, and use that as kind of a preemptive measure as well to reduce kind of this non-compliance or shocks to taxes.
Well, I'll leave the designing taxpayer customer service to the experts, but I will say I've done some research on a program where nurses did home visiting with like new mothers, for example, and they did that, and there was a pilot in which the nurses would refer the new expecting mothers to tax filing services. And so, and with Kim, who's here actually. And so, that might be one venue, maybe not directly through the IRS, but through trusted messengers and third parties, people who work with vulnerable populations who could be, trusted, who could relay that information and help people plan around those life events. So not quite the IRS, but like another idea for how to do that.
And I think the idea of messaging in terms of letters, I think you run into, obviously there's a cost associated with that, just as we saw with the CP14, but also do those letters then generate calls? And so when you're looking at kind of like that return on doing that, but that's one of the things in terms of partnering with, when I was talking about for divorce, can you partner with divorce attorney groups to get the information there that's really, they're dealing with that taxpayer? Can you partner with schools? So you have at part of a letter that goes home potentially from the school for the graduating senior, that information can then like kind of spur that. It's like, hey, I just graduated in May. It's like, well, you may not be able to claim me next year, but you might have AOTC to help you out or something like that. So yeah, it's trying to put it in those, because as we know, many people, we send millions of letters that sit in piles that don't get opened. So partnering with these other organizations that are directly impacting with that individual, I think, is a strategy that we would want to look at.
All right, we have a few questions online, and to the people who have submitted them, whose questions I will not ask, I will make sure they find their way to the right people. This question is mostly for Jan, and it comes from Nina Olson.
I knew it.
I know. Nina wants to know if there's been any investigation into the quality of the plans that the payment plans people end up in, whether they go online versus whether they do it with a human. And are there real differences in the process, or is the caller relatively following a script?
So that's always a really good question. We find that there's this, I shouldn't call it generational gap because I'm sitting up here with gray hair, but you do find that we have a certain group in our demographics that we consider like hand holders, where they kind of have an idea, yeah, I can do it, but while I'm doing it, I really want to have an individual to step me through it to make sure I'm doing it right, because I might make a mistake. And there's nothing worse than making a mistake with the IRS and having them send you another notice telling you you did something wrong. So we haven't seen like a difference in the value of taxpayers who use OPA versus those who call and set it up online. We still get the same results. They're still making the payments. They're still doing everything that they need to do. It's just really the preference of the end user or the individual that's calling on which approach they're going to take.
Right, thank you. And lastly, a general comment from Harper Sutherland at HUD, who'd like to hear the panelists make an effort to focus on, when relevant, the difference between the tax situations and what you're discussing as they may apply to W-2 workers versus gig workers, because their tax situation and their difficulty of filing is quite different. And with that, we are out of time. So I thank you all very, very much.
Do you subscribe to our newsletter?
You have a newsletter?
Or they have like emails. They push emails to give you tax tips and then to give you.
Who's who does?
The IRS.
Oh, the IRS.
Sharing this with me.
Oh, no. But I do know how to use the IRS website with my question.
Oh, I don't want the whole thing.
Hi, I'm John Guyton. I'm with IRS Research Applied Analytics and Statistics. I'll be moderating the second session here, which is on estimating audit aftershocks. Part of the broader context here is developing a better sense of the full range of impacts of our actions as an agency and the broader business impacts there. We had a nice setup for a couple of those themes in Janet's discussions of some of the Jan's paper in particular, talking about the ability to use some of the information discussed in those pilots as part of a return on investment kind of analysis. So I think we can think in a similar kind of frame. The types of work we're going to be looking at here are part of the evidence base for giving us a broader impact, a broader measure of the impact of our actions. So we've got three authors here. First up is Alan Partington from Australian Tax Office. Then we have India Lindsay from MITRE, and then Alan Plumley from the IRS. And then Will Bonning from Treasury will be the discussant. So let's get started. Alan, you want to start here?
Good morning, everyone. My name is Alan Partington. I'm a director with the Australian Taxation Office. Thank you for the opportunity to talk to you this morning. I'm presenting a paper that I co-authored with Murat Besnik in relation to changes to voluntary compliance following random audits on income tax returns. So this paper sort of follows on from previous research that we conducted. There's a few differences in relation to the previous research and this research. So previously, the ATO didn't have a random audit program until relatively recently. We started in 2017, starting with returns for 2015. So previously, our analysis on audit effectiveness was limited to using risk-based operational audit data, which obviously provides us with a biased sample of taxpayers' true reported or true liabilities compared to what they report. So we were operating in that quasi-experimental space using Heckman correction and propensity score matching techniques. And the perennial question we would often get asked from those sort of having a look at those papers is, how do you know the extent to which those techniques are effective in debiasing the data? In effect, how do we know our results from those sort of earlier estimates weren't biased? And probably the honest answer to that was, well, in the absence of a random audit program, we can't be 100% sure. So when we were able to avail ourselves of the random audit data, we were very pleased because it sort of provided us an opportunity to answer that question that had been unresolved until that point. So the first difference, I guess, with this paper is that it uses newly available random audit data. We also had some challenges with some of the data distributions that we were working with. Typically, the techniques I mentioned earlier, Heckman uses a logistic regression and a Tobit regression in a two-stage setup. We sort of found, though, as we worked through it, that the normality assumptions underpinning the use of OLS-based or censored regressions didn't really fit the data that we were working with. So we looked at other estimators that were more robust to non-normal data. And so we used a technique called Poisson pseudo maximum likelihood to try and deal with some of those issues around non-normality. But I'll sort of come to that later. Before I get too far into the approach, I'll sort of go through a few of the concepts that we're sort of looking at in relation to that sort of underpin the analysis. So I mentioned the random inquiry program that we have through a series of comprehensive audits based on a random sample of taxpayers. We determine whether a taxpayer is compliant or non-compliant, essentially whether there's an adjustment that needs to be made to their return. That sort of definition is useful for the purposes of our paper. It does ignore the possibility, though, that sometimes auditors, when reviewing a taxpayer, may make a decision that they're compliant when they're indeed non-compliant, or alternatively, but less likely, that they find that the taxpayer is non-compliant when they're compliant. But we sort of abstract from that a little bit for our analysis. But it can be important, I think, in explaining some of the outcomes that we see. So it's worth bearing in mind for later. We work with 3 populations under that random inquiry program. So we have a look at taxpayers who are in our individual tax gap population. These are taxpayers who are predominantly salary and wage earners. They may have some business, or they may have some investment income, but it's passive income. We also have 2 subpopulations within our small business gap population. So they're individuals who have some active business income, so they what we call sole traders, and also small businesses that operate through a company entity structure. The paper attempts to, there's 3 sort of concepts, I guess, that we look at in terms of the effect of our review and audit programs. The first is the audit yield, so they're the direct liabilities that are raised as a result of the review or audit. And then we look at what we term direct flow on, which is the change in voluntary revenue reported in subsequent years after the audit, which provides us with some indication as to how taxpayers have responded to the audit in the previous year or previous years. There's also another important component. We don't measure this as part of the paper that relates to spillover effects or the indirect flow on from the audit. So that's the behavioural change that we see in taxpayers not directly affected by the audit, but may change their probabilistic assessment of being audited based on what they know of what we're doing in the market. So in terms of the role of audits, I guess this is probably subject to some contention, but we see that the audits underpin the system in an Australian context at least. Our audit coverage is fairly small. It's probably 1 to 2% of the overall population, but we think it plays a very important general deterrence role in underpinning voluntary compliance, I guess, or assisted compliance. So we sort of suggest there that taxpayers do tend to factor in, at least subconsciously, that what their probability of being audited is, and the consequences of being audited. The other argument, I guess, is that they're intrinsically altruistic and very keen to pay their fair share and so forth. We see some of the responses in our later results perhaps not being consistent with altruism being the predominant driver of the results that we see. I guess the bottom line there probably for us is that the more credible the threat of an audit, the lower the payoffs for non-compliance, making it more beneficial to contribute. So audits basically underpin that dynamic as we see it. So the actual analysis itself, it looked at a random selection of taxpayers from those three populations I referenced earlier. At the commencement of this study, there was data available for 2015 income year, 16 and 17, so we had 3 years of data available. The first year of our program, some of the data produced by that was interesting in terms of we think it was subject to a higher than usual level of auditor non-detection, given that they were new to the process. They were engaging in full scope or comprehensive audits for the first time, many of them, and it's an interesting year to have a look at with respect to the data. But we feel that the 3 years looked as a whole provides us with a good basis for drawing some conclusions. So we analyse each year separately, but we also do a joint estimate as well. We only include taxpayers that have been contacted directly by the ATO. The reason for that was that we were very keen to have a degree of intensity in the interaction between the tax administration and the taxpayer to support the notion that there's been some sort of behavioural change. We felt that a correspondence review or audit probably didn't provide sufficient visibility or impact to warrant using that as a product in this context to estimate behavioural change. The intention of the study was basically to try and establish an average treatment effect for, in effect, what would happen if we audited everyone using the properties of the random sample to approximate that. In order to set a baseline for the analysis, we selected a control group. This was constructed after the event as part of the random audit program design. No one really thought to retain a control group per se, so everyone that was initially selected as part of the sample was treated. So we had to undertake some efforts to, following the same criteria as the original sample selection, in effect sample or select a control group of taxpayers that hadn't been treated. We had to go through both the treated and the control to identify potentially confounding interventions. So this is where people treated under the random audit program may have been subsequently treated under our risk-based program in later years. Or similarly for controls where within the time series that we're looking at may have been treated in that time period, which could potentially confound the results. So any taxpayers that were treated subsequently or any in the control that were treated were removed from the study. We also undertook a test to see whether or not the pre-intervention trend was a parallel trend. Probably not an entirely necessary step, but it did confirm that that both the treated and control were similar in trend terms prior to the intervention, which was just a useful way of confirming the quality of that control group that we had to construct after the treatment group had been selected. As part of the analysis, we removed the net tax amounts from the year that the random inquiry was undertaken or the random audit was undertaken. So for instance, taxpayers who were part of the 2015 random audit program, we removed their 2015 returns from the data set, and we do that for the control. That's to remove that direct audit yield value from the analysis. So just in terms of what we found, this just relates to the audit yield that we derived though from those people who were treated. So this isn't the treatment effect per se, it's the treated on the treated basically. So we find that across our populations, the audits were effective at raising direct audit liabilities, as indicated in that table on the left there. So not insubstantial sort of adjustments relating to the actual random audits themselves. We also noted that the incidence rates of non-compliance in some of our populations was significantly more than we'd previously thought. So, for example, the orange line there, in our individuals not in business population, roughly 95% of the population had some issue that was detected with a comprehensive audit, which we thought was incredibly high. Some of the issues there is with our self-assessment system in relation to work-related expenses. We don't have a standard deduction in Australia, and there does tend to be a lot of non-compliance in relation to work-related expenses. Also, there's very high incidence rates around people who've got rental properties or investment properties, which pushes it up significantly. That's important for our study as well because for individuals at least, when we went to calculate the effect of the audit with reference to a control, the individuals who were compliant or were found to be compliant with the audit, they were too few in number to actually derive credible estimates of the impact of the audit with reference to a control group for those. So we only estimated the effect for the non-compliant taxpayers for individuals. That gives you some indication of the sample sizes that we have. So our total program, the REP program, is about 1,250 taxpayers per year. So very small compared to the IRS, their NRP program and the like. Unfortunately, that limits our ability to disaggregate our results. So in terms of moving forward, we'd certainly like to increase our sample sizes to help us stratify some of our results and narrow in on some of the causes of what we're seeing. I mentioned some of the, I'll get to the results in a minute. I'll just take a step back in terms of some of our data challenges. When we reviewed the literature, we found that, looking at our data, we found issues with the presence of zero values in our data and a non-normal distribution. The literature tends to suggest two approaches that are commonly used. So one is the use of a log linear model. We found though that because of Jenny's inequality, that back transforming those results led to biased estimates. So we sort of stepped away from using the log linear approach. Another commonly used approach is to add a small constant to the zeros and then logging both sides of the equation. It can create issues around heteroscedasticity across the regressors by doing so. So we sort of stepped away from that as well. where we arrived, and this was a recommendation from my colleague Murat, who was having a very good look at the literature and came across this Poisson pseudo maximum likelihood estimator that was being picked up in some of the literature. I was quite surprised, actually. I'd only come across that technique used for count data, so my initial reaction was to suggest that maybe it wasn't appropriate, but the more we looked at it, the more we found that it had some very desirable characteristics for the sorts of distributions that we were dealing with. So it's PPML is basically a Poisson regression with some robust standard errors. The estimator is based on the conditional mean. Typically, the mean is equal to the variance with a Poisson regression. However, for continuous data, that sort of rarely holds in practice. So we have to estimate our standard errors using Ecker-Huber-White robust covariance estimators. What does that get us? It gets us a bit of precision around our coefficient estimates, and it also gets us the ability to report our results using fairly standard tests of statistical significance, which we think is fairly desirable. So we did go through with our results, though. Sorry, I'll just, as I sort of touched on before, PPML seems to be increasing in popularity in the literature. I haven't seen too much application of it in tax analysis, but it's certainly more popular in other fields. The part of the reason is it's a fairly robust sort of estimate, with the only condition required for consistency is the correct specification of the conditional mean, and its ability to handle the zeros. So when we analysed our results, we used this pretty standard difference in difference estimator. 2 minutes. Sure. So we estimated it with respect to a difference in difference estimator. We take the values after the audit versus the values before the audit and take off the control group to derive the treatment effect. You'll see various specifications of it. One thing we did with ours, we divided our population between compliant and non-compliant, which necessitated the need for individual fixed effects. So these are our results. We found for populations that were based on individuals, the random audits had a negative effect on compliance in subsequent years. So in this case, -475 on a pooled basis. We find divergent impacts based on whether the taxpayer was found to be compliant or non-compliant during the audit. So for those that were compliant, in following periods, their reported liabilities dropped off relative to the control. For people who were found to be non-compliant, they responded to the audit by improving their reported liabilities in subsequent years relative to the control. And for populations that were incorporated, for both the compliant and non-compliant population, they improved their reported liabilities compared to the control. So that's it, really. So we hope that this adds to sort of, or would certainly add to our understanding of the issue. I think we got a lot out of using the PPML estimator. It gave us a lot more confidence around the results that we were seeing. Thank you very much.
Well, hello everyone. My name is India Lindsay and I'm with the MITRE Corporation.
I'll be presenting our research on the long-term impacts of audits on non-filing taxpayers. Starting off with some background, so non-filers are responsible for $32 billion or 9% of the individual income tax gap. And the specific population that we're focused on in this research consists of non-filers with at least $100,000 in reported income. And this population is of key interest because these higher earning non-filers make up a significant proportion of, a small number of the total number of non-filers, but they're responsible for a significant portion of the tax gap. It's estimated that they owe greater than 73% of the non-filing gap. And there's been an increase in the number of non-filers identified every year. There were 7.5 million identified in 2010, and that number increased to 10.7 million in 2016. Alongside that increase, there's been a simultaneous decrease in IRS resources to audit these individuals. The IRS was able to initiate about 3.5 million cases in 2010, and that number fell to 800,000 cases in 2018. So the IRS recognizes the need to strategically pursue these individuals, and they've released several policy initiatives pertaining to that cause. In 2020, the Non-Filer Enforcement Initiative promised stronger pursuit of non-filers, with a specific focus on higher earning individuals. In 2023, the IRA Strategic Operating Plan emphasized a continuation of the strategy with a focus on addressing high-dollar compliance issues. And overall, audits are the primary mechanism that the IRS has to encourage compliance within this population. And while the direct revenue from an audit is understood, there's a need to evaluate the indirect impact of these audits in order to get a proper ROI metric. So this leads us to our research question. What is the effect of an audit on the long-term filing behavior of a non-filing taxpayer? Okay, and so considering the literature on this topic, first, there are conflicting theories on how enforcement affects how a taxpayer will adjust their future filing behavior. And regarding this specific population of higher earning non-filers, there's no set theory on how they will respond to audits. Second, literature has primarily focused on understanding the factors that influence a non-filer's future filing behavior. Key findings from this literature suggest that how visible the taxpayer's income is to tax authorities, the persistence of filing behavior, and the taxpayer's perception of government and sense of moral duty play a prominent role. The majority of this analysis has focused on the general non-filing population, and to the best of our knowledge, Irard was one of the first to extend this analysis to consider higher earning non-filers. Third, there are studies looking at the indirect effects of enforcement on the non-filing population, but these studies are limited. However, one conducted by Taglakis and the other by Data, were able to confirm the presence of an indirect effect when looking at non-filing taxpayers. But overall, there's a gap in literature analyzing both the behavior of higher earning non-filers and the role of IRS enforcement activities on their future filing behavior. Okay, and so to conduct this analysis, we had to identify how non-filers are selected for audits. And in this research, we are specifically focused on non-filers undergoing field audits conducted by SBSE. And I also want to note that this selection process details the procedure used to identify the majority of non-filers for this type of audit, but non-filers can be identified for this audit by alternate processes, such as referrals. All right, and so it starts off when employers, entities, and financial institutions report taxpayer compensation to the IRS. The IRS then compiles this information with prior year return information. Then individuals that have not filed but have reported income or a prior year return are identified by the case creation non-filer identification process. Then selection filters are applied to these taxpayers, and dependent on their characteristics, they can be distributed to various enforcement functions within the IRS. And like I mentioned, we're focused on SBSE field audits. So then the IRS is able to assign taxpayers for audit by estimating their tax liability, assigning a priority score, and then assigning eligible non-filers to field personnel based upon available resources. Okay, and so to conduct this analysis, we used a two-sample group comparison, comparing the filing behavior of individuals in a treatment group with the filing behavior of individuals within a control group. So we obtained our taxpayer data from the IRS's compliance data warehouse. And in this research, the term baseline year refers to the tax year the taxpayer entered the sample, as the return for that year is either audited or is eligible for an audit. And our tax years of interest range from 2009 through 2014. So the treatment group consists of non-filers audited under field exam that were identified from examination records. And we're only considering non-filers audited under this work stream that were identified via the selection process I just detailed. And that's so that we can construct a representative control group. We also excluded any pickups from our treatment group, and pickups refer to returns that were audited under this work stream as a result of a separate but ongoing audit covering another year's return. So then our control group consists of non-filers that were eligible but unaudited for this type of field exam. They were identified by replicating the audit selection process just detailed. And to ensure this group consists of non-filers, we excluded any late filers, secondary filers, or individuals that filed in response to any type of IRS notices. Okay, and on this slide, you can observe our sample size broken out by baseline year, with the treatment or audited group shown in red and the control or not audited group shown in blue. So our treatment group consisted of about 5,700 taxpayers, and our control group consisted of about 4,300 taxpayers. You can observe a variation in the sample size by baseline year, specifically regarding the number of taxpayers that were audited. That number increases leading up to 2011 and then decreases afterwards. And that variation may be the result of changes in audit resources leading to potentially fewer audits being conducted. We also performed some sample cleaning, and we dropped any taxpayers from our sample if they were deceased within the 8 years after baseline year, if they were identified for audit by another procedure, like I'd mentioned, if they were in our treatment group and had any missing or incomplete examination record data, or they were in our control group and underwent any kind of audit within the 6 years surrounding baseline. We then wanted to visualize the distribution of their priority score across groups. And so this shows that score with the audited group in red and the control group in blue. And so this priority score is an IRS internal metric that ranks taxpayers for audit selection. It's based upon their amount of balance due and the likelihood of being able to actually secure that balance due. And so we were able to observe significant overlap between the two groups for this priority score, and that helps confirm that our samples were constructed representatively. You can observe that a higher number of audited taxpayers have a higher priority score, and that's expected as the IRS is pursuing the higher priority taxpayers. All right, so moving on to our dependent variable. So we're interested in monitoring or examining the impact of an audit on a taxpayer's filing behavior. So we want to monitor this filing behavior for the 5 tax years prior to baseline and 8 tax years after baseline. I will say this analysis was constrained by the availability of data on these individuals. So individuals were able to be identified if they were non-filers with at least $100,000 in reported income within between tax year 2009 and 2014. But given the persistence of non-filing behavior, a lot of these individuals would disappear from IRS records in years outside of those baseline years. And so because of that, our outcome variable, fact of filing, has quite a nuanced definition. So it's set to 1 if a taxpayer filed a return. In this research, that includes any taxpayers that filed timely, filed late, or secondary filers, meaning that they were married filing jointly and listed as a secondary filer on their spouse's return. The fact of filing is set to 0 if a taxpayer did not file a return. So this includes taxpayers that are non-filers that are identifiable by the IRS because they have income being reported to the IRS. But it also includes ghosts. And ghost here is a term used within non-filing literature to refer to individuals that are not present within tax records. And so a taxpayer could become a ghost via 2 mechanisms. They could be a ghost because they don't have a filing requirement, meaning they earn below the filing threshold, which in 2023 was around $13,000. Or they could be a ghost because they're actually a non-filer, but their income is not being reported to the IRS, and so the IRS is not able to detect them. And this is where the research got a little bit tricky, is because we cannot distinguish between these 2 types of taxpayers because they're simply not present within IRS records. And a taxpayer that does not have a filing requirement is compliant. But a taxpayer or a taxpayer that's a non-filer but just does not have reported income is non-compliant. So we had to determine how to categorize these with our outcome variable. And from conversations with subject matter experts at the IRS, and given the persistence of income and persistence of non-filing behavior, we chose to categorize them as fact of filing equals 0. And in essence, this assumption is saying that if an individual is earning or has at least $100,000 in reported income for their baseline year and is a non-filer, it's more likely in later years that they continue to be a non-filer, but their income just changes to a concealable source, as opposed to them losing the majority of their income and not having a filing requirement. But that assumption is one that we plan to conduct sensitivity analysis on. Okay, so then we sought to visualize the timing of these audits in order to understand when we may begin to observe this indirect effect. So shown in red, audits begin 2 to 5 years after the baseline year, and as shown in blue, they tend to end about 3 to 6 years after the baseline year. So we hypothesize that an indirect effect will not be observed until at least 2 years have passed from the baseline year, as that aligns with when the individual is being informed of their audit. We then also wanted to look at the proportion of taxpayers filing over time within each group, with the audited group shown in blue and the not audited group shown in red for each year from baseline. So you can observe that in year 0, all individuals in our sample were non-filers. And when looking at the years leading up to baseline, specifically years -5 through -2, you can observe a difference in the proportion of taxpayers that are filing between groups. And so despite our matching efforts, that difference is likely the result of inherent differences between groups, where audited taxpayers tend to have more suspicious returns, so that could be one reason. Another cause could also be our ghost assumption, where we are assuming that all taxpayers in our sample have a filing obligation. However, in the years surrounding baseline, specifically years -2 through 2, we do observe parallel trends in their filing behavior, where the proportion of taxpayers filing in both groups decreases in the years leading up to year 0 and then increases afterwards. Considering years after a year from baseline 2, we do observe that a higher proportion of taxpayers in the audited group are filing. Okay, so moving on to our model. So to estimate the fact of filing variable, we used a linear probability model. This model was chosen because it does not require any assumptions regarding the distribution of the data and for ease of interpretability. In the future, we will employ other forms of models in order to conduct analysis on the robustness of our results. But in this model, we control for several characteristics. The audit variable captures the difference in average filing behavior across groups for all years. The year from baseline variables capture the filing behavior for each of the 13 years surrounding baseline. And then our primary regressor of interest is this interaction term between audit and year from baseline, as this is the term that captures the indirect effect of an audit, as it informs us of the relationship between an audit and each year from baseline on that individual's filing behavior. We also control for several characteristics of these taxpayers. And like I'd mentioned, our research is constrained by the availability of data on these individuals. So on this first pass through the research, our control variables were time invariant, only being sourced from the third-party reported information or the prior year return information for that individual's baseline year. We identified these characteristics from any variables that were considered significant in past non-filing literature, and we sought to control for any of the taxpayers' demographic or financial characteristics or their past filing behavior. Then tax year is also a set of fixed effects that captures the yearly fluctuations across all taxpayers. Okay, and so when looking at the results of this model, we were able to confirm the presence of an indirect effect, seeing that the audited group is 2.9 to 5.3 percentage points more likely to file in the 4 to 7 years after treatment. We did observe a negative effect in the years surrounding baseline, specifically years -1 through 2 for the audited group. And as within those years, it takes until about year 2 or after year 2 for the audited individual to be informed of their audit. So this helps inform us that there's a persistence of non-filing behavior for audited individuals around the years of non-compliance or their year from baseline year 0. And when considering the control variables, we also had several interesting findings. We controlled for the presence of several visible income sources, and we found that if those income sources were present, it did increase the taxpayer's likelihood of filing. Specifically, investment income had the strongest effect at increasing the taxpayer's likelihood of filing by 9.6 percentage points. We also found that taxpayers that reside in a state that taxes individual income increased their likelihood of filing by 17.9 percentage points. And as is consistent with past non-filing literature, we did observe a persistence of filing behavior, where taxpayers that filed a return in the year prior to baseline were in general 20.3 percentage points more likely to file. And taxpayers that were ghosts or not present in IRS records in the year prior to baseline were in general 10.7 percentage points less likely to file. Okay, so what can we make of these results? So these results support the value of audits as a tool for encouraging future filing in non-filers. Like I'd mentioned, we found that audited taxpayers were 2.9 to 5.3 percentage points more likely to file in the 4 to 7 years after treatment. We also observed that the impact of an audit on future filing peaks about 5 years after an audit and then fades 7 years after that. We wanted to compare these results to another analysis looking at the indirect effects of an IRS enforcement activity on the non-filing population. So a study conducted by DATA looked at the automated substitute for return program. And interestingly, the indirect effect of a field audit was smaller than the indirect effect of this program, about less than half that of the ASFR program. However, the automated substitute for return program looks at taxpayers that tend to have lower income and simpler returns. So that difference in estimates could be indicative of higher compliance rates in lower income populations. Additionally, I know Will Bonning had conducted a study looking at the impacts of audits across the income spectrum, finding that audits on higher income taxpayers resulted in greater revenue per dollar spent. So this does just inform us that income plays a significant role when looking at the impact of audits. All right, so that concludes the majority of this research. We have quite a variety of future research areas we want to explore going forward. It's important for us to obtain the indirect effects in terms of revenue. So we'd like to estimate the total tax model in order to obtain those dollar valued estimates. Additionally, a good majority of our audited group experienced multiple audits or within this work stream throughout the years that we were interested in. And so we would like to separate our analysis by looking at the indirect effects on taxpayers that are audited once by the SBSE field audits of non-filers, and then also looking at the indirect effects of taxpayers that are audited multiple times within this work stream. Like I mentioned, we also have this assumption that ghost taxpayers have a filing obligation. So we would like to conduct sensitivity analysis on that. Ideally, we'd like to be able to verify whether these ghosts actually have a tax liability in off-baseline years. And that would likely require using statistical models to impute their income for years they're not present within our data. And last, our analysis was constrained by the availability of third-party reported data only being available for the taxpayer's baseline year. And so ideally, we'd also like to be able to obtain a richer set of control variables that vary with time. And that would help us, or by obtaining that, we would likewise be able to obtain data for these ghosts. And that may require sourcing information from other government agencies or imputing the information using statistical models. All right, so that concludes this research, so thank you. A lot of appendix slides.
My paper is estimating the compliance response to declining audit coverage. This is joint research with some IRS colleagues and MITRE colleagues. And it begins with the observation that, at least since 2008, we have had a rather steady decline in audit coverage rates caused by decline, or certainly not increases, in IRS budgets. And that would normally be a dark cloud over tax administration, and for the most part it is. But we got to thinking that, well, maybe there's a silver lining to that dark cloud in that it might present us with a natural experiment to see if there's a compliance response to the audits. And so, for example, if you take the largest category of 1040s, you find that there is indeed a downward trend in the audit rate, but a simultaneous, somewhat upward trend in non-compliance. Well, the question is there any connection between those two? Well, maybe, maybe not. It's not clear, like that suggests, in other categories of returns, other segments of the population. And taxpayers don't necessarily form their judgments about their own probability of being audited contemporaneous with what the actual audit rate is in that year. There's probably some lag in the linkage there. But of course, also correlation doesn't mean causation, and we're really trying to find causation. There could be other IRS actions. In fact, there always are a complex set of enforcement and service kind of actions. Tax policy changes during the time could have an influence on taxpayer behavior. Societal trends may be influencing behavioral choices. So I want to talk a little bit about what's been done so far in this area. But before I do that, I wanted to define a couple terms. We've sort of used similar terms here already in this panel. One is what we would call the specific indirect effect. And that is the effect of the audit on the specific taxpayer who was audited in some subsequent years. And so both of the earlier papers here focused on that. In contrast, there's also a general, or at least we think there's a general indirect effect, which is the effect of the audit on the general population and getting signals perhaps from some kind of network or news source. But even that general effect can be defined and maybe explored in a couple of different ways. One is what I would call a demonstration study. Can we even see whether this is happening anywhere? And so these demonstration studies tend to focus on a particular population, maybe a particular kind of mechanism by which the information flows from the audit to the unaudited people. And so there are a number of studies that have taken that tack, looking, for example, at tax preparer networks, or supply chain networks, or geographic networks as avenues for the flow of information about the audits to the unaudited people. There's another type, though, that I would call a comprehensive study of indirect effects, which isn't constrained to a subset of the population, and it tends to be, in fact, explicitly agnostic about the mechanism for the information flow. Whether, it's not constrained to being a particular kind of network like among preparers. So there have been a number of studies along these lines using state panel data, zip code panel data, or even microdata. And so our approach is in its very infancy, but here's some initial results that we're getting. Our purpose is to isolate the general indirect effect on the compliance of people who are not audited in that comprehensive way, not in a more focused way. We use the National Research Program of representative audits from the entire individual taxpayer population for tax years 2006 through 2014. And how do we do that? Well, we apply econometric techniques to the micro NRP data to model the dollar amount that's misreported on the return as some function of the amount that should have been reported on that return, and things like the audit rate and other factors to control for. Now, both the misreported amount and the true amount come from the NRP audit. The audit rate that we use is not the audit rate of the NRP taxpayer, but recognizing that that taxpayer is representative of quite a large number in the population who are similarly situated, and so it's the audit rate that they collectively face on average for that year. And it's evaluated for each category of return. There are like a dozen categories I'll speak to in a minute. And so it's the audit rate faced by that the category of return that that taxpayer was in, but it's averaged over all the taxpayers that taxpayer represents. And we lag that in most of our analysis by 2 years, expecting that their perceptions will be formed roughly 2 years after IRS makes some adjustments to audit rates. Our main dependent variable, our noncompliance measure, is the net misreported amount, and it's defined in the taxpayer's favor. So if it's misreporting that reduces their tax, it's positive. And we can derive that for any single line item on the return or for any group of line items. And so for income and tax line items, it's defined as the amount that should have been reported minus what was reported. But for offsets to income or offsets to tax, it's defined the other way. It's the amount reported minus the amount that should have been reported. So for our baseline analysis, we evaluate that net misreported amount at the bottom line of the tax return, essentially, which we call tax after refundable credits, TARC. So that reflects any noncompliance that's happening anywhere in the return. It all comes down to the bottom line. And we also introduce a category of line items on returns, actually 6 different categories, and separate them by the extent to which those line item amounts are visible to the IRS. And I'll explain that in a minute. But we can establish the net misreported amount and the amount that should have been reported for each of those groups of line items. Well, if you look at the population, the IRS tends to, particularly for audit purposes, categorize returns in a dozen categories that are mutually exclusive and exhaustive. And as you can see, for all of them, particularly that top one, the audit rate was declining during that period. That top one just represents 0.3% of the population. So just zooming in a little bit on that, you can see the other ones likewise have the general trend downward in audit coverage rate. I've highlighted the ones in bold, the ones that have at least 5% of the population in them. So our baseline econometric specification is to model the log of the net misreported amount, modeled at that bottom line of the tax return, tax after refundable credits, and model that as a function of the audit rate for the activity code, the group that the taxpayer is in, the correct amount, various taxpayer controls, and fixed effects for tax year and the taxpayer group, the activity code. And what do we find? We get the surprising result that there's a positive relationship rather than a negative relationship between audit coverage and noncompliance. So it would suggest that the more you audit, the more noncompliance you're going to get. Sounds counterintuitive, right? Well, this is just a high level, essentially it's the entire population, bottom line tax, and it caused us to wonder, are there things going on under the hood for categories of taxpayers or categories of line items where they're being non-compliant. And so we did that same analysis for each category of tax return, these activity codes that IRS exam uses. And sure enough, 3 of them had significant positive relationship with audit rates, the counterintuitive result. One of them had a marginally negative relationship, which is a bit more intuitive, but most of them, it's just a mixed bag. It's nothing clear when you do this by type of return. So we looked at it by type of line item. Where is the noncompliance happening? And so there are 6 visibility categories here. The first 4 are representing income line items, where category 1 is basically it's wages. So it has very high visibility to the IRS with third-party information reporting and withholding, ranging all the way to category 4, which is the group of line items, income line items that have very little, if any, third-party information reporting to the IRS. And then category 5 is line items representing offsets to income, things like adjustments, deductions, exemptions. And then category 6 is offsets to tax. So what do we find when we analyze those groups of line items separately? Well, it's basically the same specification, except now it's the net misreported amount for the visibility group, that's our dependent variable, and then the corresponding correct amount on the right-hand side. Again, we get mixed results. For the first visibility group, we do get a negative response, very significant, but for the fourth one, we get a slightly significant positive relationship, and the other ones are kind of all the way in between. What does that tell us? Well, this is a mixed bag, and there are probably lots of things going on here. The population is not homogeneous. It'd be real nice, wouldn't it, to say you've got this and you've got that, and it's a cut and dry deal. There's a lot going on. So we did some sensitivity analyses. We asked, do taxpayers respond to a different lag in the audit rate than we were assuming? We tried a 3-year lag, 4-year lag, and we found that our bottom line estimate did reverse its sign when you used a 4-year lag, a longer ramp-up period, but it wasn't all that significant. Then we asked, do only certain taxpayers adjust certain line items? So we're breaking it down by type of return and type of line item at the same time. And we found that our expected negative effect did happen for higher income taxpayers. Another question was, do taxpayers respond to more aggregated audit rates? In other words, not just for their category of return, but possibly similarly defined categories. And that had a little bit of a response or effect, reversing some of the counterintuitive results we saw earlier. But the last question is, do taxpayers respond to spending on audits, the actual dollar amounts of IRS budget spent on audits, and as opposed to expressing it as audit rates. And interestingly, that does seem to show the more expected negative effect more often. Well, by way of summary, we're just starting this research. This is kind of fresh off the research press, if you will. We're still learning a lot. One finding is that misreporting on high visibility income seems to, the misreporting tends to drop by 3.6 to 6.1% with a 1% increase in audit rates. Not a lot else is all that clear, but for other line items, it may be that for certain taxpayers and certain line items, we do have an effect, but we're still early in trying to narrow that down. And likewise, our results are mixed on misreporting by taxpayers earning more than $200,000 who earn business income, but we're thinking part of the problem there is that that's a group that's hard to detect their extent of noncompliance anyway. And so we haven't yet corrected for noncompliance, and we're hoping maybe we can do that somehow. Non-detection, I mean. We'll see. So our next step is to disaggregate some of our definitions, our groups that we're looking at, see if there's any sensitivity there. We do want to convert our estimates to dollar values. They're more useful that way. And we've got a number of econometric extensions that have come to mind that we're still in process of executing. So that's it. I'll turn it over to Will.
All right, excited to discuss these very interesting papers. My opinions are my own and not those of the Treasury. So these are some really neat experiments. There were some commonalities in some of the challenges that they're facing. So we'll talk about those first, and then we'll go paper by paper. For a couple of the papers, it's not always clear what the bottom line is, which is totally fine for papers at an earlier stage. You know, we're kind of on this road from what we tried to what you as the reader need to know. And I think that's something to keep in mind as you advance these analyses, is to try and understand what are the things I really want to convey to the reader and then build towards that. Just sort of an advice more for the writing. I know this is something I try to do in my own papers. And then in general, I have concerns about statistical power. So theory would expect similar things for similar subgroups. If we're finding really different results for people who live in town A and town B, and they're right next to each other, probably it's not that the model of the world, you know, how people respond to audits is different in town A and town B. Probably it's noise because the power is pretty low. Sample sizes are pretty low when you're working with random audit populations, for example. One thing to keep in mind is that tests might be over-rejecting here. So you could try bootstrapping your standard errors. And you could also think about corrections for multiple hypothesis testing, especially if you're going to do multiple subgroups. Just because, you know, when you run 10 tests with a 10% rejection rate, you're going to reject one out of 10 just from noise. And finally, you know, being humble about the fact that we're in a world with low power here, you know, if you don't find an effect, it doesn't mean the effect is zero. It means we don't know, right? Like there's a lot we don't know here. So on the first paper, a big clarification question and also a piece of advice is that you start out with a randomly selected sample, but then there's a bunch of profiling, income matching, issues are reviewed, and it sounds like there may be some correspondence there, and then finally we get to the audits. And it sounds like the analysis sample is the audited returns at the end of this process, rather than the whole sample at the beginning of this process. But the beginning piece is the one that's randomly selected from the whole population, and is also the one that's comparable to the controls, right? If you took the controls and did the same funnel to them, the ones left at the bottom would look really different than the average across all the controls. So the solution to this is to just use everybody and do the averages that way. And I think you can definitely do that, and you'll probably get somewhat different results as a result. A second thing is, I think, one thing you could do, especially if you want to think about how you're positioned relative to the other papers that have been written in this literature, is what are the new things that you can speak to that other people haven't spoken to as much? And I think it's interesting to know about Australia for its own sake, but it's also interesting to know things like what's the effect of being audited on the future behavior of small corporations, for which there have been relatively few studies in other countries that I'm aware of. Another one is that the Australian tax system is kind of this neat natural experiment relative to a lot of the other countries we're used to thinking about, because it has different features than the US. And we could learn about how compliance is related to those features and whether those features are desirable or not, and probably things like pre-filling, which there's been a lot of conversations about lately. Australia can sort of talk about, well, what does the compliance pattern look like for an income item that's pre-filled? And do people like not fill in extra wages if they see that the wages amount that's been pre-filled here is only this much? And the final thought is there's a power in simplicity. So for the whole sample, it's better to pool, especially because you have so few people, right? And pooling across audit outcomes too also gets you that size, but also that comparability with the whole universe of people. As I was saying before, differences across years, there's probably noise going on there. And then the cost-benefit analysis for the audits is going to depend on the overall average, not just on whether you are compliant. So actually, the reason people have split on compliance in the past is sort of to think about confirming that the audits are driving what you're finding. But actually, you have other ways you can do that by looking at like the most common kinds of non-compliance detected and whether there are changes on those particular income items in future years. That's something that's really, it would be really neat to see. Oh, I guess I have one last comment, which is that, like in some of the other papers, it would be really nice to see year by year, because that gives us the beforehand as the placebo test. We can actually see it visually. I'm sure it looks great because you've got great random audits. And the trends over time are going to tell us how quickly the effect fades, which is something we really are really interested in this literature. And also, you can say something about the discounted return over time. Okay, on the second paper, you have a really nice, clear question and bottom line. This paper is sort of further along than the other two. But I think the place to go next is to really try to build up that contribution relative to the most similar paper by Data et al. In this area. And so what they did was automated substitute for return, which is sort of like, we send you a letter that says, hey, we think you owe this much tax. That kind of a flavor to it. And I don't know the details of that as much as I should, but actually that's somewhere the paper should fill out, because audits are a more intense treatment than that. And you're also looking at, this high income population, which you say drives most of this non-filing tax gap. Actually, you answered one of my questions, which is great. But then also, you can probably improve on their methods, and you should talk about the fact that you're improving on their methods and how you're doing that to sort of build out that contribution and say, well, here are all the other new things we're learning from this paper. My biggest concern is looking at this graph of the trends over time. If you look at the pre-period, sort of your audited group is going down and your non-audited group is going up, and that gives me a lot of concerns that what would happen if you hadn't had the audits here wouldn't be that similar. And that's just like, it really makes me very nervous. Luckily, you're in an amazing context for matching. So you don't actually do much matching. I think you do control, but really you have audits that have been selected based on a set of criteria you get to observe, right? And for non-filers, we don't have, it's not like we have a huge book of information on them. We have very limited information. You even see things like the risk scores and the amount of tax liability estimated from information returns to match on those. So you could do basically really great matching on the baseline and prior year characteristics, get some propensity scores, how likely are they to be audited based on all the characteristics we can see, and then match on those or do a similar method called inverse probability weighting. And basically then look at the trends for the years before the stuff you used for matching to make sure that those look good as a validation of your matching method. And so actually then you could sort of say, well, look, the pre-trends look really, really flat in the years before the stuff we used. Okay, so moving on to the final paper, I think this paper could benefit a lot from leaning on some theory for some guidance. Alan did a great discussion of this, but like thinking about it, it's really about the perceived probability of detection. And there are a lot of competing hypotheses for how people are reacting to changes in audit rates. Like, one story is that people are totally ignorant. Like, I could believe that for at least some people. Another is that people have a hazy, lagged idea about the change in audit rates. Like, over decades of experience from you and your friends, you sort of learn how likely people are to be audited. That lag could be decades, not just a couple years. And also, it's very hazy because you get so little information about it, right? Like, you only talk to a small number of people about whether they've been audited. People are not always like giving you a table of audit rates by year, by zip code, by income level, right? And so the perfect information world at the bottom there seems to me somewhat implausible. And some of the prior studies really leaned hard on that. If you're doing by zip code, right, you're saying that like people are knowledgeable about the audit rate in zip code A versus zip code B, and I just don't think that that's that plausible. And another related point is that the probability of detection for wages and salaries is probably driven more by changes in document matching and what kinds of information returns report those kinds of income rather than by audit rates. So if you could think about like, you know, stuff like 1099 income being an important component of long-term compliance there, and in general, like that motivates this point about, well, you know, if you're thinking about longer-term trends, then you've got to start to think about longer-term changes in technology and document matching, et cetera. So with that big picture, supposing that people have these hazy lagged perceptions, the story is sort of that audit rates have fallen a lot, and especially for very top taxpayers, right? And you find that aggregate noncompliance in the amounts has been pretty much flat. But one would expect aggregates to grow over time with population and with, you know, just the size of the economy. And so actually, like, one question I had was whether noncompliance as a percentage has actually fallen even as audit rates have fallen. And that's a hard thing to get at, but I think it's an interesting question that you're well placed to dig into. So one thing you could do is a relatively simple comparison between high-income people for whom the audit rate has been much larger. Audit rate decline has been much larger at levels, at least. In percentages, the audit rate declines are actually comparable. It's like, you know, half the audits across the board were cut, or 60% or something. But because the level was so much higher at the beginning for the high-income people, the absolute percentage has fallen a lot more. And you could maximize power by splitting into fewer groups that are more matched up to what people think about rather than activity codes. So like high income versus the rest, or even like, you know, instead of 12 activity codes, you could have 4 groups. You could have business, EITC, high income, other. I know it's hard because the activity codes mean a lot for audit rates, but actually like trying to convert them into something that means something to the reader is pretty important here. And then actually, I just have a question. I don't know what the NMP over time is for each grouping. And like even just the trends over time are very interesting here. And so like you could do a lot more to talk about those. One thing I did, inspired by having some of our Australian friends here, was I looked at some tax gap studies from various countries over time. So I just grabbed the UK, US, Canada, and some of the Australia ones and threw them on this graph. And so the US, this is 1 minus the voluntary compliance rate. So this is like roughly a measure of the percent non-compliant. And I know it's going to be hard for some people to see this because the levels are so different. But like, you know, the US level estimate matters less than the fact that the US trend over time has been towards more compliance or less non-compliance here. And if we look at all these other countries, the trends are either less non-compliance or flat. So, you know, maybe there's some story that's common across countries here rather than it being driven by whatever the change in US audit rates is. And so that motivates me into this sort of concluding slide here, which is directions for future research in this area. I think it would be great to see some cross-country studies. I think we're just starting to get to the point where we have enough things to be able to say something about relating trends over time across countries to changes in technology adoption across countries and things like e-filing and document matching. I think one piece of this literature that I always admire is that RAS has done some studies on the monetary costs of being audited, but I would love to see more surveys on what are the psychological costs to taxpayers of being audited, because everybody's story is that the audit was the worst year of my life, and I would love to know, like, okay, how bad is it really, like in dollar value? Another piece here is you could do surveys on that perceived P, right? Like the perception of audit rates, perception of changes over time, perception of changes over income. Instead of me speculating about, well, it's probably pretty hazy, you could actually bring data to bear on that question. I would love to see that. And that wraps me up. All right.
Okay, so let's take some questions here. Janet.
Okay. These are great papers. Oh, God, that sounds so weird. These are great papers, and I learned a lot, and they're all related to questions that we're all facing right now in this resource-constrained world. But my particular questions are for Alan Plumley. And I was particularly interested in the fact that you didn't just look at audit rates, you also looked at the resources and the effect, because that may be even more relevant in terms of the world in which we live. There's an element that's connected to resources and connected to audit rates, and that's the productivity of the audits. So part one of my question is, to what account could you take into account the no change? Because we've seen, particularly like with corporations in particular, but perhaps other groups, that during this period, we've seen more audits that result in the taxpayers' favor. I mean, you got the pain of the audit, but then you have the ultimate outcome, and that may be driven by the declining resources and the impact of the IRS being outgunned. The second related question is, audits are not the only thing that has declined in the enforcement world. We also saw a decline and then follow up to discrepancies in information reporting. So you see that there are fewer automated underreporting cases that reach resolution, as the declining resources have led to an increase in the threshold that triggers that. So it's twofold, taking into account unproductive audits and also taking into account other forms of enforcement that are also funded by, that also have suffered because of declining resources.
Good ideas.
Alan, let's work on that for our next paper.
Good ideas.
Okay, next. All right, go ahead.
Okay, thanks. So this is a question for India. I'm wondering if you can split, so you have these very high income non-filers, if you can split by the type of income, just at a high level, if it's like types of income that are more likely to be one time, like a large capital gain, versus other types of income like wage or labor that you might think is ongoing. So partly that's just like curiosity, if you have a sense of the relative size of those, but also relating to your assumption about future, do they have a filing requirement or not? You might have a different prediction for those two groups.
Yes, that's a great idea. And I think that's one we'll add to our list to plan to explore in the future. I know we were controlling for whether taxpayers had the presence of various income sources in their baseline year at least. So we controlled for if taxpayers had wage income versus retirement income versus investment versus the few types of self-employment income that are required to be reported to the IRS. But we didn't look at the number or the proportion of taxpayers in each sample falling into each category. And that would be interesting to explore over time, especially it would be interesting to look at the taxpayers that have wage income, because I would assume that they may be in IRS records, or they may be more present in IRS records for each year of interest that we're looking at. Like, they may be less likely to be ghosts. So that's a good point. So thank you.
Others, questions? Yes.
I have a question for Alan Partington, the Australian Alan. So one thing that, we often think about with this type of research is it's really interesting knowledge gained, what is the impact of our audits, but to then translate from that to what do we do about that information in an operational context? What are the decisions that we can make to improve our ROI on audits, et cetera? How do we use that information? So I'm curious, to the extent that you can talk to us about that, if you might share a little bit about what ATO is thinking about with this research and what you all might do with this information operationally.
Thank you for your question. I think the use to which it's put, or the degree to which we can use it, depends upon some of the questions that remain unanswered from the analysis. Sort of looking at our results, you would perhaps conclude that audits are not terribly effective at changing compliance. But the general deterrence effect we don't estimate as part of our study, and it may be reason alone to continue with an audit program that we have or expand it even. So I think until we can sort of shed more light on that effect, we'd be very cautious with making recommendations one way or the other about significant changes to what we currently do. One other thing that motivated the study was to perhaps benchmark the effectiveness of our risk-based program, so to provide some sort of baseline for determining the value add from that, which sort of supports arguments for engaging in that sort of risk-based audit activity and sort of roughly quantifies the value add from doing so. One other thing we've been doing with the results, I didn't put them in the slide deck, but we use that to also check the validity of other estimates that we make in relation to those wider revenue effects and total revenue effects that we do report on. So included in those estimates is an effect using statistical processes, and we find that we get quite different results for the random audits depending upon whether they're compared to a control or subject to the econometric estimation. So that's something that we're very keen to get a handle on as well, because we think it goes to the reliability of those estimates, and we think we can fine-tune it with this analysis.
Hi, Brian Galley, Georgetown. This is also a question for the Aussie Alan. So I was pretty surprised about the finding that non-compliant individuals comply less after audit. So I wonder if you could say more about that. I mean, certainly there's Will's concern about, this is all a selection story, and the people who get through that process of actually getting to audit are more reactant in some way, or otherwise just less likely to comply long term. So, is that your story? Do you have kind of long run effects? Is this a bomb crater effect that is only persistent for a year or two? Anything you could tell me about that population, I'd like to hear.
Yeah, what we observe is that the effect is more pronounced in the year immediately after the audit, which is sort of consistent with the literature around that bomb crater effect. What motivates the drop-off in non-compliance, we're still having a look at. Whether it's an attempt to get back to some sort of permanent income or that their expectations that we won't be back for quite some time might inform their compliance in the year or two after the audit. But yeah, it's something we're still looking at.
Okay. Yep. Go ahead.
This question goes to just some confusion in my mind about high income definition, just because I think about it more complexly sometimes about who might be a high income individual when they have upstream entities, and defining at least the context of what the high income individuals for the study, just because a lot of non-compliance may happen in an S corp or a partnership where the income is reported on a higher level entity and expenses are taken maybe improperly upstream. And just an understanding, and I don't know if it's out of scope, how to orient when looking at the study about what population it may be not addressing in terms of high income individuals.
Yeah, so in this research, I guess it's better to refer to it as higher earning individuals, because our income threshold was just individuals earning above $100,000. And so within our research, we kind of just use that as the threshold for considering a taxpayer to be part of our sample. And I think it would be interesting to explore, going forward, the number of taxpayers that fall within each higher income bracket, and see if we could do separate models for taxpayers that earn above different thresholds or in different TPI classes.
And when you mean earning, you're looking at wages, the W-2, because I'm just thinking, are you pulling in K-1s or looking upstream about what like earning. That's just where my mind is going, is the definition, and maybe it's in your paper, just wasn't crystal clear in my mind.
No, important clarification. So this is just an income that, or compensation that's being reported to the IRS. That's all that we can control for. So this includes income from wages, investment income, retirement income, various types of self-employment income, and then there's a lot of smaller income categories, such as agricultural income or fishing income. But the only income that we could consider was income that is reported by these third parties, which are like various financial institutions and entities and employers.
I maybe would add to that the focus there, of course, is non-filers, and so we don't have a return to work with. We could construct a pseudo return, perhaps, but when those taxpayers were audited, they're probably closer. I mean, the auditors are looking at more than just the W-2s and 1099s, and so. But they're classified by what's, the kinds of income that India talked about.
Alan, if I could, let me see if I can get to maybe what's at the heart of the question here. K-1s, are there K-1s that you're able to identify associated with non-filers? And how does that factor in? I think that was kind of at the heart of the question.
Yeah, we should be able to, but I don't know that we have. Yeah.
And I think the majority of like non-filers in our study did have some income from K-1s. And so, yeah, I think the IRS is able to identify K-1 income, and I think that capability has been increasing over the past few years.
Okay, we're about out of time here. I'd like to thank the presenters and our discussant and everybody for the questions.
To introduce one of my favorite columnists, Catherine Rampal. Catherine is an opinion columnist for the Washington Post, where she covers economics, public policy, immigration, and politics, with a special emphasis on data-driven journalism. And recently, she's written a number of pieces on the tax system and compliance. She's also a commentator on CNN, a special correspondent for PBS NewsHour, and a contributor to Marketplace. Before joining the Post, she wrote about economics and theater for the New York Times. She's won many awards, and I'm sure you'll find her presentation interesting. So, thank you, Catherine.
Thanks so much for that lovely introduction. Whenever I speak before a tax crowd, I always like to specify you are my people, quite literally, because I come from a long line of accountants. My dad was a CPA, my mom was a CPA, my grandfather was a CPA, my grandmother was a bookkeeper, if that counts, and my uncle is sort of a tax attorney. So in any event, I feel like it's somewhat in my blood, and I love writing about taxes. I write about a lot of other kinds of things too, including immigration policy, as you just heard, budgets more generally, safety nets, various other kinds of economic public policy issues. And I'm often asked how I choose the kinds of topics that I write about, because I do have a lot of freedom in my job as a columnist. And I think my usual response is something like, I tend to gravitate towards areas that present a lot of complex issues where I think journalists can add value by helping explain things. And unfortunately, well, fortunately or unfortunately, there are a lot of those kinds of areas right now. And there are, tons of government policies and procedures that are needlessly complex. And one of my most deeply held beliefs, I think, as a journalist and as a citizen, is that complexity tends to reward demagogues. Right? The more non-transparent a policy is, the easier it is to lie about or to misconstrue in some respect. And I think that's often true of tax policy, for better or for worse. Certainly gives me plenty to write about. So I am going to talk a little bit today about things that lots of people get wrong, including myself, particularly when it comes to tax issues. I say everyone is wrong about taxes. I'm sure that doesn't apply to this audience, but, just for the sake of argument. So as I'm sure you are well aware, Americans have very strong, often very wrong views about how the tax code works or doesn't work. And some of that is born from genuine confusion, and some of that is born from the narratives that they hear from politicians, from journalists, and others. And some things are genuinely tricky, right? Like explaining baselines to my readers is the bane of my existence. It is so difficult to explain without having a chalkboard behind me, which obviously I do not have the luxury of doing when I'm writing for a newspaper. But baselines, counterfactuals, very counterintuitive, or at least not, I would say not intuitive to understand. And I think it's reasonable that people have legitimate levels of confusion about how those work. And those are, understanding baselines is obviously relevant to understanding whether policy has delivered on the objectives that politicians have laid out and how voters respond to that. So things like, if tax revenues rose after a tax cut, does that mean that the tax cut led to the higher revenues? Or for that matter, did it lead to them for the reasons that were laid out by the advocates of those tax cuts, i.e. sort of supply side things as opposed to demand side explanations? And it's very hard to explain that to the public, like what would have happened in the absence of a policy. So I get why people might be confused, and look, I think reasonable people can make different assumptions about questions like that as well. Then there are other things that are, I think, a little bit sillier that are less forgivable that people, or especially people in my business, journalists, get wrong. So things like The complexity of the tax code is about the number of tax brackets we have, as opposed to how difficult it is to define income. Like I get emails all the time from readers saying, like, the tax code is so complicated. Why don't we just have a flat tax? And I'm like, okay, we could have a flat tax. We could have one bracket, but what's income? And it's hard to have those kinds of discussions. And then there are other silly things like people don't really understand how marginal tax rates work in general. They think, I have seen this mistake made by journalists, that they think that when you hit a particular level of income, it's not the marginal dollar that gets the marginal tax rate, the higher tax rate, but like your entire income. So like every year around tax time, you see these stories about like people trying to avoid making whatever the, $250,000 or whatever the ceiling is because they're afraid that their taxes are going to go up on all of the dollars that came before that. And then there are other kinds of issues that I think people tend to get wrong, in part because there are vested political interests in people misunderstanding them. So that might be things like whether the TCJA only benefited the rich. So it is true, if you look at the Tax Policy Center's data, in fact, and I cite it all the time, that the 2017 tax bill was heavily weighted toward higher income people, but almost everybody got a tax cut, and most Americans do not understand this. And I think that's partly because, the tax code is very non-transparent. There are a lot of moving parts, and those moving parts interact in different ways, and they determine how your tax bill changes by the end of the year. So you end up seeing people say, well, I think that, my taxes must have gone up because my refund shrank. No. Or, a lot of people think that because they're no longer deducting the full amount of their state and local tax, that must mean by itself that their taxes went up. And in fact, another frequently cited Tax Policy Center report that I often use, I don't know if this looks familiar or if anybody in this room is actually responsible for creating this, but basically it shows that even in like the deep blue states, the more democratic high tax states, a very small subset of the population actually paid higher taxes on net, even when you account for the fact that they can't deduct their full SALT because, again, rates went down, et cetera, et cetera. And the state with the highest share of people who saw a net tax increase, so again, once you take into account all of the different things that happen in the TCJA, was New Jersey, where only 10% of people saw their taxes go up. But if you've met anyone from New Jersey, they all unilaterally think that their taxes rose, right? So there's this misperception that's partly born of the complexity of the tax code, partly born of the narratives that get cast upon it. And more broadly, one of the things that I have been trying to focus on in my writing that I think affects how people interpret the tax system as well as what they demand of their political leaders and how this filters into electoral decisions is this idea of whether or not we are a high tax nation and whether or not the tax burden is too high relative to the services that Americans themselves consume. And this seems like, it should be a relatively simple question, and it's not. Objectively speaking, I would say that we are not a high tax nation relative to other OECD countries, for example. But then there's this question about whether people have already paid enough into the system to account for what they're taking out of it. I get emails all the time from people, whenever I write about Medicare, for example, saying I paid for my Medicare. Now, I don't think Gene Sterling is here, but he puts out this annual report is he here? No. He puts out this annual report with some colleagues at Urban that basically shows on average, for people at different points in the income distribution, how much they pay into Medicare and Social Security and how much they are expected to take out, even when you account for, the time value of money and all sorts of other things, how they could have alternatively invested their payroll tax dollars. And the Medicare numbers will blow your mind, that people consume much more in healthcare than they pay into the system and have no idea about any of that. Again, that's partly because the tax system is not transparent, and that's also obviously because the healthcare system is not particularly transparent. And I think part of the reason, additionally, is that for many years, conservative politicians have made the argument that tax cuts are too high and they need to come down. To some extent, they said, taxes are too high and they need to come down. To some extent, they've also said that spending is too high, but lately they've been less committed to that particular principle. But I think that there was really a change around the 80s when Republicans sort of anointed themselves as the tax cut Santa, whereas Democrats were the spending Santa. I don't know if any of you know this famous Wall Street Journal op-ed in the 80s, but it basically talked about, it was by this guy Jude Wininski, basically said that Republicans needed to stop demanding fiscal responsibility all the time and reward voters with tax cuts the same way that Democrats were rewarding voters with spending. And I think it used to be the case until relatively recently that Democrats, in service of arguing for a broader social safety net, also made the case for higher taxes. Taxes being the price we pay for civilization, as the saying goes. And that has changed. Certainly it's changed over the course of my career as a journalist, and I've been doing this for 15 years, let's say. It feels like in more recent years, Democrats have been sort of conceding the argument that most Americans are overtaxed, as they are. They still deserve more services, but they are currently overtaxed. And the only people who deserve to or who can afford to pay higher taxes are, quote unquote, the wealthy, which turns out to be a vanishingly small slice of the population that gets redefined higher and higher and higher in terms of where it is in the income distribution. Obama said that the only people who could afford to pay higher taxes or who should pay higher taxes were those earning over $250,000. Biden said over $400,000. More recently, I don't know if any of you remember this very glamorous dress from the Met Gala a couple of years ago. Representative Alexandria Ocasio-Cortez wore this dress that said "tax the rich." She was subsequently asked about what she meant by rich people, and she said that she meant, people with, quote, hundreds of millions of dollars, if not billions of dollars, unquote, not, quote, a doctor or a lawyer, unquote, who are, I'm sorry to say, objectively speaking, at the higher end of the income distribution. If we're talking about high-income people, they are certainly in the U.S. and in the world, maybe not as rich as some of their neighbors who run hedge funds, but they're still high income. And I have different theories about why this might be, that Democrats seem to have sort of conceded the issue and stopped making the case for higher taxes more broadly. Again, I think it's partly about this sort of bombardment of anti-tax messaging from conservatives. I think it's also partly that the Democratic voter base has changed quite a bit in the last few decades to become more highly educated, higher income, people who don't necessarily want to think of themselves as rich. Their neighbors who are the hedge fund partners, they're the rich ones. I'm a lawyer. Or whatever, doctor, accountant, some other professional class person. I'm, comfortable, but I'm not rich. And when I have argued with, gently, people in the Biden administration about this pledge that has been made about $400,000 being the threshold for rich, which is, depending on what definition of income you use, usually around the top 5% or top 2% of the income distribution, these members of the administration, who shall remain nameless, basically counter that they have no choice, that you can't win elections by telling people that their taxes are too low. You have to tell them that they are overtaxed. And my view is, I get that. You don't want to tell people, boo-hoo, you're not paying enough. But I think if you're making the case for essentially more of a European-style welfare state, you need to make the case also for a European-style tax system, whether that's a VAT or otherwise, to help pay for it. And now that there is relative unanimity among the political parties that the public is overtaxed, unsurprisingly, the public increasingly thinks that they are overtaxed. Now, I can't say for sure in which direction causality runs, but I think because there has been no pushback to this narrative that Americans are not paying enough taxes to sustain the size of the welfare state that we have now, it is probably unsurprising that Gallup, in its most recent poll, finds that the highest share of Americans in about 2 decades think that their own taxes are too high. That's, I don't know if you can see this, but it's the green line at the top. So about 60% of Americans now say that their taxes are too high. And if this is not an outlier, Pew has also asked similar questions, slightly different wording over time. And by the way, you know, people's tax burdens have generally been falling in this period, in these recent years, particularly in 2020, 2021, because there were a lot of temporary pandemic era tax-related policies like the stimulus payments, which were technically tax cuts. But anyway, so Pew has a similar poll where they asked people pay more than their fair share, less than their fair share, about their fair share of about the right amount of taxes. And I asked them to break it down for me by demographics. So again, I hope this is legible to you, but even about half of Democrats now say that they are paying more than their fair share of taxes. So I think these kinds of narratives do matter. And it is true for views of the tax burden today, as well as in the past, that people really mediate their views of the tax code, their views of their own tax liabilities through these narratives that they hear. So again, this is not entirely a new phenomenon. For example, if you look back at the tax cuts that took place during the Obama era, which Americans do not remember, and certainly didn't notice at the time, here's an article from 2010 where people were asked, do you think the Obama administration has increased taxes for most Americans, decreased them, or kept them the same? And the administration actually had cut taxes. This was part of the response to the economic crisis, the Great Recession and the financial crisis. Only 12% knew that taxes had been lowered. About double that said that they had been raised. So, you know, again, what happens in the real world is sometimes different from people's perception, in part because the tax code is so opaque. And it wasn't true only for Obama. This was 2004, Bush. Very similar poll. Only about 1 in 5 people said that their own tax burden had been reduced under George W. Bush, and that was like part of his whole shtick, right? was cutting taxes. But there was a broader pushback to that narrative that it was only going to rich people, and again, disproportionately to higher income people, but not exclusively to them. But that's how people saw it. And it has been argued to me that maybe there is an asymmetry here, that maybe people would notice more if their taxes go up than if they go down. I'm not aware of any research on that, but if those in the audience are working on it, tell me, because I'd love to see it. I think we don't know for sure, in part because, again, people don't really understand what's happening to their tax burden over time. And I think there's also an open question of whom Americans would blame if, in fact, they notice that their taxes are going up and they are actually going up. Certainly, the Biden administration has made the calculation that Democrats are going to be blamed no matter what. And I think that partly explains their decision to interpret that pledge that I talked about, that no tax increases for people making under $400,000, to apply to the current policy baseline as opposed to current law baseline, by which I mean there had been some debate within the administration about whether to support an extension of the the TCJA tax cuts, which are set to expire in a couple of years, less than a couple of years, I guess, at this point. Would the expiration of a tax cut be the equivalent of a tax increase? And I know that there are probably people in this room who are pushing for the administration to say no, like that, we are not considering that a tax increase. We are going to allow those tax cuts to lapse. They ultimately decided against that in their budget this year. They said that they are in favor of extending the Trump tax cuts for, the bottom, whatever it is, 95% of the income distribution, even though no Democrats were in support of that when it passed, as you may recall. But that's the way that they've staked out the issue for themselves, I guess, because they believe that's how the politics would play out, that they would get blamed if the Trump tax cuts lapsed and taxes rose. So in any event, a lot of what I do, as you can tell, is sort of explain. I write an opinion column, but it's sort of explanatory. I'm trying to push back against what I view as false or at least confused narratives, who's actually upper income, whether people have already paid for their benefits that they might be receiving, whether tax cuts pay for themselves. And lately, as Eric mentioned, I have been really interested in compliance issues, that even if tax cuts don't fully pay for themselves, tax audits might. And in fact, they might more than pay for themselves. So this was a fun piece that I did last week based on the research of a group of economists, one of whom may be here. I don't know if... Hi! We haven't met because he's not allowed to talk to the press. But I've talked with your co-authors, looking at some very cool data. Are you presenting it here? Okay, not today. Well, it's awesome. You all should check it out. But basically, he and his co-authors looked at internal accounting data from the IRS to see how much it costs to conduct audits for various kinds of taxpayers. When you account for the wages paid to the IRS employees, how many hours it takes, the overhead costs, et cetera, and then how much money comes back in return. So this was one of the charts we put together based on that work. That basically shows that for the bottom half of the income distribution, the IRS only about breaks even in terms of how much money it gets back from the initial, from whatever's recovered from the audit relative to how much it costs to conduct the audit. Whereas at the very top of the income distribution, it's like 6-to-1. And then that doesn't take into account deterrence effects. I think there was a paper presented today on deterrence, maybe, or will be. And that shows even higher bang for the buck. And then additionally, there's also been this long debate about the marginal dollar of spending for tax enforcement. Does that have more or less bang for the buck than the average dollar? Because maybe the IRS has already gone after the really high-value audits, and whatever's been left on the cutting room floor is less valuable, or less likely to have a high ROI. And in fact, they do not find evidence of diminishing marginal returns. They show that because of the cost structure, because most of the costs are fixed, and because the IRS has not been sort of maximizing revenue in terms of who it's auditing, that's not the case. So anyway, I find that kind of research super interesting, and a lot of it is somewhat counterintuitive, and I think readers are really into it. Not to mention that other kinds of investments in the IRS can also pay off, including things like investing in better IT and customer service, another thing that I love writing about. I don't know if there's any evidence about how that affects voluntary compliance rates, but I'd love to see it if there is, because that would be interesting to write about. But at the very least, it does seem like processing returns more quickly is a valuable thing to taxpayers, and in terms of getting money into the government's coffers faster. That's helpful. I took a little field trip to the IRS, to a processing center last summer, where I got to see the cafeteria. This is the cafeteria. Because the agency was so backlogged with paper returns, partly because their IT is bad, that factor colliding with the pandemic, disrupting operations. They just had every square inch of this processing center in Austin was just covered with paper, and this was their cafeteria. I am told that the cafeteria has happily returned to its state as a cafeteria, and the papers are gone, the stacks of papers are gone. But it was still kind of wild to see. And I also got to see some of what the IT system looked like pre-investment from the Inflation Reduction Act last year, including the fact that they did not have scanning technology. And instead, I don't know if you can tell, but this is an IRS employee who is manually typing in digit by digit the materials from a paper tax return into the computer system because they did not have a way to scan it. They have since bought scanners, so that's very exciting. We've joined the late 20th century, finally. And then there are a bunch of other improvements that have happened already, even though we're relatively early in the period of this reinvestment in the IRS. The agency was able to answer literally millions more phone calls this year than it did last year, cut down on its long waiting times from, I think, an average of 27 minutes in 2022 to 4 minutes this year. And these triumphs are the result of getting more resources. And one of my favorite things to write about is investing in administrative capacity, and I think the IRS is a great example of why better government is not necessarily cheaper government, that you need to actually have the basic infrastructure to get stuff done. Then I think, so here I'm getting to like the stuff that I think I've gotten wrong, or that I'm working to do better on, I'll put it that way. I think there's an untold story that I have been trying to figure out how to write on how investing in enforcement can also improve the customer experience, which is sort of, I think, not an intuitive narrative for most taxpayers. I think among the biggest mistakes that the administration made, and those of us who were supporting more funding for the IRS made, was not sufficiently explaining how better enforcement is actually, how stronger enforcement or more sophisticated enforcement is actually good for taxpayers, as opposed to just being more likely to harass people. And, there had been a lot of focus in my own work. I did this, others as well, talked about how, cracking down on tax cheats, et cetera. I think that fed into this narrative about the 87,000 gun-toting IRS agents who were going to, knock down Joe the plumber's door or whatever and, and seize everything, all of his hard-earned income, even when he was honest. It fed into that narrative. And it's very hard to convince people, like, no, they're not going to go after you. They're going to go after these other people. And frankly, I have asked the agency repeatedly, like, so how do you actually determine how this is going to work? And I don't, how you're going to direct these dollars. And I don't always get a satisfactory answer that I can, at least that I understand well enough to be able to explain to my readers. And so I think that subsequent to the focus on the crackdown on tax cheats narrative, there had been the Biden administration, Democrats, and others had sort of switched to talking more about the service elements of the investment, the IRA investment in the agency, and less about the enforcement element. But again, I think that they are related in that better enforcement in the long run protects against tax rates rising, right? Because if you're collecting more of the tax liabilities that are already owed, then you don't have to make up the shortfall by raising tax rates on the people who are already paying the correct amount, as we have seen happen in lots of other countries where tax morale is worse and there's more rampant tax cheating. But the other thing is that if you invest in better enforcement capacity and better IT, and you can better target whom you audit, you can leave the people who are paying their taxes honestly and correctly alone. And I think this is part of the reason why Americans are so skeptical about the way that these dollars will be used, because, like, if you look at the percent of audits that result in no change, and I think this might be your chart, yes. It's quite high, and it's been quite high. Like about 10% of audits don't result in any in any change in the taxes owed. So if you get better data, if you make partnership returns auditable, digitized and accessible not only by manual combing through of the returns, but like have a system where you can search things and maybe someday you use AI to figure out, this is like science fiction, I realize, given the state of the IT right now, but you could use AI to figure out like what are the actual red flags that are more useful for selecting whom to audit. I think that's a good story to tell. It's a complicated story to tell, but it's a good story to tell to taxpayers. And in fact, I think there is a universe in which better IT doesn't necessarily result in more audits, but fewer ones, right? And yet still more money being collected because the agency is focusing its resources where they are most likely to pay off. And not taking honest taxpayers, people paying their taxes correctly anyway, dragging them into this auditing dragnet. But right now, we're not there. And so I think the rhetoric on these kinds of policy initiatives has distorted the goals somewhat. And again, I'm partly to blame for this, I think, because I've been talking so much about cracking down on tax cheats and doing more audits as opposed to smarter audits. And I think you end up with more support for kind of punitively oriented measures, both in tax enforcement and the design of taxes themselves. I think that's part of the reason you see a lot of public support for windfall taxes, for example. It's the idea that, taxes are not necessarily about raising revenue efficiently or correcting for market failures. It's about like getting payback from either individuals or companies that you think are making too much money. And I think that that's a bad place for our discourse to be moving. It's true not just for taxes. I think there's a lot of more punitively oriented policy discussion as opposed to problem-fixing policy discussion that I find somewhat distressing. And the goal should be about, again, raising revenue efficiently to fund the size of the government we want, not about punishment for punishment's sake, because we're resentful about people making money. Find ways to get the money we need as fairly as possible, however we define. Anyway, those are my comments. I'm happy to take questions if folks have any. I'm not aware offhand of poll data on the recent debt limit bill, if that's what you're referring to, where there was a deal, or there was some language in the bill and then some side deals about rescinding money from the IRS. I'm not aware of anything on that. It may exist. My recollection is that when the IRA, the Inflation Reduction Act, was passed, I believe when there was polling done about the different elements of the bill, so like tax credits for electric vehicles and the prescription drug negotiation, prescription price negotiations and things like that, those things were relatively popular and the funding for the IRS was not. But I'd have to go back and check to confirm. It would not surprise me, particularly given the rhetoric.
You started out by saying that a lot of Democrats don't think they're among the rich. Do you have any polling data that they're changing their mind?
I think I have looked into this before, but let me get back to you on that because I don't want to make something up. But I think if you look at the demographics of the Democratic Party, they have certainly changed. People. It used to be that the party relied more on, the shorthand is like non-college whites, right? And though that contingent has become more Republican, And those are people, I'm sure, who would not consider themselves high income. It is the case that over time, very few Americans consider themselves high income. So it's just a matter of which party that they're voting for. Like, everybody thinks they're middle class. It's another one of my favorite hobby horses, is to like see what is middle class, and it's whatever I am, and you know, anybody richer than me is not. Dan?
Press the button.
Okay. Assuming that Biden wins the primary and there's some Republican candidate who emerges, do you anticipate any discussion of taxes in the coming election year? Let me rephrase it. Any good discussion?
Any
of
good
taxes?
discussion.
A bad discussion, but any mention of it.
Well, good and bad, I guess, are in the eye of the beholder. I can tell you that I think that the Biden administration has absolutely committed itself to, we will not raise taxes. We will assume away any fiscal problems that currently exist, and certainly that would come from expanding the safety net. And we will say that it can all be paid for by taxing the rich, whatever that means. Now, again, if you look at their budgets, like when I was saying that I don't know if I mentioned this, but when the Biden administration said that it acknowledged that it planned to support extending the Trump tax cuts, they did not account for the cost of that in their budget estimates. I don't know if I already mentioned that. So I think the discourse is not likely to be great. The one area in which I am somewhat hopeful, and maybe I'm wish casting here, is on the child tax credit. So the child tax credit has historically been supported by both parties. Expansions of it have been supported by both parties over the years. There was a major expansion of it, as you all may recall, in 2021 as part of the American Rescue Plan. It became a monthly allotment, and it was fully refundable. It was much larger. There were aspects of that that I'm very supportive of, including making it available to the lowest income families. I don't know that families making $400,000 need to get a bigger tax cut, but that was the version that went through. There has been periodic discussion, as you probably know, in the last couple of years about reviving some version of that. Now, the devil's in the details. Oops. Sorry, it's rebelling against me. So I don't know. But I hope that there is a version of that that could be revived, that Republicans and Democrats could get behind.
Yeah, you had pointed out earlier that the complexity of the tax code is not really derived from the multiple tax brackets and so on. But it turns out that does greatly harm, or at least make more complex, withholding, particularly for multiple incomes and this kind of thing. It makes it really complicated, even though it's a fairly simple concept. So, food for thought.
That's fair, but I don't think that's the main reason why the tax code is complex and why it takes people so many hours to prepare their taxes every year.
Did you write about the underfunding of Social Security and Medicare, and did you give your own prescription?
I have written about that periodically over the years. I'm trying to remember what I've said about my own prescriptions. I have sort of a mixed bag of views. I think it is unhelpful that both parties at this point seem to be dismissing the idea to some extent that there's a problem at all. Initially, it looked like Republicans were going to lead the charge to do something about entitlement reform. Democrats opposed it. You may recall at the State of the Union, Biden said they all want to cut Social Security and Medicare, and then the Republicans booed, or, had some kind of some kind of reaction, and he said, okay, so we all agree we're not going to do that. And the consensus seems to have been that nothing needs to change. If you look at the Republican Study Committee report that just came out of the House, they do say that some things need to change. I think it's probably going to be a combination of taxes and spending fixes, like increasing the wage base for Social Security, I think is a kind of a no-brainer. Some of the other things I think are going to be trickier to figure out, like raising the retirement age or curbing benefits or making them more progressive or what have you. And I don't know exactly where I come down on that. It's a really hard issue. All right, we have time for one more question. Yes.
So I'll change the topic a little bit. I think we're all interested in this room in taxes, obviously, but I'm wondering if you have any tips. We want to get our research out. I think all of us would love for more people to write about taxes. Do you have any tips for us as academics, people doing research, to kind of better inform and get better opinions out to the media or, reporters who maybe don't have a family tree laden with debits and credits to, write about taxes in kind of a smart and informed way?
Obviously, reaching out to journalists is helpful. There are a few journalists who cover taxes full-time. I mean, as I said, I do not cover taxes full-time, but there are some people who are really excellent. Rich Rubin is great. I think he's like an invaluable reporter on these issues. So making connections with those people is useful. Now, the thing that I think a lot of academics are not as good about understanding is how to put their research in the context of ongoing policy debates, or in the journalism business we call it a news peg. Like, what is the news relevance to your research? And pitching your work in that context, I think, is much more likely to get coverage. So even when I wrote about the policy impacts research on audit rates, I found out about that months ago because one of the co-authors had presented a version of it at the American Economic Association, and it was super interesting. And I could have found like almost any news peg, but I ended up writing about it in the context of this debt limit bill. This debt limit agreement just passed. How much does it cost? Which was not directly addressed in the research, but that was like a nice hook for talking about it. So thinking about those kinds of things, I think, will be useful. All right, thanks, everyone. Appreciate your questions.
All right, good afternoon, everyone. We're going to go ahead and get started. My name is Russell James, and I will be the moderator for session 3. This afternoon's session will focus on understanding contemporary taxpayers. We have a dynamic presentation for you guys today and outstanding speakers. Our topics are in the form of questions today, and what we're going to do is chase those questions with the presentation. You'll find the answers from there. So at this time, I'll go ahead and present the presenters. We have Emily Lynn, who are married, filing separately, and why should we care? We have Carlos Scantizini, willing but unable to pay, the role of gender in tax compliance. And then finally, we have Tyler Menzar, who sells cryptocurrency. And then last but not least, we have my colleague from the IRS, Yang Sun, who's going to be the discussant for today. So at this time, we'll go ahead and turn it over to Emily to start us off. Thank you guys so much.
Thank you for having me. The paper I'm going to present today is a joint work with my Treasury colleague, Navodia Samarakun. In this paper, we investigated an understudied topic in federal income tax. Specifically, we analyzed returns claiming married filing separately status and examined the associated tax issues. The usual disclaimer and disclosure review apply to the paper and to today's presentation. So married individuals can choose between filing jointly and separately. And we know that filing separately generally leads to a higher federal income tax liabilities. However, probably because there is no single formula or condition to determine when to file separately, the extent and the magnitude of the tax disadvantage associated with this filing status is not well known. Many online posts are available to inform taxpayers when it makes sense to file separately. IRS, on the other hand, advises taxpayers to calculate tax both ways and pick the filing status that gives you the lower liability. But the reality is that very few returns were filed as married filing separately. In tax year 2020, 2.4% of federal income tax returns were married filing separately or MFS returns, compared to 34% of joint returns, married filing jointly. If we count each joint return as filed by two taxpayers, then 3.4% of married filers file separately in tax year 2020. So although MFS filers make a very small share of total taxpayers, as you will find out in this presentation, the filing status is associated with some complexity, equity, and compliance issues worth our attention. Let's begin understanding this filing status a little bit. So of course, this filing status can only be used by married individuals. And married status is determined based on the individual status on the last day of the tax year. For the vast majority of taxpayers, this rule or definition is very easy to understand and straightforward to apply. But for individuals going through a divorce or a separation, it may require a closer look at the definition to determine the appropriate filing status. So under the tax code, specific court actions are needed for an individual to be legally separated for tax purpose. Maybe contrary to some common sense, some legally binding agreements or certain court document does not count. And the law also provides an exception for married person to be considered unmarried when the so-called abandoned spouse rules are met. So the rules apply to married individuals who have qualifying children who pay for more than half the cost of maintaining the household in which they live with their children. And the spouse is not the member of the household during the last 6 months of the tax years. When all of these rules are met, the taxpayer can claim the head of household even though they are married. Many tax provisions contribute to the unfavorable tax treatment of MFS status. First off, the length of a tax brackets for MFS status are half of those for the joint status. So as far as the brackets are concerned, filing jointly will never result in the higher federal income tax liability than filing separately. And also, MFS filers have limited eligibility for tax credits. They cannot claim the education credits or adoption credit, and they are only eligible for the earned income tax credit and premium tax credit under very specific conditions. MS filers also face restrictions with respect to their claims of exclusions and deductions. And all this rule together also makes MFS filers less disadvantageous relative to single or head of household filer, all else equal, but for the marital status. So if this status is so unfavorable, why do taxpayers still use it? In limited situations, filing separately can actually reduce a couple's tax liability. This occurs when a spouse has low income but significant itemized deduction that is subject to an income flow. So in this case, the couple may be able to claim a higher amount of itemized deduction and reduce their liability on the separately filed return. There are other tax reasons related to a non-resident spouse, or when the couple could have a lower federal and state liability combined by filing separate returns. And our paper focused on only the federal income tax. Also, according to our review of online posts, married person may consider filing separately for other reasons despite having a higher tax liability. For example, filing jointly may not be an option in the case of domestic abuse or spousal abandonment, or can be difficult for those in a prolonged separation. Some married individuals may want to protect themselves from being liable for the spouse tax debt or a spouse refund offset, so they file separately. And also, couples may simply want to keep financially independent, so they file separate returns. It is also uncommon for tax professionals to advise couples in the process of divorce to file separately so that they may avoid the hassle of potential audits on their previously filed joint return after they get divorced. And finally, if the couple has large student loan expenses subject to an income-based repayment plan, filing separately might reduce the payment. So in the past decade, there has been gradual but slow increase in the relative and absolute presence of MFS returns. But the share of returns following this status is still very small. As I mentioned earlier, in 2020, less than 3% of federal income tax returns were MFS returns filed by just under 4 million taxpayers. Probably because of the assorted reasons why taxpayer chose to file as MFS. MS filers' income is quite diverse. Compared to other filers, MFS filers are slightly overrepresented in the middle income ranges, but a non-trivial proportion have income below $30,000 or above $100,000. MS filers are also diverse in terms of the duration for how long they claim this filing status. So in this analysis, we pulled the population of MFS returns filed for tax years between 2013 and 2021, resulting in nearly 32 million returns filed by 13.4 million unique taxpayers. We found that over this 9-year period, of those who ever claimed this filing status, half of them used it for just 1 year. 80% use it for no more than 3 years, and 5% use it for more than 6 years. And the estimated duration gets a bit longer if we account for the left censored or right censored data. Censoring means that some observation in our sample actually begin or continue outside our observation window. So for example, in our file, We have taxpayers who began filing separately before 2013 or continue filing separately after 2021, and we can adjust for that in a duration model. So when the model accounts for this data censoring, of course, as expected, we get more longer spells of MFS claims, but the diverse patterns remain. Still, half of MFS claims end after just 1 year. More than 70% end after 3 years, and 12% last after 8 years. So on an MFS return, taxpayer is asked to enter the spouse's TIN or taxpayer identification number. So in principle, we could match the two spouses' MFS return and then calculate the potential joint liability had the couple filed jointly. However, in our file, we have 17% of MFS returns have missing TIN, spouse's TIN, and 11% have spouses filing a non-MFS return. So for the rest of the 72% of MFS returns in our file, we could identify the spouse's return, or when the spouse is non-filer, we assume the income is 0. And then we could simulate the joint return at a couple level and compare it with the combined liability on the two MFS returns to determine whether the taxpayer has a separate filing penalty or separate filing bonus. We use the $5 as the threshold, so the tax difference needs to be over $5 in order to be considered penalty or bonus. And this slide shows the simulation outcome. 63% of the MFS filers in our calculation have separate filing penalty, meaning that they pay more by filing separately than filing jointly. The average amount is $22,600. About a quarter of MFS filers would pay the same federal income tax between filing separately and filing jointly. And it should read 13.3. About 13% of MS filers have separate filing bonus with an average of $1,130, meaning that they pay less by filing separately than filing jointly. So the majority of taxpayers claiming this filing status actually pay more by doing so. Even when there is a tax benefit to do so, the tax bonus is modest on average. So next, we associate the penalty and bonus status with the taxpayer and return characteristics. We found that the bonus status is associated with itemized deduction, the taxpayer income, and taxpayer age. And the penalty status is associated with a receipt of EITC on the joint returns. MS filers generally cannot claim the EITC except for very limited situations that were only made possible under the American Rescue Plan Act of 2021. So as you can see from the table, 15% of MFS filers who have a separate filing penalty would claim the EITC on the joint return, and this percentage is much higher than the other filers who do not have the separate filing penalty. We then link the separate filing penalty to the decision to claim this filing status. We model the decision on whether an MFS filer chooses to continue to file separately, given that they have claimed this filing status for a certain number of years. So the terminology for this probability is the survival rate or survival probability at time t. We estimated the survival probability by income quintile. In general, the higher the taxpayer income, the more likely that the taxpayer will continue filing jointly. And when you compare the two charts side by side, given income, you could see that having the separate filing penalty significantly reduced the survival rate at any given time, meaning that taxpayers are more likely to shift to another filing status when they have the separate filing penalty. I want to emphasize that this result is a correlation, not necessarily causation. It is possible that taxpayers who use this filing status for a very short time or temporarily tend to be those who are more likely to have the separate filing penalty. However, it is also possible that in the absence of this penalty, taxpayers may be encouraged or have the incentive to continue using it. So what are the tax issues associated with this filing status? As I mentioned earlier, taxpayers going through a divorce or separation may have the living situation or circumstances similar to those of an unmarried person. However, they cannot file as unmarried if they don't have the required core actions or they do not meet the abandoned spouse rules. This leads to the equity concern for several reasons. Low-income taxpayers may not have the resources to get the tax advice on the appropriate and the most favorable filing status, or the resources to obtain the required core action to get the legal separation. And for those who receive outside support, it may be difficult for them to meet the household maintenance test in order to qualify for abandoned spouse rules. MFS filers were only eligible for the EITC and premium tax credits under very limited condition, with rules that are not verifiable by the IRS. These rules are about living arrangements, separation agreements, or separation duration, or even the condition of the spouse's relationship. So this certainly would lead to difficulty for targeted outreach, education, and enforcement for the IRS. And another tax administrative challenge is about the compliance with filing status. Individuals going through a separation or divorce are susceptible to making filing status errors. Analyzing the audit data in the IRS National Research Program, we found that about 1.7% of returns claim the MFS status between 2006 and 2014 each year. However, the audit result determined that 2.7% of returns should have used this filing status. So while there only a small number of taxpayers were affected, the net misreporting rate is quite high. To conclude, I think the concerns raised in this paper about increasing awareness for credit eligibility and providing assistance to taxpayers in determining correct filing status have broad implication for low-income population. Your thoughts and suggestions on the paper, as well as the administrative strategies in this regard, are welcome. Thank you.
Okay. Thanks for the invitation. It's a pleasure being here. I had the opportunity to present another paper with Andrea a few years ago that, got published very well. So I hope that, this is a pattern. I work at the Inter-American Development Bank. Some blogs from here. As a employee of an international organization, I have a non-resident status, so I'm one of those people filing, MFS that Emily was mentioning. I have been doing that for more than 20 years. So, I'm one of those long-lasting people in the tail of the distribution. So let me tell you a little bit about the paper. This is a relatively simple paper where we built in a previous paper that I published many years ago, where we are looking at the role of gender in tax compliance. And let me be clear, when we are talking about gender here, in the paper, we are talking about sex assigned at birth, and I'm going to be talking more about that. So when we are talking about women, men, we are always talking about sex assigned at birth. But the idea here is trying to recover. So we know, and we're going to be talking about that women are more compliant than men. That they tend to evade less, and we're going to be talking about that. The question is, how do women react to interventions of the tax authority? So do they also react more by paying more? And the issue, that we are trying to look at here is that we know that there are pre-tax gender differences in pay. Women tend to make less than men. But also, if they pay more taxes than men, then the post-tax gender gap is going to increase. Okay. And we know that, again, compliance by women is higher than compliance is higher for men. And then if women react more to the actions of the tax authority, then, the gap gets, larger and larger over time. So that's a little bit of what we are trying to look at it here. Again, so we know that there is plenty of evidence that, says that women are more likely to comply with their taxes than men. There are plenty of papers out there showing that. We are going to show you some data. And why is that? Well, there are two hypotheses. One is that women are more risk averse than men. Right? So they fear, they are not as willing to take risks as men are. We know that, men tend to do more stupid things than women. and fall of things and, get on higher altitudes than men. So we know that men are a little bit more risk-loving than women. But we also, there is also some evidence that women have a higher tax morale. Okay, so they believe that paying taxes, is more of the right thing to do than men tend to think. Okay, so the question is that when faced with an intervention of a tax authority, are women going to react more than men? Here, when we say more sensitive, we are talking about more sensitive to the intervention, not that you are more sensitive, in general. So please don't. So it's more sensitive to the intervention. But also men have more room for improvement. So if men tend to cheat more than women, then there is higher room for men to improve when faced with a tax intervention. So the idea is, okay, what happens in practice? What does the theory tell us? So what we're going to look at is an intervention that affects an overall population, and we're going to look at whether men and women react differently. One key of the intervention is that it's going to provide a treatment of deterrence and also a treatment on tax morale. So, we know again that these are the two things that may be affecting differentially the compliance. And we're going to do in the context of a very simple tax, which is the property tax. And for this, it's important for you, all of you, to move from the world that you know of the US, of the developed world, and move into the developing world environment, okay? Just to give you an idea, if you think about Argentina, where I'm from, or actually from Latin America in general, you pick a tax, you pick a country, and if you think that tax compliance is about 50%, you are going to be right. Okay, just whatever tax, whatever country, more or less compliance is about 50%. In the property tax, compliance tends to be even lower, which for you may be quite weird because, most of you just, pay your property tax, don't even think about the property tax because it's, comes in the escrow with your mortgage, etc. It's not even an action that you make. But that's not the case in Latin America. In the case of Argentina, for example, less than 1% of the properties are financed through a mortgage, okay? So basically, you either inherit your house, or you save for 20 years, and then you go and buy your house, okay? But then once you own a property, then every month or every 2 months, you are going to receive a tax bill from the authority, and then you are going to make the decision, do I pay this tax or don't I pay this tax? And one of the interesting things about the property tax in this case is that then it's very easy because there is no uncertainty about the tax you have to pay. Okay, there are no reporting requirements. You are told by the government that you have to pay $100, and you decide to pay it or not. Okay, so we don't have a problem in which we don't know how much people were supposed to pay. So again, we built in this other experiment that we did more than 10 years ago, and basically it's a city, it's a city of about 250,000 people, and basically we get 23,000 taxpayers, and we did an experiment with these people. And again, property tax, this is a very simple context in which to do an experiment. Again, the tax is billed by the city, okay? The city sends you a bill, in this case, every 2 months, okay? And basically, they compute what your tax is going to be, so they know the size of your house, etc., the improvements, they know what type of public goods they provide. In most of cases in Latin America, the tax accounts for the services you provide, the government provides. So if they collect your trash, you have, you pay some amount. If they give you, street lighting, you pay an amount, etc. And then, the size of your house, etc., is going to determine how much you have to pay. So again, compliance is very simple. You pay your tax or you don't pay your tax. That's the only decision that you have. So basically, what we did is that we sent these people three types. So we had these 23,000 people. We divide them into 4 groups. One group did not receive any type of messages, and then the other 3, the other 3 groups, each one of them received a different message. One was about deterrence, what happened if you don't pay. Another was about, reciprocity, what the government. So we inform people what the government does with the money they receive. So we say, okay, look, in the last 6 months, the government collected this amount of money. This is all the works, the public works that the government did with that money. And the last one was about what other people are doing, whether people are paying their tax or not. So what we did is that we redesigned the tax bill. This is, these are the 3 examples of tax bills. But this is what you receive in the mail, okay? So you receive one of these every 2 months telling you how much you have to pay, and then you go to the bank and you pay what you are being told. So basically, we know the owner. So we know who receives this bill, which is usually the owner, or in some cases is the tenant. In the property in the leasing contract, they can stipulate who is going to pay for the property tax, if the tenant or the owner of or the landlord of the owner of the house. So we know the name, and one characteristic of Argentina is that there is a list of officially approved names. So you cannot name your child like Elon Musk did, like X, Y, whatever. So there is a list of officially approved names for people who are assigned, the gender of a woman at birth, and then a list that is separated for men. So there cannot be, there is no uncertainty about when somebody is named Carlos, as in my case, it can only be somebody who was born as a male, okay? And if it's, the name Maria can only be assigned to a person who is assigned women at birth. So there is no uncertainty about, who is, what was the gender of the person at birth. So we could recover, the gender of 92% of the sample. Okay, so everything works well in terms of internal validity. We have it's well balanced, etc., etc. So basically, again, what it happens, the government sends the tax bill. In this case, during the second part of the month of August. Then you receive, by the 1st of September, people receive their bill. So they have, 15 days to pay their bill. So that will be the first due date. Then there is another more week that they can use to pay the tax. So that will be the second due date. And then, we look at what happened, after another 2 months, which is when they are going to receive the bill. So we are going to be looking whether people pay their tax by the due date, by the first due date, by the second due date, or after a period of 2 months. Okay? Basically, if you pay your tax within that period of 2 months, nothing happens. The government, forgives your interest rate and everything. Okay? So what happened? So basically, in the original paper, what we find is that there is an increase in compliance for the deterrence message. That is sizable. It's like 10% increase. And we find no average effects for the other two, but there are very interesting heterogeneous effects that I will not go into that. If you want, go and read the previous paper. So, but just to give you an idea, so what we did in the original paper was that the message will be something like this: did you know that if you don't pay the tax on time, and you have a debt of 1,000 pesos, you will have to disburse additional 268 pesos in fines at the end of the year, and the municipality can take administrative and legal actions. Basically, what happened is that a lot of people thought that there were no consequences for not paying because the cost of not paying was a monthly compound interest of 2%. Okay, and when you tell the average taxpayer that they have to pay a monthly compound interest of 2%, they have no clue what you're talking about. They hear 2%, they think that is very, something small. It doesn't count, okay? So what we did is just basically try to explain that a monthly compound interest of 2% amounts to real money, okay? And that the government, can pursue legal action. So what is that we find? So here you have women in the treatment group, in the bolder line, and women in the control group. So what you see is that there is an increase in the share of women that when they receive this treatment, increase their payment, about 4 percentage points. Okay, you see that there is also a significant difference by the second due date, but then there are no differences basically in the end period. So what is happening is basically you have stock of women, let's put it this way, who are paying their tax. Now they receive this message from the government telling them that that there are penalties for not paying. So what they do is that they rush to make sure that they pay early. Okay? But the overall number of women who pay their tax remains basically the same. Okay? About 47%. Okay? So about, let's say 50% of women pay their tax, both in the treatment and in the control group, but the women who receive the notice, now they make sure that they pay on time. What happened with men? So as you can see first, is that compliance is much lower. Okay, it's about 10 percentage points lower in the group of men than women. What you see is that they don't rush. They couldn't care less about being early. Either for the first and the second due date. But then there is an increase towards the second period. So now what is happening is men, they are keeping the same behavior, but there are new men who decide now to pay. Okay? So there is an increase in this extensive margin in terms of increasing the number of men that pay, which is something interesting because then you see, now you see both groups in the same group. So basically you see that there is higher compliance by women, and now there is a high, overall, there is higher compliance by women by the first due date, which basically disappears towards the end, but now men are complying more. So this is kind of an unexpected result. So we expected that, more women will end up also paying more. The behavior of the men is the same that, you will find in most experiments. But, we were surprised by the fact that women, the number of women that were actually paying the tax remained more or less the same. So we try to explain what may be going on. Why is that women are not, are behaving this way? And one of the things that is interesting, probably you don't see it here, is that while men are not reacting to the size of the tax, okay, so basically all of the men, the average effect is the same across the different levels of tax. Women who are paying relatively low taxes react a lot, so they increase paying a lot, but the women who have to pay a very large tax are basically not paying that much. Okay, are reducing how much they pay. So the first idea that we started to look at is, okay, maybe a case that there is a budget constraint. Okay, clearly these are, household, led by women. We know that income is going to be lower. There may be the case that they really want to pay more, okay, but they are cash constrained, okay, in order to pay. Because again, one thing that is important to consider is, again, that the case in Argentina or in most Latin American countries is different than the US. In the US, the value of your property is very correlated with your income, okay? Because basically you are paying with your mortgage. The size of your mortgage depends on your income, so the type of house you are going to buy is dependent on your income. Here in Latin America, the wealth that you have in terms of housing is not going to be correlated with your income, okay? Because in most cases, you may have inherited your house, you are a woman and you divorce, now you get the house, but your income is lower, etc., etc. So there is the kind of a disconnect between your income and the wealth that you have, and that's why the property tax is not well correlated with your income. So we have a model in which basically the traditional tax compliance model, but we introduce cash constraint in the model, and we show that once you introduce these budget constraints, then what you may have this possibility of corner solutions in which women may be willing to comply, but they cannot because of that. So we look at some complementary survey data that we collected, and then we look at census data that seems to correlate with information with the hypothesis that we have. So basically, when you ask women if the government, they tend to be more answer that the government is going to detect evasions if they don't pay, and they also think more than men that women are going to there's going to be consequences if they don't comply. So there is this idea that clearly women think that the government can catch them and the consequences are going to happen. So clearly the fact that we are finding that they react to the notices is correlated with information. But we also find that they are less willing to pay a higher tax, and they are also more likely to answer that the tax is too high, okay? And then when we look at the income distribution, basically we also see that, women tend to have a much lower income than men in monthly income, for the household, and per capita. So how do we interpret the results? So basically what we see is that women tend to have a stronger reaction to intervention, but they are budget constrained. So that's why we don't see the overall effect for women. So why does that we care about? So we are here in a context in which tax compliance is low, as I show you. Only 50% of the people are paying their tax. However, women are paying their tax, 10 percentage points more than men. And we also see that there is, that clearly, the income distribution is skewed against women. So women are making less money, but women are paid, are more likely to pay their tax. And now there may be the case that they even react more to the actions of the tax authority. So what we are basically bringing to the table with this paper is the idea that not only we have to think about tax policy and the effect that tax policy can have in the post-tax gender equality, but we also have to think about how the actions of the tax administration may also affect gender equality. Thank you.
All right, I'm Tyler. This is Who Sells Cryptocurrency? Hopefully the title is pretty self-explanatory. With co-authored work with Jeff Hoops, who is here, and Jaron Wild, who is at Iowa with me, not here today. I'm sure everybody is sick of these by this point, but obviously this is IRS data. I'm not speaking for the IRS, and the views that I express are my own. So, just overview, what am I going to be talking about today if you couldn't tell from the title? First, cryptocurrency. Who owns them? What are we looking at? Why should we bother with cryptocurrency, right? Isn't it dying right now? And ultimately, how do we actually identify cryptocurrency owners? So I'm going to start with the why. This presentation and paper has been super interesting to present over the last year or so as we've gone from bull to bear markets. You know, the framing kind of changes. So you guys are getting the bear presentation today. But we see market failures, right? And my example up here of perhaps the one fortune that was always going to come true, FTX, the now disgraced kind of cryptocurrency exchange that blew up last year, advertised in fortune cookies for some reason, and in retrospect, it was inevitable, right? So we've seen these huge market failures, and we know, there's a lot of retail investors that are investing in cryptocurrency. This is no longer just kind of a niche investment. It's no longer just, tech bros in Silicon Valley that are investing. So it pays, from both a tax administration, but also a public policy standpoint to understand who owns cryptocurrency, who might be hurt by these market failures, who do we want to protect with new policy and regulations. And obviously, cryptocurrency also offers kind of these unique enforcement. It's a technology that is inherently kind of anonymous, very associated with crime and illegal activity. And so are these people even reporting, right? Had a lot of papers here today so far about enforcement, about how audits affect that. And this is maybe a little bit of a different area where the reactions to some of those interventions might be a little bit different. So it pays to kind of think about how are these individuals and investors different from the general tax population. Also, I think something that we've seen a lot today is, kind of these racial inequalities and just inequality in general, how tax laws and regulations affect different people. Cryptocurrency is kind of unique, so I have a few articles pulled up here kind of from the last 2 years. And the earliest articles are talking about how cryptocurrency is going to provide Black investors, a path to creating wealth and how this is going to be a progressive kind of investment. And then we saw the market kind of collapse, right? And ultimately, and I just looked up today, the most recent articles are still talking about how this is actually bad for inequality and kind of the racial wealth gap, because you had investors, if African Americans were more likely to invest, they might be more likely to lose the money as well. And so we want to consider that and kind of provide at least some initial evidence on what these differential effects might be, more than just the anecdotal articles. So how do we actually identify cryptocurrency transactions? All right, as I mentioned before, the reporting and the cryptocurrency kind of environment is pretty unique. Prior to 2017, basically there was no third-party reporting, even from a lot of the major exchanges. The IRS eventually did the John Doe summons. Some exchanges like Coinbase, and over time more of them, have decided to voluntarily report cryptocurrency sales of their users. And so we kind of take a two-sided approach. We look at third-party reporting for 1099-Bs, and we also go to Schedule D, where taxpayers self-report, because there's going to be a lot of cryptocurrency exchanges, a lot of cryptocurrency owners who aren't getting third-party reported, so we want to capture them as well. We ultimately use textual analysis of descriptions. So for the 1099-Bs, it's a little bit easier. Unsurprisingly, large companies are a lot more standardized and have a lot less spelling mistakes in their descriptions. It's a little bit more noisy when we go to Schedule D. Obviously, we have people who are saying, see attached, or just cryptocurrency sales in general. We try to pick up a lot of that, but certainly there's noise in our measure. We're going to be missing some things. We focus primarily on Bitcoin and Ethereum, and this was done, one, because the size of those two cryptocurrencies encompasses a very large portion of the market, and two, because we're using kind of textual analysis, it's hard to separate certain types of cryptocurrency from just regular investments. And so we want to keep our kind of false positive rate as low as we can. One example of that is there's a cryptocurrency called Polkadot. The ticker for that is DOT. And as you can imagine, when we run a search, right, for DOT, there's a lot of Department of Transportation bonds that show up. And so taking those out from the sample is just a lot of manual work. And so we stick to Bitcoin and Ethereum, which are both large and a little bit easier to kind of separate from your traditional stocks and bonds that we don't want to look at. So obviously, as I mentioned before, we have concerns with tax avoiders. We've talked about non-reporters in some of the presentations today. That is definitely an issue. We hope that the sample we have is fairly representative of kind of the universe of at least cryptocurrency investors who are not doing illegal things. I firmly believe that if you're buying or selling drugs with cryptocurrency, you're probably not reporting it on your taxes, but that should be a small percentage, especially in the more recent sample period. And also, we have the issue that identification is contingent on you actually selling. Luckily, we find in some of our supplemental tests that the holding period that we do observe is pretty short. But if you bought in 2013 and you have never sold your cryptocurrency, first, why haven't you retired yet? And second, we will not see you in our data. So who are the people who sell cryptocurrency? Our results. So first, a little bit of background after I tease you there. Our paper, 2013 to 2020, you can see that we get over 2 million cryptocurrency users, so taxpayers who report cryptocurrency. And our total sample is about 200 million. And one of the benefits that really IRS data has provided us is compared to prior studies that have been looking at cryptocurrency owners, we have a huge sample. We have a ton of cryptocurrency owners. We're a little bit less limited in kind of some of these self-selection concerns. So again, hoping that our results are a little bit more representative of the broader population. So when we look at cryptocurrency sellers, this graph is showing two things. The yellow line is just the number of cryptocurrency taxpayers over the course of our sample period. As you can see, 2016 to 2017 is kind of a turning point. Prior to 2016, almost nobody reported. After that, the growth has been exponential. One of the reasons for that is, again, IRS enforcement actions. The IRS really came out. 2017 was when the Coinbase John Doe summons kind of got litigated through court. You can see the black bars are where we have the number of taxpayers that are receiving a 1099-B. So again, increasing the importance of third-party reporting in individuals complying, even though these 1099-Bs are voluntary by the exchanges themselves. And since then, it has, again, just kind of blown up exponentially to, I believe, almost 1.6 million taxpayers in 2020. And how has that affected who is actually selling? So William made a good point in his discussion that maybe we want to do a whole group sample because the year-by-year comparison is not great. I'm going to do a year-by-year comparison because I think there's a lot of change that's happening. Again, that 2016 to 2017 seems to kind of be an inflection point. Here we're comparing cryptocurrency sellers, so people we identify with cryptocurrency, to non-crypto investors. So look, there's obviously a difference if you've never invested in anything. So we want to compare people who invest in crypto versus people who have investable assets. Maybe they have stocks or bonds or interest, to make the groups a little bit more comparable as the starting point, and then look at how that changes over time. So we can see, investors who don't invest in crypto are a lot older, and crypto investors were younger than other investors, but since 2016, they've gotten quite a bit younger. And then in income, right, the non-crypto investors' income has been slowly kind of increasing over time. That's the gray line at the bottom. And we can see the cryptocurrency investor, again, with this just explosion of more people coming into the space, more third-party reporting, potentially more tax reporting, right? We've just seen the average income of cryptocurrency investors plummet since 2016. And giving credence to kind of our hypothesis that, the enforcement of cryptocurrency needs to fit with the individuals who are actually selling, and these characteristics have been changing pretty significantly over time. So next, we are going to go a little bit into, are there racial disparities, right? We saw these news articles about how, black investors may be doing better, maybe they're doing worse. The problem, as other presenters have been pointed out, the IRS does not have racial data. We are hoping to use your measure in the future. We've taken a different approach so far, so interested to hear thoughts on that. We start just kind of with a little bit more of a coarse measure, and we use census-level zip code data to look at the racial characteristics of each census code, and then we aggregate our reporting statistics by those zip codes to see, all right, if in a particular zip code there are a lot more African Americans, what does that do to the percentage of those people that are reporting cryptocurrency and their gains? An additional note for the next graphs, I do standardize all of these percentages to mean 0, standard deviation of 1. So the coefficients should be comparable between groups, even if you have a small percentage from African Americans and a larger percentage of Asians, they should be comparable. So first question, does racial characteristics matter for the number, the proportion of individuals selling? And we see that it does, and there are, again, changes over time. Certain groups, so Asians, much more likely to be a cryptocurrency seller throughout time, still increasing. African Americans, kind of in line with the news articles, originally were actually less likely in 2017, and over time they've increased to be more likely than our baseline to sell cryptocurrency. Now, but that's just one part, right? We want to know not only whether they're more likely to own it, but what are the outcomes of that? So we also look at cryptocurrency gains over time. And here I do on the bottom have the yearly buy and hold Bitcoin return as a baseline for how much did the market go up or down. And we can see racial minorities, they were more likely to hold, and they seem to perform better when the market is up. They perform worse when the market is down. And so given they're more likely, that maybe is a little bit obvious, but we think it's interesting, and it kind of provides evidence that from a policy standpoint, these groups are a little bit different in their investing characteristics and habits. So finally, I'm not going to go into all of our other results just due to time. We have a lot of them, so I encourage you to look at the paper when it ultimately comes out for the conference. But we find geographic dispersion has also increased over time. Back in 2013, as you might expect, it was East Coast, West Coast, the Silicon Valleys is where the cryptocurrency sellers were. And over time, it's spread to be almost in every county in the United States. We look at the profession of individuals who are reporting cryptocurrency. Again, in our early part of our sample period, we find it's tech professionals, finance professionals that are really reporting, whereas by the end, there's a lot of restaurant workers or hospitality workers who are reporting. Again, giving this broader adoption of cryptocurrency, potentially bringing in people who might not have otherwise invested in other assets. And I think one of our interesting tests, we also look at people who had huge gains. So some other news stories that we've kind of seen is that, oh, so-and-so bought cryptocurrency or mined cryptocurrency in 2012, and now they have $1 billion, right? Because they just held it. So we look at individuals who in a single year had over $1 million of cryptocurrency gain. And we find that for the top income percentiles, that, yeah, we see the big spike, they have a big gain, and then their income kind of goes back down to the baseline within 2 years. But for lower income individuals who have these really life-changing amounts, when your average income might only be $50,000 and you have $1 million gain, at least 2 years out, their average incomes are still significantly higher than they were in the pre-period. So again, giving this, maybe there's some silver lining to cryptocurrency for at least a small number of people. So ultimately, takeaways, the cryptocurrency user base is not stable over time. I think that presents interesting opportunities for research when we're thinking about compliance and maybe even on other non-cryptocurrency topics, how to use this as a setting, but also for other cryptocurrency research. Demographics continue to rapidly change, and even things like geography, profession, and racial composition also continue to change. And in case you were wondering, that is Herky the Hawk, the Iowa mascot. So we have to have him on the slide for us as well. And that is all I have. So thank you very much. I'm looking forward to the discussion.
Hi, my name is Yan. I'm economist with the rest of IRS. I'm honored to have opportunity to contribute to the conference as a discussant. So today I will review 3 papers. I think these 3 papers have brought us the research expertise from the Treasury, from the academics, and from international communities. The research in this session highlights the importance of understanding our taxpayers, and they are all empirical papers, and even they focus on tax compliance, but they from the different angles, from the filing status and the intra-household resource allocation, from the racial disparity and the in response to the intervention, and from the cryptocurrency. So the first paper is married filing separately. So this is an interesting paper examining the MFS filing status. It used the individual return for 9 years. And the key finding is most MFS filer face a separate filing penalty. So I like this paper a lot because I think this it quantifies the penalty and the bonus. The paper also, I think, did a good job, brings the inequality, the angle into the big picture. So because this MFS filer face an unfavorable treatment of tax with respect to tax credits. And for the low-income household, they sometimes they cannot file married filing jointly. So they kind of like have the penalty. Also, I think this paper make me think, how could IRS help taxpayers to understand the consequence of different filing status? What's the advantage? What's the disadvantage brought by the tax as well as the tax credit? Because MFS filer, they have limited eligibility for the tax credits. They are not able to claim the EITC until 2021, and they cannot claim education credit. So I think the paper would be more interesting if it discussed the scenario under which MFS are better off or are worse off. The author does explain why using MFS, but in the sample, like as a rational household, why I choose this, elect to choose this filing status by maximizing my expected utility. So I think from the data, if you can tell us more information, that would be great. Like, is it because of the student loan payment, or is it because of the medical expense deduction, or because of I have big disparity in the couple's income respectively? Also because of like something I need to file because I'm in pending divorce or separation, or I just have lack of information. The reason I'm saying that because different scenario for IRS, we have different intervention policy. So yeah. Also, I think it would be great if you examine the heterogeneity in the MFS sample. Also look at the heterogeneity over time, because you do have the data. It's 9 years data. And the minor question, what's the consequence or impact of MSFS, this filing status, on the household structure, family structure? For example, the disincentive for the marriage, does it have any consequence? I just come across this paper and from Tax Policy Center. Hopefully it would be useful. So the second paper is by Carlos. So this is experimental method to inform the policy. It is in municipality in Argentina. Examine how taxpayer responded to the intervention message from the city government on the property tax payment. It has 3 messages, 3 types of message. So the main finding is women would be more motivated to pay, but they face significant household financial constraint. So I like the paper because along with the empirical modeling, it also developed a very nice analytical framework. Like you pay now, or I don't pay, but I face probability of being penalized in later. And I also like it. It brings a lot of domains and approaches from development economics. For example, beyond the risk aversion and tax moral we see in the tax compliance literature, it also talks about household budget constraint and income inequality and poverty, because the female household headed, that household have lower income. Also the disparity in the labor market outcome. So we all know tax compliance is very complexible because it cannot use just one approach. So I think all this approach make that paper very rich of the context, very interesting to read. Also, I think the empirical analysis is conducted very carefully. For example, for the regression, it analyzes the tax compliance along the gender line and across the gender line. So along the gender line is a regression for man and woman respectively, and then combine them together and introduce the interaction of the gender variable. So I think it is very nicely done. So the main challenge, I think, for the experiment is scale up. So I think the finding is very interesting, but how can we learn from that experiment? So this is the city in Latin America. As the author already said, the tax structure in that country is very different from the other side of the country, from the developed country or from OECD country. And it is a property tax and versus the income tax. So does it matter? Does the finding would differ because of that? And also the local government versus central government. If I want to learn from this experiment, like what should I do? Like, can I take all of them, or like it's different insight? Also, I think like for experiment, if there are other things affect your findings, like for example, I have the property joint owner. How do you define the gender for the joint ownership? And for this experiment, it is in 2011. Do you have another round of most recent data can give us more updated information? Yeah, so the next paper is very exciting, the cryptocurrency. So it examines the cryptocurrency sellers who report cryptocurrency sales to IRS. So it uses 8-year data, 2013 to 2020. And it gives general information on the characteristic of cryptocurrency users. So I think the author did a really smart way to utilize the administrative data to understand the relatively new financial product when the survey data is not available. And it offers the first broad descriptive statistics on these U.S. taxpayers who sell cryptocurrency. And it also provides the empirical analysis. So the main challenge is the underreporting, because it's a subset of the population. So I think IRS, we have strengthened the digital assets reporting. I think, and also I think the finding is very interesting because you have the cryptocurrency user has increased and the income has declined. But is this like because of underreporting, or like is there any like other explanation? So I think since tax year 2020, IRS has required all the taxpayers to answer the digital asset question in Form 1040. So do you receive, sell, send, exchange any virtual currency? So for all taxpayers, even if you do not have, so you have to answer no. So I'm thinking when you face this underreporting challenge, do you think this update from IRS side would address this underreporting issue? So are you considering to use like another round of data, like a tax year 2021? Also, I think investing behavior is very complex. Like, but our tax data, since it's tax purpose, we don't have a lot of variables there. Like, for example, education, we don't have that variable. So are you considering to use additional like survey data? Also, I think we don't have the gender, the race, and like the co-residency, for example. I think all these variables, they are very relevant for the investing behavior. And another factor is network externality and complementarity, because as you said, now more and more people use cryptocurrency. And I think now we have more and more financial exchange firms, and the payment firms. All these players, they create a positive externality. And I also have minor data issues. And for example, for your sample selection, you pick up the first observation, but do you think alternative way, like using the TC code to pick up the amended return? Also, you define your student as if they have 1098-T form. But I think for some student populations, they are student, but they don't receive that 1098-T form. if they have the more scholarship than their tuition. Also, the income, I think probably you have to clarify, like I think in the paper, we have tax return. I think you put very clear why you pick up the taxable income, not the AGI, but then here you use per capita income. So in your paper, you have to be very consistent. And also the wage income there usually is endogenous variable. How do you say something, address this? That's, I think, probably one factor your the R square is very low. So I think this wonderful research, they just make me to think, how can we make our tax intervention more effective while considering the disparity in gender, household structure, and labor market outcome? How can we make our administrative authority a more trusted institution, provide more better guidance for taxpayers, and especially the disadvantaged people, like low-income people, female-headed households? How can we address the challenge from the fast-growing technology advance? All of this, we don't have the definite answer for this, but now IRS work with the Treasury, with the support from the academic think tank and international communities. So, I would like to thank authors for sharing these great papers in this conference with us. Thank you.
Person in Argentina, just like Andre. He went to Venezuela,
Well, it was a phenomenal job. They did a really good job, and we even had a college mascot to join the group today. So let's open it up for questions and answers. Anyone have any questions? Yes, sir.
I had a question for Emily. Did you see any evidence in your data when you're analyzing things that married filing separate really serves kind of as a transitionary filing status where you have, it really is kind of going from, it's like pre-divorce. It's like you're separated because, and you're not going to get but you're on your way to divorce. So like how many of those people didn't just end up in a divorce state or filing single, I guess, would be that next year?
Yes, that's kind of our next step. We haven't linked any the multi-year data. We have the data only on the MS returns, and we should have linked the data into the before and after to see the transition. But as one of the reason we think people file separately is in the transition from marriage to divorce. So and many of them use only 1 year. So we suspect that is what's happening.
Yes, sir.
Yeah. Hi. So I had a question for the cryptocurrency paper. So it's for Tyler. These dynamic patterns are really interesting, and the types of people that you're seeing reported sales of cryptocurrency. Maybe I don't understand the reporting environment very well. My understanding is you showed us there are these very large changes in the reporting that's happening over the same set of years. So how much of the demographic pattern is just a change in who gets reported on, and how much of it is a change in who's dealing in cryptocurrency in real terms?
Yeah, so I wish that I could provide you with a concrete answer. It's definitely something that we've been thinking about. And I think one of the parts of our research is just kind of showing, a lot of papers will use kind of 2017 as the shock to IRS enforcement of cryptocurrency. And to be honest, at this stage, we're kind of doing some more tests, but I think it's both. I think there's a lot of new people coming in that's changing the income down. There's people who had been using it before and are now newly reporting as well. And yeah, teasing that out is hard given we only see one half. We don't see the non-reporters, but it's definitely something that we're thinking about. So if you have any suggestions.
Yes, ma'am.
My question is also for Tyler. You noticed that big spike in the number of reported sales as the volatility grew and more people came into the market. Could that possibly be because there's no wash rule? You know, you can't sell your stock and buy it back the next day and lock in that loss, but you can sell your Bitcoin and buy it back the next day.
Yeah, definitely. So I think one of the interesting things that gives us a little bit more confidence for like eliminating the buy and hold people who you might not see in traditional securities is that exact fact that, you know, there's no penalty to selling and then kind of buying back right away because of the lack of the wash sale rule. I know some of the additional tests that we're running is kind of looking at both the volatility right around 2017, and then also we're going to expand the sample out to 2021 to look at what's called the crypto bowl and the ads around the Super Bowl and see how trading kind of changes around there. But I suspect that there is a lot of short-term trading.
Yes, sir.
So 2 questions. The first one for Tyler. You mentioned that a lot of the 2017 increase is particular cryptocurrency exchanges. And actually it would be really cool, even if you just give them each a color and like you take your black bar over time and you split it out by, you know, this is color green, this is color yellow, this is color blue, whatever exchange, and just see, oh, how many of the increase in our particular exchanges. And so you might say, oh, you know, here are the people who are reporting, who are also reported on a 1099-B from one of the exchanges that was summoned, and here are the people who actually increased their reporting even though their exchange wasn't summoned or they weren't on one of those. And that would give you some leverage on what was driving that 2017 increase in over time, and also like, is there a spillover of that enforcement?
Yeah, we definitely do. That is a great idea to split it out by exchange. We do see both increases in the 1099-B reporting, but also individuals who don't have 1099-Bs who are reporting. So that does, I think, slightly answer that it's increasing in both groups. It's not entirely driven by just the 1099-Bs.
And my second question is for Carlos. So on the, to what extent do you have demographics, or even like, you know, you have something about the value of the property, and it would be interesting to know how much that varies with gender, and just like to sort of link that in. Even if you can't see income, you could at least see, well, the women have properties that are on average this percentage as large as the men's, or vice versa. Yeah.
Yeah, no, so we don't have detailed demographics just because, you know, we're using the tax data, but we can see the properties, and women tend to have smaller properties, and they are more centrally located in the city, so they tend to live, you know, more in the center of the city rather than, you know, in the outskirts. So then the you know, lots are going to be smaller, and so the property tax is going to be relatively smaller than the men's, because the property tax is not really, it's not like in the US that you have the value of the house, and then you have basically just a combination of the size of the lot plus the services you receive, et cetera, et cetera.
Do the services they receive vary differently for women and for men because they're more centrally located?
Women tend to receive, yeah, relatively more services than men. Yeah.
It's interesting.
Yeah.
Okay, thanks.
Anyone else?
I have a question for Tyler.
Yes.
I'm curious if there's any research done on the type of person who tends to own cryptocurrency and their overall tax compliance.
So there's definitely a lot of kind of surveys and stuff, at least on just the general characteristics. I cannot think offhand of the general tax compliance on like non-cryptocurrency aspects, I think was what you're getting at maybe. I know compliance and kind of the enforcement, Jan mentioned the cryptocurrency checkbox is one thing that we do also have on our list to kind of continue on with the research and look at further.
Yes, ma'am.
Following up on that, I've done a little bit of research into the crypto space, and the last data I looked at from the IRS, I think it was around 3% of filers who report cryptocurrency. And if you look at the Pew Research Center survey that came out recently, I think around 16% of Americans say they've invested. So I just wonder if you've looked into that gap. And also, a second part of that is, do you anticipate that it will become easier or harder to identify those filers over time?
So we have looked at kind of like the survey evidence. I'm always a little bit skeptical of some of the survey evidence. Pew does pretty good stuff. I know a lot of the cryptocurrency firms also kind of put out their own surveys that are usually pretty high because they're all online and they're for their customers. So I don't quite know, how we might tie that kind of one-to-one to, zero in on what that gap is. And as far as will it get easier or harder, honestly, I don't know. I mean, some of the IRS folk here probably have a better idea of what they're thinking. I think one of the big challenges right now is like the SEC enforcement actions. If they shut down the big cryptocurrency exchanges that are already deciding to voluntarily report 1099-Bs, and we move to all decentralized exchanges, right, it probably gets harder. There's probably going to be less people reporting. If those court cases go differently and the IRS requires a broader 1099-B requirement, then it probably more cryptocurrency people will report because they'll get more third-party reporting. But I don't know. I don't have the fortune cookie to tell me which way that'll go.
Yes, sir.
That was kind of my question. In regards to efforts and regulatory enforcement by other agencies, such as the SEC, CFTC, or FinCEN, did your study take into account any of those efforts?
So in our sample period, we're missing a lot of that because a lot of those actions have kind of been more recent. So we kind of look around that 2017 period, but again, it's so correlated with the huge increase in price that happens in 2017, the huge increase in hype, that it is really hard to just kind of disentangle what's enforcement, what's general economics, what's kind of like the advertising effect in this really rapidly shifting asset. Yeah.
Yes, ma'am, in the back.
So your results imply that, I'm hearing the echo here. So your results imply that women are much more responsive to treatment. But is that the response you wanted? Because you wanted people to pay more taxes, not to pay them quicker.
Yeah, no, so we were kind of surprised. So if we assume that women are more likely to pay than men, again, because of risk aversion and tax morale, etc., but we still have, half of the women not paying, we assume that with the intervention, what we will see was a higher impact also on women. And we didn't find that. We found this kind of weird result in terms of moving women that were paying, but paying probably late, just to paying on time. And the traditional result for men that they after an intervention they pay more. So yeah, we're not expecting. Then we started to do this like forensic analysis. Why is that? It may be the case that we are not bringing more women in, and we find this plausible result, which is this issue of cash constraint or budget constraint. But yeah, we were not expecting. Just let me be clear: when this intervention took place, we hadn't considered these gender differences. We were thinking about just taxpayers, and then this is something that we did 10 years after we ran the experiment. We say, okay, we can recover the gender. So given that we can recover the gender, we can go back and answer a question that basically nobody has looked at, is whether women and men react differently to the actions of the tax authority.
Yes, sir.
question for Emily. Following up on the earlier question, though, the transitory kind of use case versus some of the others that you were discussing around the kind of more permanent folks who are long-time married filing separate, and it reflects maybe different needs for how they organize their lives. Where are you looking to take this? I mean, it seems like that's going in the direction of some kind of segmentation of understanding different uses of the policy. Where are you looking to take this in terms of trying to take this apart a little more?
Yeah, that's a good question. At first, we started this just because we felt like we didn't know much about this, but we heard about filing status issues, and then we look at NRP data to know that a lot of like head of household, married filing separately, and singles, those type of issues. So that's where we began. But also when we started gathering all these reasons to file separately, and we think that by looking at data, we could link to the reasons. I think that's also related to the discussion's comment, to link the length of using it to the reason using it. So, we don't have a specific direction as to where we are going to take this project to. And that's so right now we just kind of our beginning of our work, and we want to see which area will require additional work, and we will just go from there.
Well, I'd like to thank you all for all your hard work regarding this important endeavor. We really do appreciate it. And we're at time. Thank you guys so much.
So I filed as a non-resident, so I filed in 1040 and so I might, so but and I'm
whole idea.
Everybody can take a seat. We can start the next session. For our final session today, we have our final session today, Hidden Assets and Hidden Networks. We have 3 papers on some of the less visible parts of the tax system. Our first paper in this session, Following K1s, Considering Foreign Accounts in Context, is being presented by Tomas Wind, a data scientist at the IRS's Research and Applied Analytics and Statistics Division.
Nice to talk to you.
Our second paper is Application of Network Analysis to Identify Likely Ghost Preparer Networks. It's being presented by Joshua King, who works in the Emerging Risks Lab, also at the IRS's Research and Applied Analytics and Statistics Division. And our final paper of the session and the conference is The Offshore World According to FATCA, New Evidence on the Foreign Wealth of U.S. Households. It's being presented by Daniel Reck, who is an assistant professor of economics at the University of Maryland and a faculty research fellow at the National Bureau of Economic Research. The discussant for today's session is Paul Organ, who is a finance economist at the Office of Tax Analysis in the Treasury Department.
Did she say yes or no? No. Okay. Bye.
Hello, my name is Tomas Wind, and I am at RAS in the IRS, and I'll present some results from my work here, following K1s, considering foreign accounts in context. It's work completed with my colleagues, David Bratt, Alyssa Graff, and Ann Herlash, and as always, the usual disclosure applies. This work does not reflect the views of the Department of Treasury or of the IRS. So some of the motivation for this work. So it grew out of a couple different work streams. First, digging into what we know about taxpayers with overseas accounts. So as you'll hear about a little bit in much more detail a little bit later in this session, recent estimates have shown that in 2018, for example, about $4 trillion in assets from U.S. taxpayers are overseas. And there's also earlier work that goes into great detail in tracking how so much partnership income flows to owners in tax havens, and then the lack of transparency in following these funds. So I think we're beginning to build a better understanding of how much money has been tracked for U.S. taxpayers overseas, and then also some of the steps taken by some taxpayers to make that money difficult to track. Then we also are building off of previous work looking at using network analytics in tax administration. So, for example, the Agarwal paper from a couple of years ago that ties the presence of pass-through entities and corporate structures to tax avoidance and uncertainty. So here we're looking at in the individual context, but in the also K1 networks. So we're really trying to understand how using K1 networks rather than just individual returns can help us understand whether non-compliance or, in this case, looking at the population of taxpayers with offshore accounts. Just bring us to our research question, which is, to what extent are taxpayers' K1 network characteristics predictive of their disclosing a foreign account? So I'll just walk through a quick overview of our methodology of how we went around doing this. So first, we identified all individual taxpayers that did report holding a foreign account. So I will note here that we are only looking at individual taxpayers. We are not looking at partnerships or other business entities. Then we filtered down that population to individuals that also received a K1. That is because we are interested in looking at K1 networks, so they would have had to have received a K1. And we then took a sample of that population.
Can you turn on your microphone?
Oh. Okay, better? All right. Okay. Right. So we took a sample. So this population, referred to this as the RFA taxpayers, or reported foreign account taxpayers. Then we also took a sample of individuals that also received K1s but never reported foreign accounts, so to act as a comparison group. So I'll refer to these as NRFA taxpayers, or non-reported foreign account taxpayers. Then we created a graph database just depicting the K1 networks and also the spousal relationships among taxpayers in these groups. And then finally specified a series of models on whether a taxpayer reported a foreign account in a specific year. So very briefly, just here are the sources that we used to identify taxpayers with foreign accounts. So we did look at taxpayers for FBAR. We also looked at Form 8938 as required by FATCA. Just another note here about Form 8966, which is third-party reporting by foreign financial institutions. So we did not use that to identify taxpayers because we were specifically interested in reporting behavior. So we were interested in seeing whether or not a taxpayer with a foreign account self-reported. We did use the 8966 for one purpose, and that was just when we looked at our non-foreign account population. We wanted to make sure they were not mentioned in an 8966 filing, just so we could be sure to the best of our ability that they did not have a foreign account. They should not have been reported or reporting having a foreign account either. And then, you can see the last two, we also included taxpayers that participated in various IRS voluntary disclosure initiatives, like the offshore voluntary disclosure programs, and then the streamlined filing compliance procedures. So we're just clarifying a little bit, taking a look at the two different groups. So the RFAs with K1s and the NRFAs with K1s. So just again, the main difference here is that one reported a foreign account and the other one did not report a foreign account. However, both of them are comprised of only individuals that received at least one K1 between 2006 and 2017. And we did limit this to make sure that they received a significant share from K1 income. So we defined significant share here rather simply as just that the individual must have directly received at least 30% of the income that was reported out by the K1 payer. So construction of the graph database, I won't go into too much detail here, but we essentially just got the K1 network for each of the taxpayer, got the spouses, and then added additional data, like 1040 data and some other taxpayer characteristics. So this is a graphical depiction of a sample network of a taxpayer. So we'll see we would start with that blue rectangle, be our starting node. So this is an RFA taxpayer network. It is an OVDP participant, so offshore voluntary disclosure. So you can see this taxpayer would have received two K1s, one from entity B, one from entity L. In our network, just to keep things manageable in terms of sizes of networks, we would only keep entity B, because you can see entity L, he just receives a 1% stake. So for this point, we would not include that in our network. And then going up from entity B, we would just follow the K1s through looking at different payers and payees. Again, always make sure that they are above that threshold. So this was a 1% threshold kind of after that initial identification stage. And then you can see on the bottom, there's just a spousal relationship here as well. So we're just noting that, and then also taking a note that the spouse did not have a reported foreign account. Okay, so now some insights from the graph. So few of the RFA taxpayers did report a foreign account in all of the 12 years. So what we did notice, though, is that taxpayers that did report a foreign account in multiple years were more likely to report a foreign account in the years directly following the first report. So what this shows here is these are taxpayers who reported a foreign account for the first time between 2006 and 2012, and then it just tracks how many of them continued reporting a foreign account 5 years later. So you will notice that the y-axis begins at 50% there, just make a note of that. So about 65% of taxpayers reported a foreign account in the year directly following the first disclosure, and about half of taxpayers continued to report a foreign account 5 years later. So now turning to looking a little bit at the differences in their networks and network characteristics. So on this left-hand side here, so this is just the number of taxpayers in the network, in the K1 network. So the lighter blue are the NRFAs and NFRFA networks, and darker blue are the RFA networks. So kind of right off the bat, you can see that the never RFA networks tend to be smaller in size in terms of normal number of taxpayers. They're also smaller in size than just the dollars that are in the network. It's not shown here. So in fact, 55% of NRFA taxpayers contain less than 4 taxpayers, and that's compared to about 45% for RFA taxpayers. So we can already start seeing some difference in the in the types of networks that they have. And then in the right-hand plot, so it just shows some different metrics, and again, the percentage of RFA or NRFA taxpayer networks that meet that. So the first one is received K1 from a multi-tiered pass-through entity. So here, multi-tiered pass-through entity defining as a pass-through entity who itself received a K1 from another pass-through entity. So this is just kind of could be one proxy for network complexity. And you can see here a much higher percentage of RFA taxpayers did receive a K1 from multi-tiered pass-through entity. And then the other two just show other RFA taxpayers in their network. So that first one, RFA owners, would be mostly, in our case, individuals. So other RFA K1 recipients who are also reported for an account. And then the other one is RFA payers, so K1 issuers who are in the network that reported a foreign account. And again, both of those were much more likely to happen in RFA networks. And then one last slide showing the difference between the two. So here we're looking at different 1040 measurements, so different measure of income and tax. So right off the bat, you can see that the dark blue line is, once again, RFA taxpayers. So the median RFA income, so AGI, for example, is considerably higher than the non-RFA, the median for non-RFA taxpayers. That kind of holds across the board. And now looking along the x-axis, so for the RFA taxpayers, these are RFA taxpayers who had their first reported foreign account between 2009 and 2014. And then it shows a little bit how their reported income, or whatever 1040 statistics we're looking at, changes in the years prior to first report and the years after. So one interesting note here, you can see that the capital income actually increases slightly, and then while wage decreases. And then for the non-RFA taxpayers, of course, they don't have a foreign account, so they don't have a first year of foreign account. So we randomly assigned a year zero for them between 2009 and 2014. So just to get a comparison group to see, just make sure there's no kind of larger economic trends that are going on here. We do have planned to kind of take a deeper look into this, really seeing the differences in behavior and seeing kind of maybe what might be going on in that capital income and wage statistics. So we're still a little early on, especially on this phase of the analysis. Okay, so now digging into some of the results. So we ran a series of logit models with year and individual fixed effects. In each of the models, we had the same outcome. The outcome was whether the taxpayer reported a foreign account in a given year. So we run 4 separate models doing this. So again, same outcome, but we just changed the grouping of covariates to describe a different element of the taxpayer. So the 4 elements that we run, we're using network variables, using K1 taxpayer variables, using 1040 variables, and then a combined model using all of them. So on this slide, you can see the results for the first 3 set of models. We're using just a subset of the variables. So just a little bit how you read this. So these are odds ratio for each of the covariates, so exponentiated coefficients. So anything greater than 1 would be a positive relationship, below 1 would be a negative relationship. So starting with the network model, so this is intended just to give us insights on the ability of network characteristics to inform us of the likelihood of reporting a foreign account, and then also which network measures were associated with reporting a foreign account. So you can see in our top, kind of that top one right there, so that is whether the taxpayer network had a K1 payer who reported a foreign account. So we could see that holding all other variables constant, the odds of a taxpayer whose network contains a K1 issuer in the same year is about 1.1 times higher, or 10% more likely to report a foreign account. So it's a bit intuitive, and then it's also the same, kind of see similar results for also if there's another RFA owner in the network. And then moving on to that second model, the taxpayer K1 model. So these are variables that are directly associated with the K1s that received by the taxpayer. So instead of looking at the network, these are directly the K1s. So this actually tells a similar story to the network variable, where here we see that top variable there is looking at the odds of the taxpayer reporting a foreign account increases by about 25% when that taxpayer received a K1 from an entity that also reported a foreign account. So again, totally intuitive, but it's good to check. And then the last model is looking at 1040 variables. So just to note here that all of the different incomes, so it's dividend, insurance, AGI, et cetera, has been broken down to deciles, and it's decile from our population. And yeah, so future work, we might also break it down a little bit finer than decile. So seeing some of the other previous work that's come out that looking at there's really a difference between the 5%, the top 1%, top 0.1%. So we might definitely want to look at that in some finer granularity. Okay. Now moving on. So this is our combined model where we of course combine all the variables from the previous models. So unsurprisingly, we see the top variables from the previous slide are showing up once again. So, this is showing us that there definitely is something there. Just instead of just looking at, for example, the 1040 variables, there is something that seemed proximity to other taxpayers' foreign account does seem to have at least some relationship with also reporting a foreign account. The right-hand plot here, so we then compared all of our different models using the Akaike information criterion, or AIC. So the AIC takes into account the trade-off between model accuracy and simplicity. So a lower AIC indicates a better balance between model fit and complexity. So this showing here is the difference, the percentage difference in AIC from our, quote, worst performing model, which was the taxpayer K1 model, to the best model, which is the combined model. So it is interesting to note, though, that even though it might be intuitive to think that the combined model would perform the best, but also this is even when to account that the model has been penalized for the additional complexity and the additional parameters. So we do believe that our results demonstrate the promise in considering a taxpayer's K1 network when assessing their likelihood to report a foreign account. But this is also, I think, in combination, the previous slide shows that, with additional taxpayer characteristics, such as 1040. So moving forward, we do plan on the couple steps we do plan on taking, such as updating data right now for different data issues. We were only able to select taxpayers through 2017, so we do hope to get that resolved soon. Adding additional variables, so exploring other types of taxpayer characteristics, such as taxpayer had a foreign address, whether they had an amended return. We do hope to potentially incorporate the Form 8966, so we can incorporate some third-party reporting somehow into our results. We also talked a little bit about how we're only using individual data, but we come from previous research. We also know that a lot of the high dollar accounts are in the business, and so trying to see if we can include some partnership data and then some of the previous work linking partnership data with individuals and see how we can make use of some of those insights. And then again, try different models, especially if we are planning on moving into a different potentially like a predictive modeling space, so different a random forest model, even a graph neural network, so definitely exploring what that could take us. And that's it. Thank you.
Hi, my name is Joshua King. I'll be presenting on the application of network and analytics to identify likely ghost preparers. I work, sure. Well, I've got my notes. I'll move closer to it. So I work in IRS research and applied analytics and statistics. While I'm presenting this, we do have a much larger team that worked on this analysis and helped put together.
We can hardly hear you.
Okay. I'll work on speaking up. We did have a much larger group that contributed to this analysis and writing this paper. So I wanted to acknowledge that at the outset. All right. So paid preparers are an important IRS partner. The service depends on them to help taxpayers comply with tax law. A ghost preparer is a compensated tax return preparer who does not provide a preparer tax identification number or a PTIN on the returns they prepare, as required by IRS rules and regulations. Ghost preparers may intentionally or unintentionally hide their identity. For preparers who are unaware of the rules and requirements around PTINs, there's concern that they may not be qualified to provide assistance and advice to their clients, and may unknowingly put taxpayers at risk of not meeting their tax obligations or may put them at risk of IRS audit. For preparers who knowingly hide their identity, there's a range of reasons to do so. Ghost preparers may prey on taxpayers stealing refunds or engaging in potentially illegal or fraudulent preparation strategies. And even where a taxpayer is collaborating with a ghost to falsify returns or to maximize refunds or claim unearned credits, the ghost preparer enables this illegal behavior. Additionally, we've heard of cases where ghost preparers may lie about their activities to avoid their own tax liabilities, or because they've already been identified as a problematic preparer. And then lastly, we recognize that ghost preparers are very likely engaged in schemes that we've not yet identified. So, compounding these risks, an individual ghost preparer may be responsible for tens, if not hundreds, or thousands in some cases of returns. So they very much have an outsized impact on tax administration. So ghost preparers disrupt and destabilize an established IRS preparer and taxpayer ecosystem. So the Innovation Lab is an initiative at the IRS to encourage collaboration across the service on a specific administrative or compliance challenge. In fiscal year 2021, the Innovation Lab sponsored research to apply network analysis to detect and identify ghost preparers. The objectives of that Innovation Lab were to explore multiple approaches to identify ghost prepared returns and to develop a tool for compliance staff to access and investigate these networks for treatment. Over the course of the Innovation Lab, analysts delivered 2 clustering approaches, a data set of 1040 returns networked across a range of filing characteristics for 3 filing years. And then going forward, those results should be updated with more recent data and additional data sources to build out context of the cluster networks and additional inputs to our clustering approaches. And the lab delivered a ghost preparer specific tool designed to deliver results to users and facilitate investigation and lead development. All right. So the value of network analysis to identify ghosts. A ghost preparer is inherently difficult to identify because they don't identify themselves on the returns they prepare. So from the IRS perspective, 100 returns completed by a ghost preparer might look like 100 individually filed self-prepared returns. Behind a ghost preparer, however, is a web of relationships between all individuals involved. And in theory, a network model can help capture some of these relationships. And by analyzing the structure of the network, we can identify patterns across returns which suggest ghost preparer involvement. In addition to providing groups, or what we call clusters in this analysis, of interconnected self-prepared returns, having the data in a network format lends itself to seeing second and third order connections between the returns, which facilitates connecting these clusters of returns we've identified to a potential lead or ghost preparer. In practice, how this process works is we take available 1040 data and we use it to build large networks of self-prepared returns, and then we search in those networks for subnetworks or clusters. We have 2 general approaches for doing this. One's risk-based, and then the risk-based approach, we first limit the returns that are included, we prioritize returns which have suspicious filing characteristics before building the network and searching for subnetworks. And then the second approach, which we also term sort of a top-down approach, is we first build a network and then work to limit points of connection based on degree limits, and then where we still have large subnetworks, we apply a label propagation algorithm to break them apart. And then just generally, we feel that having these data sets stored in a network format provides insights that might otherwise go unobserved if we were working with tabular data. And while this is one application of network analytics, there's potential for other use cases and applications. All right. So on to the analysis. While we did conduct analysis on some of the clusters we identified, our main research aims at this point are to understand how suspected ghost prepared clusters appear early during the filing season and how they evolve through the filing deadline, and then also to understand the effect that ghost preparers have on the returns they prepare, and eventually we'd like to know the larger impact they have on tax administration. Before we go into that analysis, a few pieces of context. We only use results from one clustering approach for this, which is the risk-based clustering approach, and that approach also has a lower bound of 50 interconnected returns that get returned. And another big limitation is that at this point, we do not have labeled data. So we assume the clusters of interconnected self-prepared returns we detect using our risk-based clustering represent individual ghost preparers, and that all returns in each cluster are ghost prepared. But we do recognize that there may be false associations or returns incorrectly identified as being ghost prepared, as well as returns where we do not detect ghost preparer involvement. And we do not currently have a measure of the extent to which we misidentify ghost preparers. And then something else to be aware of is the analysis does span the COVID pandemic, which was a period of where many taxpayers' tax situations changed. All right. So first, cluster evolution during the filing season. For this analysis, we ran the clustering approach at various intervals during filing season 2021 to provide snapshots of what clusters would have looked like at that point in time. So these snapshots were in February, March, and April. We then looked at the returns identified at each snapshot and checked to see if at the end of the filing season, they would have fallen into a cluster of 50 or more returns, which would have been detected by the model. And if they did, we sort of labeled them as suspicious. So you can see on the bottom of this chart in the bars, that's sort of the volume of returns that fall into each of the cluster sizes. And then on the top, we have some percentages that indicate, how many of those returns that would have been detected at that size would have ended up being in a suspicious cluster at the end of the filing season. For example, if you were to look at the February snapshot to the left of the slide, you would see that 80% of self-prepared returns appearing in a cluster of 20 or more returns in February would, at the end of the filing season, be in a cluster of 50 or more returns. Again, looking at the volume of actual filings at that point, you can see that they're relatively small compared to later points in the filing season, suggesting that there might be opportunities for interventions early on that. All right. To the impact analysis, the larger aim of this analysis, as I mentioned before, is to eventually quantify the risks that ghost preparers pose to tax administration. However, at this point in our research, we're working to understand the effect of being in a suspected ghost cluster has on a given return. And we're doing this by looking at tax year over tax year changes. An important consideration is that anecdotal evidence backed up by some of our analysis conducted earlier on during the Innovation Lab suggests that ghost preparers do not work with a group of taxpayers who are representative of the entire taxpaying population. So to address this, we only look at primary filers who appeared in a ghost preparer or a suspected ghost preparer cluster at some point. And we think this should limit the risk of attributing filing behavior of a specific community or demographic to a ghost preparer. So the process is that we ran that clustering approach for 3 tax years, 2019, 2020, and 2021. And then for those tax years, we selected a sample of primary filers and then considered their returns for those 3 tax years. And then from that data set, we were able to identify 2 groups of returns, those where the filer appeared to be transitioning into a ghost preparer cluster, and those where a filer was remaining in a ghost preparer cluster. So that means that, you know, at this point in time, both returns were in a ghost cluster. However, one set, you know, the primary filer did file in the previous year, but did not, but wasn't picked up by the clustering approach. And then for these 2 groups, we looked at how the returns changed from the previous tax year. You know, our hypothesis is that, you know, returns where the individual appears to be transitioning to a ghost cluster should have a more significant year-to-year change in their returns when compared to individuals who appear to be a returning ghost client. And we think these changes are due to the involvement of the suspected ghost preparer. We did these comparisons across sort of the returns themselves as well as existing IRS risk metrics. So looking to the table at the left, there are 2 groups. As I mentioned before, those are joining ghost preparer clusters and those who have stayed. In the red box, the returns themselves, you know, are close, suggesting that it's a similar population and that if there's a ghost preparer involved, first-year clients are receiving the same treatment as returning clients. Then to the right of this to this chart, you can see that the year-over-year changes are more significant for the individuals who, or the returns where the individual appears to be transitioning into that ghost cluster. And this is especially true for the refund amounts. And then looking to the table to the right, we consider sort of an existing IRS risk metric, the discriminant function or the diff score, and it's been mentioned also, you know, before in this conference, but it's an algorithm or technique that predicts how likely a return is to have a significant adjustment. Scoring is done specific to an activity code, which is defined by elements on the return. And so as a result, the scores themselves can't really be compared to one another necessarily or across processing years. So to allow for a comparison, we just really considered counts of returns which fall in the top 5% of diff scores, indicating that they're some of the riskiest returns, irrespective of processing year, are activity code, sort of allowing us to do a comparison across these years. And in the chart, you can see that both groups had similar percentages of returns in the top 5% of riskiest returns as calculated using diff. So if you can see here, it's significant that, you know, that it appears that the returns that fell into this cluster appear to be 3 times as risky as returns overall. And in the bottom of the chart, we can see that primary filers who appear to be transitioning into suspicious clusters, or first-time filers with a ghost preparer, transitioned into the riskiest diff categories at a higher rate than those return clients. It's also worth noting that, just the population of filers, regardless of whether they appeared in a ghost cluster or not for this group, were we're in the at 13% of the returns ended up in the top 5% of the distribution. So they're riskier than returns overall, but and that's not something that we anticipated. So to conclude, briefly, we do see ghost preparer as a significant challenge. I think we've demonstrated that network analytics can identify specific ghost prepared returns at least. And while results are promising, as we receive feedback and refine these approaches, we hope that our results will improve. And this concludes my presentation.
All right, great. So thank you all for sticking around. My name is Daniel Reck. For some reason, this keeps automatically flipping forward, so let me try and keep it on the title slide. Okay, so this is a paper called The Offshore World According to FATCA. It's joint work through the JSRP between an academic team consisting of Niels Johannesson, Max Rich, Joel Slimrod, and myself, along with John Guyton and Pat Langeteague at the IRS. And one more thing, and then this will stop happening. I should note we have the usual disclaimer that these are just the views of the authors. And the paper is called the Offshore World According to FATCA. So you should be bearing in mind when I show you all of this that might be different from the real world, and what those differences are. We're still trying to sort out. The paper is a working paper, and so if you have institutional or some insights that would help us make sense of some of these patterns, then I hope we can talk about that. All right, so globally, there's an estimate that about $7 trillion in wealth is held offshore. That's a global estimate. The estimate for the U.S. a little bit more uncertain. This has created concerns globally about the loss of tax revenue from concealed offshore assets. And from what data we have, these assets appear to be highly concentrated among the wealthiest individuals. And so there's sort of a regressive loss of tax revenue. FATCA is part of a global crackdown on concealed offshore wealth. The intent of FATCA is to make it impossible for an American to hide wealth offshore. In financial assets, at least by implementing third-party information reporting. So we now have foreign financial institutions reporting on U.S.-owned accounts to the IRS, which, if you like, conceptually is an extension of third-party information reporting to financial income and assets in foreign source financial income and assets. Okay, so what we're doing in this paper is to use the administrative data, especially from the forms that are filed as part of FATCA. So I mean by that the Form 8966 is where we'll pull the most data, to try and understand what foreign financial institutions that are doing all of this new third-party information reporting are saying, Americans own. So to construct some high quality, the best descriptive statistics that we can from this data. The second question, which I'm not going to tell you anything about today, but the team is working on, which is sort of how does this relate to the compliance effects of FATCA? So what effect did FATCA have on compliance? So I'm going to focus entirely on a descriptive analysis today on the micro data. These are data from linked Form 8966s. I want to tell you things about how much assets are reported, who holds these assets, individuals holding assets through pass-through entities. And where the individual owners are located in the income distribution. So just before I dive into a lot of data on that type of thing, by way of background, the FATCA reporting regime works as follows. So foreign financial institutions are required to identify accounts at those institutions that are or the beneficial owner is a U.S. taxpayer, or if you want to be more specific, a specified U.S. person. And one of the important features of this is that it's focused on beneficial ownership, but in the U.S., the way that FATCA is written, a beneficial owner could be a U.S. company, so it could be a U.S. partnership, and then U.S. partnerships have owners, they're partners, and so what you might think of as a beneficial owner from a very kind of economic perspective is not exactly the same as the way things are reported. That's going to turn out to be very important because we're going to see a lot of wealth assigned to partnerships on these forms. Okay, so it's enforced by a threat of some withholding penalties. There are some exceptions where an American could have an offshore account that is not reportable under FATCA. The main exception to know about is that if the account is less than $50,000, then it's not required to be reported on, although it turns out many FFIs do report on those types of accounts. They can forego that exception to the rules, and a lot of them do. Okay, so in between, so we did a lot of data cleaning before we got to this table. There's more on how we cleaned the data, looking for things like duplicate accounts and so on in the paper itself. I'm not going to talk too much about some of the data quality issues. There are a lot of interesting data quality issues in the first few years of FATCA reporting as institutions are finding out what they're supposed to report. They're trying to track down U.S. owners. There are a few things about data quality that are going to show up in the MECR aggregates that I'm about to show you, though. Okay, so we end up, I'm going to focus mainly on 2018, where it looks like the reporting is more or less complete. The numbers are starting to stabilize in terms of the assets that are being reported over time and the number of reporting financial institutions. So we've got about $4 trillion in offshore assets that are reported on the Form 8966 in that year. That's coming from about 45,000 foreign financial institutions. It corresponds to about 4.6 million accounts owned by 1.5 million or so U.S. owners, along with another, about a third of the accounts, 1.6 million accounts that we cannot link to an identified owner, mainly due to missing tens, because the taxpayer identification number was not on the form. More about that as we go. So this is decomposing the assets that are reported on Form 8966 according to the TIN of the account owner that's on the form. And so something that's going to come out of a lot of these is there's sort of a contrast between a typical account holder, a typical account in the data, and a typical dollar of wealth. So a typical account, more than half of accounts, is owned by an individual. So this is directly, the 10 on the 1040 matches the 10 on the 8966. It's a directly individually held account. The next largest category is missing tens. I suspect many, in account-weighted terms, many of these are individuals, but we didn't get the 10 from the FFI. That's a sort of a known issue with 8966 reporting that's expected to improve as the 10 requirements get more strict in more recent years. Okay, meanwhile, the typical dollar of wealth, or dollars of wealth, are much more likely to be owned by partnerships. Partnerships have just 1.2% of the accounts, but fully a third of the wealth. So that's a sign that a lot of the very large dollar accounts are in partnerships and other types of entities. There's a chunk of wealth in C corporations, a relatively small amount in other types of entities, and then about a quarter of the wealth is attributed to those with missing tens. There are a few other reasons why we don't allocate wealth. A lot of that is sort of ambiguous matching issues or issues with EINs that show up on, that appear to be valid EINs but don't match to any tax returns. We wanted to show you quite some stuff about sort of where the wealth is located. There are some restrictions that keep us from showing by country data. So I'm going to split into two groups of countries here. Following an academic literature, I'm going to call one group of countries tax havens, the other non-tax havens. This is an evolving policy landscape, so some of these tax havens may no longer be considered tax havens, but this is just a group of two countries that we kind of understand from the academic literature. The majority of accounts are in non-havens. A typical account is in a non-tax haven country and owned by an individual, so a picture is starting to emerge here. Meanwhile, dollars of wealth are much more likely to be located in tax havens. About 50% of the wealth is located in these countries were designating tax havens. This is now going to split the location of accounts and wealth by haven status and the type of owner that we're talking about. So if you like a typical account, this is showing you that a typical account, once again, is owned by individuals, and that's sort of true in havens and non-havens, although you're starting to see accounts owned by partnerships are more frequently observed in tax havens. Whereas accounts where we can't find the owner's unknown, mainly because of missing TINs, those are mostly in non-tax haven countries. Meanwhile, for dollars of wealth, you see the partnerships, the orange piece of this bar are far more important. So partnership wealth in tax havens appears to be especially important. So there's the story the data are telling here that large accounts are disproportionately located in tax havens, and they're disproportionately owned by partnerships. I also want you to notice just how small the missing piece is once we do things in dollar-weighted terms within tax havens. So there's a few signals here that a lot of what's going on with missing TINs is more sort of small dollar accounts that are likely to be held by individuals and havens and so on. But not all. Okay, so let me back up for a second and compare what I just showed you to what we would have expected from prior literature on this type of thing. So the number in havens specifically is about $2 trillion, so about half of the total. That's 10% of GDP in 2018. The best estimate that we know of for the US was about 7% of GDP in tax havens circa 2007, so that was a long time ago. How you want to think about comparing those is up to you, but it's a pretty large number, suggesting that at least offshore wealth has not entirely been repatriated because of FATCA. Okay, now the next question we want to come to is what can we learn about the income generated in these accounts, because that's ultimately what's going to be taxable. There's been prior work trying to understand what the rate of return is in an offshore account. The FATCA data are not perfect for this because we see a lot of missing data on the income reports on the Form 8966. So the 8966 has rows for the total account balance and 4 types of flows, and those flows are very often missing. So what we'll do is the best thing we can sort of come up with here is first we'll condition on some of the income items being present, and then compute a rate of return within that sample where we do see income being reported. So for this table, it's just interest and dividends. So I'm taking total interest and dividends reported on this 8966 divided by the total account balance, conditional on our observing interest or dividends. So this is a rate of return that wouldn't include anything from, say, realized capital gains, because that's where some issues with the way information is reported get really messy. Okay, and so what we see here is you do get a sizable, a decent rate of return in that type of a sample. Overall, around 3%. It's quite heterogeneous by the type of account, who owns it, and where it's located. So we're seeing larger returns in tax haven countries and for accounts owned by either individuals or partnerships, relatively lower rates of returns for the more exotic types of entity owners or in non-haven countries. And those rates of return are 5 and 6%. I mean, those are significant and right in the ballpark of what one might have guessed from previous research on this stuff. Okay, so partnerships hold the plurality of assets, and so the next thing that would be natural to do is to link the partnerships to their owners and to learn about, within the, U.S. tax environment who owns this wealth. So we have done that. We take the 1065s that match to 8966s and then the K1s attached to those, and then find, distribute foreign assets and income to the owners of partnerships. And we do that based on the share of total income distributed on K1s. There's some issues there with sort of the relationship between realized and unrealized capital gains and sort of special partnership allocations. That may not be perfect. You might take it with a grain of salt. But we do look through, partnerships that are owned by other partnerships and so on to get to, as best we can, an ultimate owner. This is just a descriptive fact about the types of partnerships that we're talking about here. This is the NAICS code that is assigned to these partnerships. So this is, and it's all in dollar-weighted terms. So it's like the share of assets. What we see is about 70% of partnership wealth is in a single NAICS code, 4-digit NAICS code, which is 5239. That's other financial services. This is the NAICS code you expect to see around private equity, offshore investments, the financial partnerships that facilitate that type of activity. There's this other financial category that accounts for most of the remainder. So these are the so-called financial partnerships, maybe not so surprisingly. And when we allocate the wealth that partnerships own to the owners of the partnerships, this is how things break down in dollar terms. The red is the share of assigned wealth. The blue is the share of all partnership income, just to kind of give you a comparison. And indeed, things break down kind of similarly for FATCA wealth compared to, say, all partnership income. About 10%, a little more than 10% matches to entities like tax-exempt entities and trusts. There's a share that it belongs to foreign corporations, but most of this wealth, just over 55%, we can allocate to a U.S. individual, like a 1040 filer. And so everything that I'm about to show you in the next few slides is just based on these individuals who own wealth through a partnership, who own offshore wealth through a partnership, and individuals who directly own offshore wealth. And we're not going to focus going forward on any of the other categories. And you might expect that to be pretty limiting, but it turns out that we do have pretty good coverage of at least one segment of the income distribution, despite all of those limitations and sort of what we're able to focus on. And that is the very top of the income distribution. So despite the fact that this linkage is only based on a portion of the wealth, we're ending up with over 60% of individuals in the top 0.01% of the income distribution who are showing up in these data as owners of offshore wealth, according to Form 8966. Much of that through partnerships that they own. So the blue is individuals who only own offshore wealth through a partnership. The gray are individuals who own some wealth directly as an individual and some wealth through a partnership. And the black is individual only. So you can see that a lot of this, a very large fraction of individuals have at least some stake in an offshore account, most of that through pass-throughs, and most of it also in tax havens. So this is now adding the dimension of whether the account is located in a tax haven. You see that of that 60%, in the top 0.01% of the distribution, almost all of those individuals have accounts in tax havens. Now, even within the top 1% of the distribution, that gradient, the probability that you show up as an owner of offshore assets is steeply increasing, suggesting there's meaningful heterogeneity within the top 1% of the income distribution here. The losses bucket also pop out as somewhat important, because that doesn't include a number of high income, high wealth persons, so it shouldn't be totally shocking. Okay, so next we've looked at the dollars of wealth. I guess before I show you that, let me tell you that that steep increase, although it's the absolute level of it, the fact that we get to 2/3 of individuals at the very top of the income distribution is a somewhat surprising fact. The steepness of this gradient, and then the fact that you have people at the very top are much more likely to own offshore wealth than people even a little bit further down in the income distribution. That steepness should not exactly surprise you based on prior work from, based on the Offshore Voluntary Disclosure Program or amnesty programs in other countries. Finally, in dollar-weighted terms, what share of the assets is owned by individuals at different parts of the income distribution, continuing to focus on directly individually held wealth and individuals owning wealth through partnerships. And indeed, the wealth is quite concentrated. So for wealth owned through partnerships specifically, almost half of the wealth is owned by the top 0.01% of the income distribution. The lion's share of the rest is belonging to at least the top 10% of the income distribution. The wealth that's owned by partnerships is more concentrated, suggesting owning wealth through a partnership is a sign of sophistication. That stuff is more concentrated at the top than the directly held individual wealth. And these numbers are, once again, there's a more detailed laying out of all of this in the paper, but they're roughly comparable to what you might have expected based on the partial data sets of owners of offshore wealth that one studies in prior work. we have in summary of that, about 46% of reported offshore partnership assets are owned by the top 0.01% and 80% of those by the top 1%. So, given what we know about the concentration of offshore income and also the concentration of partnership income specifically, so it's about 70% of all partnership income ends up in the top 1% of the income distribution. What we're seeing in the FATCA data sort of gels with all of that, but this is the first time that we're seeing it. And then finally, this is about how the dollar totals break down between havens and non-havens. We're seeing that non-haven wealth is actually, offshore wealth is actually rather concentrated. So it's not the story that all of the concentration is in tax haven owned wealth. Nevertheless, you see comparable rates of extremely concentrated ownership in havens, and non-havens a little bit more concentrated in tax havens. Okay, so putting it all together, including havens, non-havens, pass-throughs, individuals, it's about 30% of the total wealth that's owned by the top 0.01%, and about, I don't know if I have this one in a picture, it's about 60% of the wealth at the top 1%. Okay, that I'm going to skip over that. If you want to see a really detailed comparison of this to prior work that uses things like the Nordic amnesty, there was a Colombian amnesty program. You see quantitative comparisons to all of that, then that's in the paper. Okay, so what do we take away from this? FATCA is providing new evidence on how much wealth Americans hold abroad. About $4 trillion of financial wealth is reported on these forms. About half of that, or about $2 trillion, is located in tax havens. That's on the large side of what you would have expected from prior work, but it's not, not to an insane degree. And a large share of this wealth is held indirectly through entities. At least 46% of the wealth is held indirectly. An important implication of this for our ongoing efforts to understand the compliance effects of FATCA is what was the compliance effects for partnerships is about 50% of the answer to the question of what was the compliance effect of FATCA overall, because about half of the wealth is owned by partnerships. And so we really need to drill into the partnerships and embrace the complexity that that entails in order to understand the effects of FATCA. So if you're thinking about the incidence of the revenue effects or the compliance effects of FATCA, those are likely to be highly concentrated because a typical dollar of wealth, and thus a typical dollar of income generated by offshore wealth, it is falling pretty high up in the income distribution, although there are a large number of individually held small dollar accounts where we might worry about things like the compliance, the costs of FATCA, that are further down in the income distribution. So these are just some of the more striking figures on the extent of the concentration of the FATCA wealth. So that's 62% of households in the top 0.01% of the income distribution, 64% of the wealth owned by the top 1%, 77% of the top 0.01% foreign assets are held through pass-through businesses, especially important. Pass-throughs are especially important at the top. Okay, and so those are important distributional facts to be keeping in mind as we evaluate FATCA, and it's pointing to what are the important populations to really understand if you're trying to understand the compliance effects of FATCA. So with $4 trillion in wealth and a decent rate of return on that wealth, there is a substantial potential compliance effect of FATCA, but we still don't know really how tax compliant these populations where the data are telling us it's especially important to understand, like were those populations tax compliant after FATCA? Did FATCA actually make them comply? And were they in fact non-compliant before FATCA? To what extent were they non-compliant before FATCA? And then everything that I'm showing you is sort of after any repatriation effect of FATCA. So there's been some recent work on that suggesting that there is a significant compliance effect coming through that channel as well. It's a challenging question. Can you wrap it up? Yep, I sure can. That's a challenging question to answer, the compliance effects. So maybe next time. Thanks, everyone. appendix for you.
All right, thank you very much. I'm Paul Organ. I'm an economist in the Office of Tax Analysis at the U.S. Treasury. Very happy to be here closing us out with a brief discussion of these three papers. And I'll just note these are my opinions, not those of the Treasury. So I'll be discussing these three papers, and I was trying to think what connects these three papers, what brings them together. And I came up with two things. So one is these are papers that are either they're applying new methods to existing data, or they're thinking about our existing methods and applying that to new data. And they're also highly operationally relevant and also of academic interest. So I think this is very much in the spirit of this conference and of what Barry was talking about this morning about bringing academics and the IRS together to work on things together. So starting with the K1 paper, following the K1s. So I think there's quite a bit to like about this paper. So I think it's a clever idea to look beyond just an individual taxpayer and understand that taxpayer sits in a network of all kinds of other actors. Their tax preparer, potentially their partnership if they're in a partnership network, other taxpayers. Alan alluded to this a little bit in thinking about spillover effects and that there is some research in this. And so these two sub-bullets here, I think you could think there's sort of a predictive or a correlative question. So if you look at the people around a taxpayer, what can we learn from looking at them about that taxpayer? The second sub-bullet there is sort of about a causal question. How does what other people in a taxpayer's network, how they act, how does that influence the focal taxpayer's behavior? And I think that this research could speak to both. At the moment, I think it's mostly speaking to that first question, and that's the main goal. And I think that on its own is interesting. But I would also encourage the authors to consider that second question and maybe push in that direction, whether in this project or another. And then I think it also shows something interesting about how you can observe one group of taxpayers about whom you might have a lot more information, or just particular information here that they're reporting foreign accounts, and then see how carefully analyzing that group, you can then learn about a different group of taxpayers. And also, I think they, as you saw, carefully thought about what variables should be included in the model, what are the costs and benefits of that. So I'll keep my comments or suggestions for this paper are threefold. So one is trying to take advantage of the richness of information in that taxpayer network, then trying to understand how well the prediction is working, so backtesting it, and then I'll talk a little bit about maybe a next steps, timing and mechanisms. So Tomas presented that, or showed that network, and you saw how complicated it could be. There could be the focal taxpayer who is receiving a K1 from that they've got a 40% share of, and they're also receiving a K1 with a 1%, and there's so much information contained in that graph. And at the moment, that's all getting distilled down into one binary variable. Does this taxpayer, I guess there's a little bit of a timing dimension, but it's like, is there a reported foreign account in that network or not? And I think, I would just encourage the authors, I think you could use that network and collapse that with a little more richness, thinking about how many accounts are in that. Of the dollar value in this network, how much is represented by the foreign accounts versus not. And I think that would help. The information then contained in those variables would be a lot more precise than what is right now just getting condensed and flattened into a 1-0. And so I think that would help lead to tighter predictions. And then another sort of side note, but would be maybe making that network even more complicated, adding the taxpayer and thinking about how, or the tax preparer, the accountant, how they're involved here too. I think that would speak to the mechanisms too, so I'll bring that back up. Okay, my second comment is sort of about, so the goal of this paper, maybe the main goal is we want to use what we observe about taxpayers who are reporting foreign accounts and see what does that tell us about the taxpayers who aren't. Might they have accounts that they're not reporting? And I think a key question then is, does it work? Like we build this algorithm, we build this prediction approach, is it actually successfully predicting the taxpayers who we should maybe go look for? And I think there's two approaches you could take that. One would be, we have our predictions, now we go forward, we do some audits and we evaluate. maybe that's in the cards. But I think you could also try to find, are there examples of existing historical data that you could use to backtest this algorithm and then maybe improve it and tweak it. So my ideas there were, you note there were these programs over the 2010s where there was increasing disclosure of foreign accounts. You might be able to use some of that information where you observe taxpayers newly reporting accounts. So if you roll back a couple of years, apply your approach of following the K1s and say, is it flagging the taxpayers who you then expect that you think should be reporting an account? Do they actually show up reporting an account? Maybe the NRP would give you something here where you have some randomness, because of course the reporting of accounts during the 2010s was endogenous and not random, but the NRP might give you something. And then I do think, very related to Daniel's paper, what would this approach? You observe the reported foreign accounts. It tells you something about the potential number of unreported accounts. What would that say about the size of undisclosed accounts, and how would that relate to what we see in the FATCA data? All right, and then finally, sort of an idea for future research here. This is more on the causal question about what is causing taxpayers to report a foreign account. And so my idea here is something about one mechanism for that might be other taxpayers in a focal taxpayers network starting to report, and that information just kind of permeating throughout that network. Hey, I just reported my account, maybe you should consider doing that. Or I just got a letter, you should do this. You could imagine it flowing through this network. And I think you could test for that. So you have these data, you observe the first year in which the focal taxpayer has someone in their network reporting. I think that's a nice setup for an event study approach. I think you're pushing in that direction, which is great. And you actually have some evidence of this. So you do test current versus prior year, and you see a different effect there. So I think that suggests this is worth considering. Okay, so moving to the ghost preparer. I couldn't show a ghost preparer, but this is a prepared ghost with a first aid kit there. So again, I think this is another great example of a paper that's applying, to me, very exciting new methods. And I think it's a really great example of often those methods are exceedingly complex and technical. And so it's not necessarily a method that I could apply or that most people can apply. But what I like about this paper is they are applying that method and distilling it down and explaining it in a way that practitioners and others at the IRS can then use that tool. So we all benefit from the use of those methods, and that's just great. Like, that's a thing that I think we should all strive for. And finally, I think they're trying to build a tool that is adaptable. So as new data comes in, they can build that into this clustering approach. And it's not just a fixed tool that is then done. So 2 big comments on this paper, pretty similar to the first paper. One is how effective are the algorithms? And then the second is just thinking about how to explain the different clustering approaches and the costs and benefits or pros and cons of those approaches. So my comment here is going to sound pretty similar to the last one. We developed this approach where we are trying to predict potential clusters, potential ghost preparer clusters. And what we really want to know is, did it work? Did we actually prepare a cluster or not? And so again, you could do that forward-looking, and that may be happening, but I think there might be some, I think it's worth getting creative to think about a way that you can find some past data. So the paper notes that they're, at present, basically the way that ghost preparer networks are noticed or identified is kind of ad hoc referrals. People get a tip that it might be going on, or it comes up in another compliance engagement that they're checking something else and they discover that it's a ghost preparer. So of course, those are totally not random, but they are there, they exist, and that gives you a flag of you have some historical information about what were truly identified ghost preparer networks that might allow you to then apply the algorithm in the years leading up to that and see if it would predict that, and then I think you could iterate on that. And so Josh also noted there are a couple of different cluster approaches, and a key piece of that is the information that is going into the algorithm. So there's a risk-based and a top-down with the label propagation. I think it'd be really helpful for the reader to see a table of like, here are the approaches. What do we gain by doing this approach, and what's the cost of that? Well, so that we could decide like what is the correct route to go down. And then thinking about this as sort of a repeated game with the ghost preparers, that they are adapting to what the IRS is doing and changing their behavior to not get identified. So thinking about the information that goes into each of these approaches, what of that information is a fixed characteristic that the taxpayer can't change versus, for instance, one of the pieces of information is about the phone number that they put in. That's something they can play around with, but there might be other characteristics that are fixed. And we might want to build a tool that relies more on those fixed characteristics that the ghost preparers are less able to game. Okay, and so finally here we have the offshore world according to FATCA. I'll have a comment on the subtitle of this paper shortly. So stay tuned for 2 minutes from now. So things to like about this paper. Really exciting new data. I think we all just learned a lot in the last 15 minutes, so it's really exciting to see this data finally being analyzed. Really careful, detailed linking. I know it probably took a ton of time to take those partnerships and actually get them down to individuals. We just get to see on slide 2 or whatever the table, but you could probably have 1,000 slides before that, so props on that. And I think, of course, this is going to spark some follow-on research, of course. So I've also had the fortune of discussing this paper at length with the authors, and so I was trying to think of what are new comments that I can tell them that will help improve the paper from where it is. And so I'm going to talk about one mostly, which is about what we can learn or what could we learn about those unmatched 40%, and then what that would inform about the overall, the universe. And I'll talk a little bit about U.S. citizens abroad. Right, so in that table of kind of splitting down by types of owners that Daniel showed, about 40% of the accounts, 38% of the wealth, a little more of the accounts, is not able to be matched. And there were a couple reasons. The big one was no TINs, but there's some other things. And I think partly inspired by the earlier 2 papers in this session, I was thinking, like, what could we do? What could we learn about that 40% unmatched to predict something about if we had more information, or what bucket should it be going into? And I think we do have some information about those counts. So like the 8966 that's filed by the FFIs. Well, first I think it would just be useful to know, like, is it that whole FFIs are reporting on accounts and none of them are matching? Or is it that an FFI reports 100 accounts and most of them match, but it's a few that don't? Those are different situations, and we might think differently about this. But also, even for the accounts that we do get, we know some things, like what currency is the account reported in. Understanding we don't always have every field, but we know some things. And I think that the approaches of the first 2 papers are thinking about prediction. And so you could take some of those methods and try and do the same thing here. Given the information that you have, predict, do your best to get a probabilistic sense of what bucket it would fall into, and then that would help us learn more about what we can say about the universe. Okay, and just finally I'll note, so some of this is going to be U.S. citizens who are living abroad. And so calling this offshore wealth, foreign wealth of U.S. households, I think is mostly true. But it's certainly the case that some of it is what they would call local wealth of foreign resident U.S. citizens. And that is a mouthful, and I would not add it as a subtitle. New evidence on foreign wealth of U.S. households and a little bit of local wealth of some foreign, that's not good. But I do think you could quickly get a lower bound. You could look at the addresses, are they foreign filers, and just right off the bat of the individuals, that's a quick statistic to get. I also think of the unmatched, the 25% no TIN, probably a huge chunk of those are accidental Americans or foreign residents, and maybe the predictive method would pick that up potentially if they looked similar to the matched TINs who were foreign resident, that would give you something. So I think I'll leave it there, or I'll leave it with a teaser, which is I'm very excited about the causal work. I know that it's ongoing, and I'm excited to see that. So thanks very much.
speaker at the bottom. Okay, thank you. Okay, so we have some time for a few questions from the audience, if there are any questions. Yes.
This is a question for Josh. Paul mentioned an idea to, you mentioned you don't have any label data on who's actually a ghost preparer. And Paul gave an idea of looking at, referrals. Maybe another idea could be looking at tax promoters to see, because those are identified by the IRS. So maybe looking at tax promoters to see what types of networks surround them as a way to infer something about shady preparers in general.
That's a good idea. Thank you.
Yeah.
Questions for the first and third papers. So the first one, are you grouping together K1s from partnerships and from trusts? Because those seem like very different stories. So like in particular, I would think that the partnership K1s, right, these are mostly private equity firms, whereas the trusts are probably going to have relatively small networks that mostly just consist of a few beneficiaries, that sort of thing.
Yeah, so we are including S corps, partnerships, and trusts. That is something that is a variable that we did look at for the model. So whether or not in that K1 taxpayer model, we did look at whether they received the K1 and who the payer was, the type of entity.
I mean, I think it would be interesting to see coefficients separately for those entity types. My hypothesis is that there's a very different coefficient, but I don't know if that's what you find. And briefly for Daniel, so I guess one puzzle is, why is this money in a haven at all? We have for individuals, if you're a U.S. citizen, we have a worldwide tax system, not for the C corps, but for the other taxpayers. What are they getting out of it? And I guess one hypothesis is they are sheltering trust income from their state. And so it'd be interesting to know whether there's a difference between the proportion that's held in havens from high tax states versus low tax states relative to the overall, expected wealth from that state. Yeah,
Okay, so thanks for the suggestion. I had not thought of doing that, and that's something that we can certainly look into. To the broader question about why people own wealth in havens, I think there could be some tax motivated reasons, like the one you suggest. A big tax motivated reason that's supposed to have just changed is the enforcement environment. So why people still hold wealth in havens, I don't fully know the answer to that question. I think from what I have read, there are investment vehicles that open up to you if you invest through offshore companies, because that are dodging some rules about how U.S. companies can invest. So there's some potential there. I don't pretend to be an expert on all of that stuff, and if anyone in the room wants to talk about it after, then I'm all ears.
Quick question for either Paul or Daniel. Just that last point you made about foreign residents. Isn't their income still taxable by the U.S.? And so why exclude them from the calculation?
Yeah, so if your only goal is to understand tax compliance for the reason you've just mentioned, you wouldn't want to throw them out of your sample. If you are trying to compare to NIPA data on, say, all U.S. households, then those people are not considered U.S. households according to some of those types of economic statistics, and so you might want to exclude them. It's a fair point, by the way, that's something we could look at a little closer.
And I'll just clarify, I'm not suggesting to exclude them at all. Just I think it's interesting to know how much is one versus the other, and that there's different policy implications of what we might do about one or the other.
So I have kind of two questions. The first one for Josh, and I think more of just a comment. One thing that seemed really interesting was your statistics kind of on what the returns of these ghost preparers look like, that they increase income but also increase the EITC credit. And I think it'd be super interesting if you could show, and if it does happen, because you have a phase in and a phase out for the EITC, if you're on the lower phase in threshold, your income goes up to get you the max credit. And if you were phasing out, the ghost preparer brings your income back and lowers it to, again, get you the max credit, and if that's more likely with ghost preparers than not.
That is a really good idea. It would be, yeah, that's a good idea. That's something we should do.
And then for Daniel, a lot during your presentation, you mentioned wealth. And I might be wrong on this, but right, you only have kind of the monetary or stock accounts. If the partnership, say, partnership is in Bermuda and it owns an apartment building in Germany, do you have like the value? You don't have the value of that building, right, from the FATCA reporting. You just have the monetary assets.
Okay, so some of this gets a little complicated. So if you have, say, an offshore company that owns some real estate in, pick a country, wherever, then the shares that you own in that offshore company can be an offshore asset that's reportable under FATCA, depending on how you own it, who does the reporting, like who's the FFI. If it's extremely closely held, so you can end up in a situation where it's you. So whether that stuff gets reported on, whether they comply is sort of dubious, but you can end up with a lot of situations like that where wealth is held in a way that there is a financial asset that should be reportable under FATCA, even though what you might think of as the more primitive underlying asset is real estate or yeah.
This question is just about one of the tables, Daniel, that you had on the FFIs, where it was like 45,000. Is that controlled for ones that issue 8966s or just ones that are registered and could issue a form?
That is a count based on the 8966 data. So that is the number of FFIs that file an 8966 for at least one account holder that is not a useless record that we scrub from our data. So literally, that's what the number is.
Thanks.
My question is for Tomas. You mentioned in passing that you had used diff scores to try to identify new clusters of ghost preparers. Can you elaborate on that a little bit?
For Josh.
Sorry. Josh?
Sure. I think outside the work in the paper, we definitely did look at diff scores for returns that ended up in suspicious clusters versus returns that were prepared by preparers or self-prepared, and then within preparers we tried to do some sample matching so that we could try to replicate the population of individuals who appear to be having their returns prepared by ghost preparers, and we did find that the returns that ended up in these sort of suspicious ghost preparer clusters were, at least according to the diff calculations, more risky than any other population we considered, including those of those returns prepared by the riskiest preparers that are as identified by another risk metric. So we did that was one analysis that we did that didn't end up in the paper. But yes. But diff is not part of the clustering approach.
Other questions? No? So I had a question, especially for Tomas and Daniel, but especially for Daniel. So we've been thinking about compliance and trying to do more on compliance and quantifying. And I'm wondering if we've also heard a little bit about accidental Americans and people who are caught up in the system. I was wondering if you had any thoughts about trying to work more on the taxpayer compliance burden.
Well, I should mention there's an excellent study related to this by Paul on people who renounce their citizenship in response to FATCA. So there's some research on that, and I think it's important. I think if we ever get to the stage where we have enough of traction on compliance effects to start to think about evaluating FATCA systematically, you really would want to bring in some numbers and try and get some numbers onto those sort of compliance costs because it is important. I agree.
Yeah, I guess to add one thing that differs between kind of our work and what Daniel is doing is that the majority of our population were FBAR filers, and so FBAR, the threshold is $10,000 for a foreign report, for an account, so it is most likely going to be, and individuals, so kind of what Daniel showed, so it is definitely going to be more like potentially kind of accidental Americans, or probably not that 0.01% that Daniel's trying to get at there.
Recent U.S. citizens, too.
Right.
Right, and a few others.
You got me in there.
Okay, any other questions? No? Okay. Wait, just stay, Daniel, Joshua, just stay here.
I'm going to just a minute. Wow. I hope you all have as much fun today as I have. This has just been a really great day. Thank you to all of our speakers for taking time to share their research with us. It takes a lot of work to put together these kinds of presentations and to prepare, and we really appreciate all the effort that went in. It really showed in the quality of what we saw. Thanks so much to our discussants for reading the papers and offering such thoughtful and helpful suggestions for how we can improve the research. Everyone should look forward to the published volume coming out sometime next year with these papers in them. Thanks also to the conference organizers. That's a big job, sifting through all the different papers and putting together coherent sessions that are interesting and hang together, and you did just a marvelous job. Every year we think, wow, what a great conference, how's it going to get better? But every year it seems to get better, so thank you so much for that. Thank you again to the Tax Policy Center and to Brookings for co-sponsoring and for hosting to make today so special. And then finally, thanks to our audience, both those of you who are here in the room, and for those of you who are virtually with us. I hope that you all really enjoyed this and learned something today. And I hope that we see you all back together again next year. So thank you all.